Good morning. It is Wednesday, November 2nd here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Stasi. It's a busy day on Wall Street, so let's get right to the three things you need to know as the clock hits 9 a.m. Mixed action in futures today. Investors playing the waiting game. Of course, they're waiting for the Federal Reserve's policy decision and future guidance as well this afternoon. The Fed widely expected to hike rates for the fourth time in a row.
And earnings parade on Wall Street. Chipmaker AMD is rising on an earnings beat, but the company issued a gloomy outlook for the quarter and warned of weakening consumer demand.
And Airbnb shares are falling this morning. The company had its best quarter in its history, but said things will slow down in the holiday season. The company citing impacts from the strong dollar and shifting consumer behavior. We'll break down that report very shortly. But we have to begin today with our top story. The Federal Reserve is expected to continue its fight against inflation and boost interest rates by 75 basis points later today for the fourth time in a row. For more on the Fed and what's ahead, let's bring in Yahoo Finance Fed correspondent Jen Schonberger. Jen, this morning we got some hot ADP job numbers that comes on the heels of, I would say, a hot JOLTS report yesterday. Clearly, this puts some pressure on the Federal Reserve.
Good morning, Brian. Absolutely. I am here live from the Federal Reserve in Washington, where in this building behind me, Fed officials are commencing a second day of their two-day policy meeting where they are widely expected to raise their short-term benchmark interest rate by another 0.75 percentage point when they conclude at 2 p.m. this afternoon. Though it will be what Fed Chair Powell says during his press conference about the pace of future rate hikes that markets will be most attuned to. With inflation continuing to trend toward multi-decade highs, officials are expected to raise that Fed funds rate to a new range of 3.75 to 4% from the current range of 3 to 3.25%. Now, the Fed has raised rates by 3 full percentage points already this year, and another 75 basis point rate hike would mark the fourth in a row since June, an unprecedented move since the Fed explicitly started targeting the Fed funds rate back in the late 1980s. Now, if they do proceed with that 75 basis point rate hike, it would mean that the Fed funds rate is back to a level not seen since December 2007. And while the Fed likely to pull another jumbo rate hike today, investors largely expect that the Fed will signal that it will slow the pace of future rate hikes, that is, reduce the size of future rate hikes at forthcoming meetings. Though while the pace may slow, that may not have a bearing on how high the Fed funds rate could go. Right now, the Fed expected to raise the Fed funds rate to nearly 4.5% by December, though markets pricing in the chance, 50% chance, that rates could go as high as 4.5 to 4.75 by the end of this year, according to the CME. Of course, all of this hinges on the data and how hot inflation comes in. We will get more guidance from Fed Chair Powell when he holds his press conference at 2:30 this afternoon. Ryan?
Yeah, I'm going to take it, Jen, getting a lot of questions, I'm sure, in that press conference on that future rate path of policy changes, right? I imagine that's where most of the questions are going to be centered here. In the past, the chair has sometimes muddled the message, right, in those press conferences. So I'm curious what you expect from the presser and whether there are going to be other things perhaps that people are going to be asking about as well.
Yeah, hey, Julie. So I think that, as you said, a lot of attention going to be paid to the pace of future rate hikes. I don't think that Fed Chair Powell is going to commit to anything specific here because it's really going to hinge on the data. So one question I think looms is we're going to get another CPI report next week. If that comes in hot, does that mean that another 75 basis point rate hike is still on the table as opposed to slowing down to perhaps 50 basis points as many in the markets are sort of gunning for here? So that's a major question du jour. And just basically, how is the Fed viewing inflation now? As Brian mentioned, we had that hot JOLTS report. The labor market clearly holding up here, even though there have been some signs of cooling, it's still remaining tight. So really getting an understanding of how the Fed is viewing inflation now and how that ties in with the pace of rate hikes and how high they could go on the Fed funds rate is what we'll all be attuned to this afternoon.
Yahoo Finance's own Jen Schonberger. They're outside of the Fed. We got a lot of big news that's going to be coming through today. We appreciate you really setting the scene for us, Jen. We'll check back in later on. Switching gears, everyone, AMD stock climbing this morning after the chip maker posted slightly weaker than expected third quarter earnings, but noted solid gains in revenues in its gaming and data center segments, which partially offset weakness in the PC market. We got to set this scene here, though. This was on some of the weaker guidance that they had already issued and put out on the street. So with that in mind, and that kind of as the background there, even with those preliminary results that they announced last month, they were still, in this case, pleased with the performance of data center, gaming, and embedded segments, each of those growing significantly year over year. It's just a matter of when we continue to see some of this PC demand. As that continues to wane, what does that mean in the road ahead for this business as well?
Yeah, this PC correction just seems to be rolling right along and getting worse. I did not like that Lisa Su, CEO of AMD, hopped on that earnings call last night and said they don't really see any growth for China, and that perhaps continues into next year. I tweeted that out, just a big red flag for me. Also going to note a good note by Citi, Chris Danley, he covers the chip space. Neutral rating out this morning. He thinks the rest of the AMD's business, that is data center and consoles, will in fact correct. And when that does, that might be the buying opportunity. I think the street is surprised to see this reaction here in the early going.
Yeah, and you continue to have the arms race, if you will, the market share race between AMD and Intel. As we know, AMD has gained a lot of share, particularly on that all-important server side, which has been such a growth area for them. On the PC side this quarter, they actually lost a little bit of ground to Intel, in part because AMD held the line on pricing, right? Would not necessarily offer some of the discounts or the lower prices that Intel was offering. But from what the analyst commentary I'm seeing, they expect AMD to continue to sort of regain that share and continue its momentum on the server side of the business.
Yeah, Lisa Su saying on the call last night, the PC business, it is more price sensitive, and they've seen it become more price sensitive over time. They believe that there's a strong value proposition, but that value proposition, when you have less demand that continues to trend lower, that might not mean anything, unfortunately. It's really just coming down to how much of the total addressable market still remains intact, and that's just not the case. It's not remaining intact.
Right, and I would just add on this move here in the pre-market, I don't think it's really a function of the results, because to your point, they missed their lower guidance. You never want to see a company do that, but next week they're coming out with their latest set of chips. Genoa chips. They like naming all their chips off of Italy for whatever reason. Italy's cool. My grandparents from there, hat tip to that. But I'm just saying, I think this is a market getting excited about the next generation of chips for AMD, which will likely be far superior to many others in the marketplace.
And there seems to be also maybe a little relief that they weren't worse, right? Even though the forecast for the current quarter is a little bit light of estimates, it's still an increase, not a decrease.
It's not an AMD problem. You have to think about Intel has been behind the curve in terms of products for the past 2 years. This is AMD feeling the effects of the marketplace. And this PC correction is terrible. And you have no indication it's going to be done anytime soon.
Well, here's another company that's affected by the wider world, Airbnb. We're watching that stock as well this morning, which has been tumbling. Right now it's down about 5%, actually, not down as much as it was earlier, beating on the top and bottom lines in the third quarter, but then giving a disappointing outlook for bookings in the fourth quarter. And as it's facing some macroeconomic headwinds, and also just sort of, again, this readjustment, normalization process post-pandemic. What does the travel landscape look like post-pandemic? Are people going to be going for long stays, working remotely in other places? I think individuals are trying to figure that out. I think Airbnb is trying to figure it out. We saw a shift back towards some more urban bookings during the third quarter, which indicates maybe a roll-off of people going and staying out in the country somewhere and working remotely. And so, I think investors are also trying to wrap their heads around that shift back towards what does normal even mean anymore, but a shift back to that environment.
Yeah, and that's going to have an impact on the average daily rate. You figure a lot of the more urban listings that they do have, it typically comes in at a lower rate. And so that average daily rate was about $156 in this most recent quarter. That was up by about 5% year over year. And then you think about the stays as well, as you were mentioning, Julie, the long-term stays, 28 days or more, that accounted for about 20% of the nights booked. And so all in, when you have the return of urban stays and cross-border travel combined with even the average daily rate improvement, the active listings growing as well, the quarter itself wasn't bad. I mean, this was their most profitable quarter in the company history. It's really just the guidance going forward from here. They're talking about a choppy return on that cross-border travel as well. And then additionally, there are going to be some high marketing costs to really get more hosts on the platform too.
Right, and I think all this was captured in a really good note this morning by Lee Horowitz over at Deutsche Bank, saying next year the core metrics of the Airbnb's business can prove, quote, highly volatile. So you take some of the maybe recessionary concerns, you have the fact that Airbnb is going to be cycling tough comparisons. What does that mean in plain English? Some of the growth rates are likely to slow, not good when you have a stock value like Airbnb is, a premium to the broader market, and you don't have a good setup for the stock.
Yeah, and if a lot of their gains were coming from price increases and that 5% average rate increase that you were talking about, how much will that moderate, right? If inflation starts to moderate, will there be some pushback against those higher rates? But this is a pretty variable environment in terms of rates, right, for Airbnb, and so we'll see if they can maintain those kinds of gains.
There is some historical data to look back to with Airbnb because this is a company that had to operate through the Great Recession. When Airbnb started back then, they had a lot of people that were coming on the platform to host to get that extra income. It's just a matter of how much for Airbnb, given the scale up that they've had since that time as well, where they're able to kind of maintain some of these key metrics that investors are now really parsing through and looking through to really understand the strength and the health of the business.
So what you're saying is if we get into a recession, I rent my place out and live out of my car, basically.
And
That's
it doesn't even have to be the whole place. It could just be the couch.
Just be the couch. Okay, I can do that. That's great.
Yeah.
$500.
Next time you do your hit from home, we'll just see somebody in a bathroom walking behind you to get something out of the fridge. Looking forward to that.
Frightening.
Looking forward to that.
All right, guys, Sazi Sweets. They're going to list on.
Yeah.
Guys, coming up, BMO's Jennifer Lee will join us to preview the much anticipated Fed decision next. The Federal Reserve is widely expected to once again raise interest rates by 75 basis points for the fourth consecutive meeting. Joining us to break it all down is Jennifer Lee, BMO Senior Economist. Thanks so much for taking the time, as always, Jennifer. Always value your insights. When we think about the data that's been coming through, though, this doesn't really make the Fed's job any easier, quite frankly, especially if we're looking at some of the employment data that has continued to pour in this week and even ahead of the monthly jobs report.
Good morning, and you're right. It's not only the jobs data, and then of course you're referring to the JOLTS data that we saw yesterday. This morning's ADP was also above expected. Even the auto sales data, depending on which report you're using, hit the highest level since earlier this year. So it just goes to show that the economy can still withstand higher rates. And for sure, I would love to be a fly on the wall this afternoon when the Fed concludes its meeting. But like everyone else, we're looking for another 75 basis point move this afternoon. But of course, what he says during the press conference is what everyone's going to be hanging their hat on.
And so, Jennifer, just I guess to ask that a slightly different way, when we look at data like the ADP report this morning, which came in higher than estimated, maybe as a precursor for the jobs report on Friday, is that data a problem for the Fed? And should it be, not to say overlooking jobs data, but maybe focusing on other indicators to give us a better idea of whether their efforts to bring inflation down are working?
You're right. I think they are, but at the end of the day, it's all going back to the labor market because you've got there are two mandates, and the labor part, the employment part, can be checked off, but they still see the job market as being far too strong and too tight, and they are okay with just loosening it up a little bit because that if it's too tight, then it's going to suggest that wage pressures will continue to bubble along, and that's going to be very inflationary, and that's what we are continuing to see. We saw that last week in the ECI report. The wages data from the personal income and spending numbers that were out last week also continue to point to strong wage pressures, which, as I always say, it's such a weird thing. It's a good thing for consumers because they're getting more money in their pockets, but at the same time, it's very difficult for businesses as they're passing out more in terms of it's costing them a lot more. And again, it's that whole inflationary impact that the Fed is trying to tamp down on.
Jennifer, another rate increase before the holidays on top of several rate increases this year. What does that mean for consumer spending in the fourth quarter?
It's going to cool it even further. It's already started, right? We're already starting to see the slowdown in spending in the retail sales front. But at the same time, because we're still looking at strong savings, they've been working down on their pile of savings, but at the same time, there's still money coming in terms of from the wage front. So that helps. But I think consumer spending has already started to slow, and it will slow further. We are still looking forward to consecutive quarters of negative GDP growth in the new year. And contributing to that will be slower consumer spending. If
consumers make it through this holiday season, perhaps, with the amount of spending that is anticipated and are still healthy in their household balance sheets, is there a point that you look out to next year where there's a serious checkpoint that needs to be done to really see if the consumer strength in their household balance sheets is actually still there, or if that has withered post a major spending cycle?
Well, I would hope that it's not going to be withering too much. We want the Fed wants the consumer to slow the spending down, but not to the point that it's going to, be catastrophic, I guess. Again, they're just looking to slow spending, slow economic growth down, cool inflation down, back down towards 2% or heading towards that pace to that level before they start cutting rates, if we even start talking about cutting rates. But, I think it's quite possible that we could actually see a non-dovish tone today during the press conference. I mean, the base case right now is that he's going to start talking about or hinting towards slower rate increases. But there's a chance, just given some of the data that we've been seeing lately, that he doesn't do too much on that front and still continues to point or warn to higher rates ahead.
Jen, if we fast forward a year from now, what does the unemployment rate look like, given that there are still so many openings out there, for example, and the jobs numbers have been holding up pretty well?
Higher, in a word, higher. We're looking for maybe about like a percentage point higher or so, 1.5 percentage points higher than where we are now. Again, this is just part and parcel of what happens during a recessionary time. Again, we're looking for a mild recession, and not a hard landing. But at the same time, it's going to be some pain felt. That word that is being used broadly across the world by central bankers these days. There will be some pain felt by both consumers and households, and of course that's going to impact the labor market. So that's when we're going to see some of the loosening up of job demand and on the wage front.
Jennifer Lee, BMO senior economist, always good to see you. We'll talk to you soon.
Thanks.
Coming up, CVS shares in focus after the company raised its full-year profit outlook. We'll break down that report, plus have the opening bell on Wall Street next. Welcome back. CVS has one of the hotter ticker pages on Yahoo Finance this morning after the company lifted its full-year profit forecast. Yahoo Finance senior healthcare reporter Anjali Kamlani has been digging into this one. Anjali, good to see you. I know you were on that earnings call. What'd you hear?
Well, like you said, really strong quarter for the company. They have a lot going on and really starting to look, of course, more than just a pharmacy as we know it to be. A lot of focus on where the company is going, looking at offloading Omnicare and really building on their acquisition of Signify. That's one big thing. As you can see, guidance up, shares up, everything looking strong. The one, of course, pressure coming from the opioid settlement. That's just one of the other things. But also, when it comes to what the company is doing, when it comes to between pharmacy and then the healthcare services, it really seems like everything is focused now on the idea that CVS wants to be a broader healthcare company, strong revenues, strong membership coming in from the pharmacy benefits manager side of the business. So that's also where we're seeing really the upside for the company.
Yeah, the pharmacy services segment, the biggest part of their business, of course, here. But they did see a hit within that retail segment there. Did they offer any color there?
That's actually pretty normal. You've been seeing that, in the past few years. That has been sort of a pain point for them. So definitely pressure there.
And you mentioned the settlement on the opioid lawsuit, and CVS wasn't the only company that participated in that. So give us some more details on that.
So what we've got is CVS joined by Walgreens and Walmart. A total of $12 billion has been established as the settlement amount. Now that is going to be paid out with CVS at $5 billion, Walgreens at $4 billion, and Walmart at $3 billion. And CVS specifically, we got more color, of course, from them this morning from the call, talking about how they're going to wait until they get the buy-in basically from the states, the cities, and the tribes that have been suing them, and that's their global decision. It depends on how many sign on, and they're waiting to get that number. They're going to be paying that total out over 10 years starting next year, and that's the way that they've sort of balanced it out, so it's not an immediate hit. Now, another really important thing that was mentioned, though, is the way that this company is looking at it. CEO Karen Lynch saying on the call that they are looking to, quote, put the decade-long issue behind them, and then later on acknowledging the pain that the settlement has caused for families around the country and the role that CVS and others have played. So they're also part of the settlement, also distributing a bunch of naloxone kits. So that's also part of the deal.
Something else I believe that analysts were going to ask about on the call, and maybe they did, maybe they didn't. If you missed it, don't worry about it. But there was a pharmacy benefit contract that I believe Centene awarded to CVS competitor Cigna instead of to CVS. Was there any commentary about that?
Just the fact that they are losing that. It's something that they hoped not to have to, but it's just, part of the business at this point.
Yeah, I guess so. They got to be competitive.
Absolutely.
Yahoo Finance's own Anjali Kamlani, thanks so much for breaking all this down for us around CVS and the settlement, too. Appreciate it. And guys, switching gears here, shares of Estee Lauder, they are lower after the company reported earnings, but despite topping estimates, the company slashed its full year 2023 net sales forecast as it now anticipates a decrease of 6 to 8%. Shares lower by about 7% right now here. And for the company and what they did report within this most recent quarter, net sales of $3.93 billion, a decline of 11% from the same period last year.
A lot of red flags in this quarter. Let's start on Asia. They're calling out weakness in Asia. Really, I think, mirrored what I heard from P&G. They own that SK2 line in China. Has been a big business for them, but that started to weaken in their most recent quarter. So Estee Lauder calling that out as well. Also calling out tightening of inventory by some retailers in the United States. Very interesting as well. Curious on what that means for an Ulta when they report in a few weeks, but also curious what it may mean for department stores. Of course, you walk into department stores, you talk about it. We're always looking for Tom Ford cologne.
Always.
You walk into these stores.
Have to go to Zara instead.
I know, you're here with a lot of cosmetics sections, so I'm wondering how the back half of these quarters played out for department stores and a lot of other players off of these Estee Lauder numbers.
That updated guidance is just dramatic, right? That now they're expecting a pretty steep decline in sales versus a gain. They also cut their earnings per share forecast, by the way. And I just want to reiterate those numbers because, again, it was pretty shocking when I saw this headline. The new forecast for the full year, $5.01 to $5.21. The earlier forecasts have been $7.11 to $7.33. We're talking about a $2 downgrade in the earnings per share forecast, which is pretty remarkable here. So that's one thing I wanted to flag. Secondly, it does feel like what we're hearing from the cosmetic companies is a little bit lumpy. In other words, some do seem to be holding up okay. So as we get more information from them, which are, which aren't, is it the department store piece that is the issue here, and the Ultas of the world are doing better? I'm curious to see how that plays out.
I am interested by the Asia, not the Asia call-out, the travel retail call-out, because we've been getting great numbers. Airbnb, sure, stock's getting digged on the results, but that was a strong quarter. All the hotels, strong quarters. Airlines, strong quarters. So I'm trying to figure out, is this a leading indicator of what might be to come this holiday season? Either way, it's not a good sign.
Or did you spend all your money on your lodging and your hotel ticket and you've got nothing left to buy on the duty free? I don't know.
Or you're buying booze at the travel center.
I mean, well, why not? It is a vacation.
Brown alcohol, right?
Well, of course,
alcohol.
Always. It's got to be. They did say in this quarter, though, fragrance and hair care, to your point, they each rose up, hard turn, I guess. They each rose double digits organically. However, you mentioned kind of travel and specifically in the Asian markets as well. Skincare most challenged by COVID-19 restrictions in China, significantly impacting the category.
Interesting. So that China thing emerging as a theme, even as we get murmurings of perhaps reopening in China, it certainly doesn't appear to be happening yet. As we set up for the opening bell this morning, just wanted to reiterate as well the ADP numbers that we got earlier that came in stronger than estimated. And yet, here we are back in the good news is bad news era for the market. So ADP showing a gain of 239,000 jobs, which is compared with the 185,000 the economists had been estimating. So again, as we talked about just a few moments ago with Jennifer Lee, doesn't give the Fed a lot of room to slow down. When you see a hot number like that, they do tend to weight more the official Bureau of Labor Statistics number that comes out on Friday. But nonetheless, if ADP is any indication, that one could be hot as well.
Yeah, the biggest segments that they saw growth or sectors that they saw growth were leisure and hospitality, 210,000 jobs added there, and then 84,000 jobs added in trade, transportation, utilities. But there were some significant offsets. Professional business services, that declined by about 14,000, and even in the goods producing manufacturing sector, that was down by about 20,000 jobs there in the quarter.
Yeah.
75 basis points. Wow, we say it like it's nothing, but this is a huge increase coming off the back of an even higher, even a similar increase. I mean, these are big increases, and we haven't seen it yet in some of these GDP numbers. But wow, I mean, we could be sitting here in the first half of next year talking about a lot different growth trajectory for this economy.
What is it going to mean for those mortgage rates, which are already above 7%? So there's the opening bell on Wall Street on this Fed day. You see there the opening bell. Yeah, apparently it's a group of tech CEOs, which private community of tech company. Oh, CFOs.
CFOs.
There we go. That's hence the F.
F suite.
The finance suite. Anyway,
catchy.
So we're looking at a lower open here this morning ahead of the Fed, but it's not seeing much change, right? Because we tend to see a little bit of treading water on Fed days as investors wait for more guidance. There's going to be, as the 75 basis points is largely baked in at this point, there's going to be more attention paid to the press conference and any kind of glimmers, hints dropped by Jay Powell and company as to what is going to happen next. So we've got a little changed open here on this morning. And I imagine we're not seeing a lot of decisiveness on the sector level either.
Yeah, sector performance getting an F on the morning thus far here. As out of the gate, it seems like we're down on about 9 of 11 S&P 500 sectors. The biggest decliner right now is the real estate sector here. You're seeing that down out of the gate by about 0.9%. However, we've got one bright spot at least here right now. You've got the materials select sector, the XLB, that's up by about 0.3%. Let's take a look at the Nasdaq here to see where we've really got the most activity, and we'll just make this equal for a hot second here just to give you a good look at the heat map here. So relatively split, but clearly more decliners than advancers here. The biggest advancer, Match, we're going to talk about them later on. And for those out there looking for love, MTCH up by about 14%. So Match getting some love on the day. Airbnb, though, as we were breaking that down by about 4.7% on the back of its most recent earnings report. And then Peloton, you're seeing them pedaling lower by about 4.2% as of right now. We'll see exactly where that continues to move as we move on throughout the rest of today here as well. But putting that back to an market view here and also taking a look at some of the mega cap tech stocks. You're taking a look at Microsoft. It's up by about 0.3%. Alphabet or Google up by about 0.3%. And then if we could take a look at some of the market caps here, look at Amazon. below $1 trillion right now.
For the first time since, what is it? It's been a long time since we had Amazon at these levels. I'm trying to remember when the last time was. And of course, Meta had fallen below $1 trillion market cap as well. And now we're seeing Amazon fall below that level. It closed below that level yesterday, and so it has not recouped it since 2020. So it hasn't been that long, but long enough.
Significant move to get above $1 trillion and maintain there for a while, but we're seeing that reverse just a little bit here on the day.
Yes, a commentary on the status and state of tech stocks right now. Speaking of tech stocks, let's check in on shares of ZoomInfo Technologies. Those shares are trading down by 26% this morning. The company did beat earnings estimates. Revenue grew 46% year over year. But the company cut its free cash flow forecast for the remainder of this year. And, you know, we've talked to Henry Schuck, the CEO of ZoomInfo, multiple times. This is a company that has prided itself on its profitability, right? And it was still profitable in the quarter. But when you cut that cash flow forecast, that causes some
this
concerns.
is not a good day for Henry. He's a friend of our show. We really enjoyed watching him as he continues to build this business. Definitely an up-and-comer in the software space. But I talked to him, I was thinking back last night too, when I talked to him at the Goldman Sachs conference in mid-September. It did sound like some of these deals that they were trying to push through, a little bit of delay, a little more scrutiny. He told us that. And now I think those comments were echoed on that conference call last night, saying some macro pressures are causing some deal delays. They are closing, just not, I think, as fast as he would have liked.
Well, of course, the companies that you're going out and trying to either upsell to or sell into as net new customers are all looking across the spends that they have or the cost structures and all of the different applications that they lean into, whether that be a Slack application or whether that be a data center spend that they have to continue to maintain. And with that, that comes down to the different services that you decide to either trim or just kind of remain at the same credence of that spending and say, you know what, we're just going to allow lesser access within the organization to this particular type of software. And I think in the larger ERP landscape, that's the decision that some of those portfolio clients are going to make, is to say, do we need as many licenses? Can we have a core kind of license holder administrator to say that, you know what, we operate with this one license amount actually, and decide not to kind of build up off that. And that's similar to what ZoomInfo is probably having to navigate through right now too.
Yeah, so indeed, not a good day for Henry.
Coming up, everyone, Yahoo Finance's Jared Blickery going to break down the latest market action as investors await the Fed decision at 2 p.m. Eastern Time. We'll break that down a little bit. Welcome back to Yahoo Finance Live, everyone. This morning, we're taking a look at U.S. major averages in the red here as everyone is sitting on the edge of their couch right now, waiting for the Fed to really unveil their policy decision at 2 p.m. later on, and we'll get commentary from Fed Chair Jay Powell. Major averages in the red. Let's get on over to the Wi-Fi Interactive, where Yahoo Finance's own Jared Blickery is standing by. Jared?
That's right. Whether you're an armchair Fed watcher on your couch or on a Barcalonger, we do have the major indices in the red, as you just said, Brad. And taking a look inside the market, all 11 sectors were in the red a few seconds ago. Utilities now in the green. Real estate taking it on the chin to the downside. Energy also off about 1%. Other than that, communication services down a little bit less. Industrials, discretionary, and healthcare rounding out the bottom here. And let's take a look at some of our sentiment indicators. Bets, that's a gambling ETF, that's in the green. So is K-Web, so are some semiconductors, probably off that AMD. And let's check out what's happening with the semiconductors recently. Now, we can see AMD up 4.5% here, Marvel up 2.5%, NVIDIA up about 2%. Not a lot of huge movement there. And we'll also check in on software, kind of the complement, and we can see a different picture. Now, software and semiconductors, both somewhat cyclical, but trading at odds as they have several times this year, or several periods this year. Also checking out our meme stocks, not a lot of love right here, and that's kind of par for the course whenever we've seen a down day. A lot of these fringier markets don't necessarily get that love. Now I want to back up a second and take a look at the bigger picture. This is the S&P 500 over the last 2 months. We are still in an uptrend here, this narrowly defined trend channel at the bottom here. Usually on Fed days, we just kind of drift around and it tends to be to the upside, not today. Taking a look at the bond market, we got the 5-year T-note yield down 2 basis points, the 10-year at 4.03%. That's down a little bit as well. And check this out. The 13-week, that is at 4.05. That is an inversion. This just happened very recently. And so I think there's going to be some focus on that later today at the presser. We'll have to see how Powell feels about the bond market and also the strong U.S. dollar index, flagging a little bit today, but really giving a lot of markets a headache recently.
Jared Blickery, thank you so much. Okay, loving this new snap from the team at Compound Capital. Twitter closed at $44.90 on its first day of trading on November 7th, 2013 at a $54.20 sale price. That's a 20.7 cumulative return, or about 2.1% annualized. The S&P 500 ETF gained 157% over the same time period, or 11.1% annualized. Coming up, why our next guest says he's remaining cautious ahead of today's Fed decision. We'll discuss next.
gotta use some too. As we've been discussing, the Fed is predicted to raise rates 75 basis points for a fourth and maybe final time today, followed by a potentially smaller hike in December. But if the Fed slows the pace of its hikes, what does that mean for investors going into 2023? Probably more importantly, what if it doesn't? Thematic Research's Chief Investment Officer Chris Versace joins us now. Chris, I was just checking the latest tally. The S&P 500 up about 7.8% from its lows earlier in mid-October. Is the market setting itself up to get burned here by maybe getting too optimistic that the Fed is closer to a pause?
So, Julie, we at Thematic have a word for that. We call it opium. And we've seen the market kind of get hit a little bit, over the last several months with hopium, trying to overread into what the Fed may be doing. And I think when you sit back, you look at the data, even the data we saw this morning with the ADP employment change report for October, the jobs number was better than expected. The year over year wage gains were, 7.7% or so, very little changed from what we saw in September. And then we backfill in with some of the other data that we've been getting, a stronger than expected GDP reading for the September quarter, the employment cost index still hot, core PCE price index still elevated. There's a lot of reasons to think that the Fed has enough cover to continue to raise rates where it's looking at. And the thing is, the market expectation, what's been helping drive the market higher, as you noted, is the note that, hey, maybe they will back off a little bit. So I do think there's room for the market to be disappointed.
Hopium and a prayer that the Fed will back off, Chris, here. So when we think about what that timeline actually looks like and how much the extent is that the market has misread the Fed, what does that look like in your perspective?
Well, look, clearly we're going to get, some insight as to what they're thinking about the December meeting, maybe what the pace of monetary policy could be in 2023. But I think at a minimum, Brad, whether or not, we see 50 or 75 in December, we still have to remember that the Fed funds rate is going to be significant, doesn't even, catch it. It's going to be up dramatically compared to where it was entering 2022. And I don't think we've seen the full impact of that yet or ripple through the economy. We have in housing because what we've seen in the mortgage arena. But, what does that mean for consumer borrowing as interest costs continue to grow higher? What does that mean in the automotive arena as auto loan costs get higher? So I do think there's more follow through, if you will. But I think candidly, the market might be leaning too much into, is it 50? Is it 75?
Chris, I know you follow a lot of sectors and a lot of stocks, and are you bullish on the metaverse as a theme? And if you are, how do you play it? I mean, look, I used to edit your stuff. I know you watch everything. Talk to me. What do you think about that sector?
So the short answer to that is no. When we took over Action Alerts Plus last year, we made the strategic decision to exit then Facebook around, I think, 3:30, something like that. And candidly, we haven't looked back. So if you're looking at it as a play on meta platforms, I don't think it's there. I'm not really sure, Brian, what they're going to do to reinvigorate the revenue line as they continue to pour money into the metaverse. But to me, this is very similar to what we saw with Second Life almost a decade ago, where there was an initial spur and then it fizzled. The question that I struggle with when it comes to the metaverse is, what is the killer app? Why will people go and continue to go in mass? And how do they drive revenue? Not just Meta, but really anybody. And I don't think it's really I don't think the answer is there yet.
Just to follow on that, with the kind of present nature of the vacuum of easy money policies, does the metaverse actually become a reality?
I think look, anytime we have these new technologies, right? And I'm going to date myself here a little bit, Brad. So back in 1999, 2000, when I was a younger man, I heard all about 3G. 3G is coming. 3G is going to revolutionize everything. And it's going to be here next year. And it took several years for 3G not only to really have the networks built, the devices there, but for the applications to emerge that really drove the incremental average revenue per user the carriers were booking. So I think we're going to see that again. And will it happen? Yes. I think like autonomous cars and everything else, the timeline is just going to be a lot longer than we originally think.
3G and Second Life. You're really taking me back here, Chris. So within technology, then, what is more attractive to you? If you're looking specifically in that, does it pay to stay more boring, for lack of a better word, right now?
Well, it's an interesting question, and I say that because over the last several months, when in the Action Alerts Plus portfolio that we run for the street, we've actually exited a number of technology companies. When we took the portfolio over, it was overinvested in technology. Again, this was about a year ago, and we've whittled that away. And the landscape, I think, is a little murky right now, to be kind. We heard what AMD said last night. Data center looks like it's holding up better. PC continues to be worse. We're hearing repeated conversations about slowing smartphone sales. So it's hard to get excited about technology. And I know some people will come out and they'll say, well, these stocks are cheap. And my reply, as Brian will probably guess, is, when I put my analyst hat on, is, well, how are they cheap when I don't really know what the E is, or I don't know what the S is in price to sales, because those numbers are coming down. So I want to like technology because it does have a lot of, disruptive and productivity plays, but I don't think we're there yet, Julie.
Chris, what about industrials then?
So industrials are an interesting way to look at it. I used to cover that back in my early days, and it's a very wide category. So you can have everything from trucks and rails to construction equipment and ag equipment. I think those latter two are a lot more interesting. Construction equipment, Caterpillar put up some great numbers with their U.S. construction business in the September quarter. We're starting to see some of the benefits flow through for demand on the Biden infrastructure law. That's why we like United Rentals, we like Vulcan Materials as well. And that thesis was really confirmed this morning by what Martin Marietta had to say. So we like those. And then on the ag equipment side, look, farmer income is killing it. And historically, when that happens, they tend to replace their equipment. We also have, if you want to talk, a little bit of technology, this real push in precision ag. Farmers are struggling with high fertilizer costs. I think that's going to accelerate that move.
Interesting. Love to talk some precision ag. We'll do it at more length another time, Chris. Thanks so much, Chris Versace. I'm not even kidding. Thematic Research Chief Investment Officer.
Thank you.
Thanks. Coming up, Sas is going to share the top things he said should terrify
I thought we went
Santa?
with worry, but okay, terrify's cool. I'll roll
Terrify
with it.
Santa.
I'll roll
We're
with it.
mashing up Halloween and
roll with
Christmas already, apparently. We'll be right back. Today is indeed Fed decision day in America, and while investors are obsessing over what the Fed says and doesn't say, the reality is that today's borrowing costs will be headed even higher after what the Fed unveils this afternoon. And that could spell bad news for retailers of all kinds this holiday season.
That's a great intro.
What a downer.
Yeah, well, it's the reality. So let's, first graphic here up in this is, we're getting more or increasing signs of a lot of consumer weakness, and it's starting to pick up. We've been talking about this past 2 weeks as these warnings have come. First, Whirlpool cut its guidance. You have Generac, the generator maker, warning about bloated inventories despite hurricane season, which theoretically should be causing more generator sales nonetheless. You have deck maker Trex, like we talked about yesterday. They're seeing sales, or they saw sales in the third quarter flat out plunge, terrible outlook. American Express, when I talked to CEO Stephen Squeri about a week and a half ago when they reported earnings, touch of caution in their full year outlook, not dire by any means, but still some red flags there. Bank of America, when I talked to Brian Moynihan, the CEO of that company, noting that card spending through October up 10%, but that was just a little bit slower rate than what they saw coming out of the third quarter. Just little red flags, but now we have a couple charts here. First off, speaking of B of A, they put out a lot of good data on card spending, and you can see really card spending among B of A customers has started to weaken a little bit during the holiday season. Now, is it falling off a map? No, of course not. But when you're trying to put the pieces together and think about how you should be investing into the holiday season or investing into next year, you have to take all these pieces and think about them.
I think consumers are also reminiscent of recessions past or economic downturns past, and in trying to take a different approach, perhaps readying their wallets, readying their credit as well to be able to sustain through a period like that, which means kind of the vacuum of some of that spending, at least in portion over time.
And it's not just, there's been a lot of focus on low-income shoppers, middle-income consumers, but look at this next chart from B of A. It shows consumer sentiment by income group. And really, this chart, I think, signifies that, the plunge in the market this year may start to impact consumer spending amongst wealthier households this holiday season. I haven't seen it within luxury goods. Maybe this Estee Lauder quarter today is a sign of what could be to come from higher income shoppers this holiday season. They'll still be out there shopping, but maybe not at the rate the market thinks.
Yeah, and that's not surprising to me because of what's happened with the market, right? In other words, the top third of incomes have the most invested in stocks, and stocks on the year have not done that well.
Yeah, and lastly, we're tracking also this comes from Citigroup, restaurant sales. Restaurant sales, again, no big falling off a cliff here, but still a steady decline. And we saw even, McDonald's had a great quarter, but their traffic to the restaurants under a little bit of pressure. We talked to Wingstop yesterday, good quarter, traffic a little bit under pressure. Dine Brands reported earnings today. I'm talking to CEO John Payton a little bit later on, but sales there were under a little pressure as well.
But it looked like the traffic was up above 2019 in that chart, no?
Yeah, I mean, relative
just now.
Yeah, relative to then, but it is not spiking and is not going up. Theoretically, you want to see these things going up. Overall, here's my take. I think you're going to see more retail blowups coming very soon. As these companies report earnings throughout November, there's Santa Claus coming out of the chimney. It will start early on next week. We'll get some results, I believe, out of Tapestry, some high-income companies, and then Walmart, Target, you name it, will report.
I mean, this is in line with what we heard from Lorraine Hutchison yesterday over at Bank of America, where she in particular was highlighting the inventory numbers, which continue to be alarming.
Well, she inspired me to do this because her comments were very on the mark.
Yeah.
On the mark. We had Santa Claus there, but it had a Grinch tenor, if you will.
Better than Sad Claus.
Oh, yeah, we should have had a green.
I don't want to be a Grinch. I just want to be happy. I just want to be happy, guys.
Well, then stop telling us things are going to be terrible. Sorry, Saz.
Coming up, we're going to break down some of the market action and more big earnings reports from Paramount, Match Group, and EA Sports. It's in the game.
I'm just going to do that too. In the game. There we go. Good stuff, Dad. Welcome back to Yahoo Finance. I'm Brian Sazzi alongside Julie Hyman and Brad Smith, and we're just a few hours away from the Fed's latest decision on interest rates. FOMC officials are seeing hiking rates by another 75 basis points. Right now, we're seeing markets really tiptoe in that Fed decision. All three major indices slightly in the red. Now, here's what else is on tap for this hour. Tuning into Paramount, Yahoo Finance's Ali Canal has some instant analysis on earnings results out of Paramount, which was also whacked by a Wells Fargo downgrade earlier in the week. And swiping the plastic, I talk with Mastercard CEO Michael Miebach on why he doesn't see a coal-filled holiday shopping season. And CEO Chatfest will also check in with the CEOs of XPO, Trivago, and Rockwell Automation to get a pulse on the global economy into year end. Brad, over to you.
All right, thanks so much. Big Fed day. We're going to get to the decision later on this afternoon, but taking a look at how the major averages are moving on today's session going into that announcement and then the press conference as well. You're seeing the Dow down by about 0.4%. Let's set the mood with some candlesticks here and take a look at some of the larger movements that have been taking place there. Also getting just another look at some of the other major averages here on the day. We'll try to get markets back later on. Oh, there they are. Okay, well, anyway, we've moved on. We're going over to sectors right now. Sectors on the day, as we had seen some major laggards throughout the early morning session. We've now seen all 11 S&P 500 sectors in negative territory, move into negative territory. Financials has also slipped into the red. That's flat, but to the downside. Take a look as well at consumer discretionary as we've been tracking that. That's down by about 0.3%. And with that in mind, I want to take a look at some of the retail names as I've been tracking those. And you've got a lot of red in retail right now. Amazon hyper waffling, Walmart down 0.5%, Home Depot down 0.4%, and take a look at the declines in Lowe's, moving lower on the day by about 1%. Also, you've got a host of others. Just to put this in broader perspective here at some of the declines on the day, you've got, of course, Bed Bath & Beyond as well. That's down by about 1% right now. Julie, over to you.
Thank you very much, Brad. And we're also watching shares of Paramount that are down about 9% after an earnings miss, as investments in its content, marketing, and international expansions bite. With a recap of the media giant's earnings and the broader streaming landscape, we've got our own Ali Canal joining us right now. So Ali, tell us about this quarter and what stands out and what happened.
Yeah, well, good morning, Julie. It's very clear investors are not too happy about this. A miss on both the top and bottom lines. As you mentioned, profits really suffered as a result of those greater investments in marketing, content, international expansion, which Paramount has been really committed to. Weak advertising revenue as well. That declined 2% in the quarter. That's a big macroeconomic challenge that the industry as a whole has been grappling with. That weighed on the company's bottom line. CEO Bob Bakish, though, he focused on the company's subscriber wins for the quarter. We did see a significant amount of growth. Paramount Plus adding 4.6 million subs for a total of 46 million. Pluto TV also seeing continued success with 72 million monthly active users. And as a whole, the company has nearly 67 million subscribers across its direct-to-consumer services. And executives said that there's more room to run here. The problem, though, that Wall Street seems to have is on the profit side. Can DTC alone save Paramount amid these linear TV challenges? We heard from Wells Fargo's Steve Cahall earlier this week. He issued a second downgrade in less than a month on the stock. He suggested that Paramount take on the role of an arms dealer, similar to what we've seen from Sony, maybe license out or sell off some of those assets. Bob Bakish was specifically asked about this strategy on the earnings call, but he said that's not really part of their vision. He's really committed to keeping ongoing content on the platform. He says that's ultimately how you deliver value. Backish also confirming that price hikes will be coming. He actually said this on our air during Yahoo Finance's All Market Summit. No timeline has been given on that, but that's something to look out for as well. Overall, though, investors really struggling to find that silver lining. Shares seem to be accelerating their losses a bit, down over 9.5%.
Ali, while we have you and we're zeroing in on the entertainment landscape, Netflix's ad-supported tier, that launching now too. Do we have a sense of where some of the conversations around where the what actual content will be on that ad tier are starting to net out?
Yeah, this is a big point of conversation right now. This ad tier launching officially in the US tomorrow. And the company did warn that about 5 to 10% of programming will not be available on this ad tier due to ongoing conversations surrounding the rights to air ads against some of this content. The Wall Street Journal confirming that those talks are still ongoing with several major studios. And that includes some big guys you're seeing on your screen now: Disney, NBC Universal, Sony Pictures, Warner Brothers Discovery, Lionsgate. Some of these studios provide original content to Netflix. Others offer reruns, license their content. And we're talking about some pretty big shows here: Grey's Anatomy, The Crown, You. So it's very important that Netflix can get this right. Experts that I've spoken with have said advertising is the future for this company as it competes for subscribers and the revenue that comes along with that. We have Disney's ad tier coming out next month. Many players in this space already. So Netflix really trying to take a bite out of that market share. But in order to do that, you have to have the content of both the user side and the advertising side. So this is something that we will have to watch very closely as this ad tier rolls out.
All right, nobody let Penn Badgley know that he might not be on the ad-supported tier. He might get upset. We know what happens then. Thanks so much, Ali Canal. We appreciate it. Switching gears, everyone, investors saying it's a match as dating app specialist Match Group reported an earnings beat. The company, which owns popular services including Tinder, Hinge, and Match.com, saw a boost in users and subscriptions in Tinder. That's even as a widening or a weakening global economy threatens some of the spending here, particularly from its lower income consumers. But this is notable, especially given how the reopening would certainly thrust a lot of attention towards people who were just looking to get back out. And year over year, that was the construct. How much of the reopening in 2021 in Q3 back then would actually protrude or permeate over into 2022 and remain kind of this normalized level?
I guess the only thing I can really add here is love is not recession proof. I mean, really, if you've lost a job recently, you don't have money to go spend $200 on a day night. That's how I read this quarter.
Yeah, I mean, so the company last quarter was not great, right, in terms of the earnings in particular. And so this reminds me oddly of Intel a little bit, where basically the company comes out and says, we're going to be disciplined on headcount. We're going to be disciplined on expenses. And that seems to be, in this environment, what the street wants to hear. These reassurances that these companies are reading the room, so to speak, and that they understand that we're going into a tricky time. So that seems to be the sort of big picture here of why Match is reacting so well to this report. You wouldn't think that Intel and Match would have much in common, but that's the theme I see, at least.
No, I don't think Tinder, I think there was weakness throughout this report. I think they highlighted that really through and through. They lost customers in some parts of the business.
Well, for Match, for Bumble, all of them are trying to build up the amount of revenue that they're seeing on each individual user by offering some of the incremental kind of add-on costs, whether that's being able to move yourself to the top of somebody's queue, whether that's being able to say, just send somebody a gift through the platform, which to me is a little creepy. But if that's your
10 things you should not do. X.
Jesus. Yeah, I mean, the paying users here is what it's going to continue to come down to, where they're seeing that paying user kind of increase. And I think it's really going to come back to, as well, the amount of word-of-mouth marketing that actually takes place among those paying users. Because if some paying users are saying, you know what, at the end of the day, this is not really working for me anyway, then you could see a deceleration there.
I mean, there's also some internal stuff going on. There's no permanent CEO for Tinder right now. The CEO of that group left earlier in the year, and they have not replaced them. And so this is something that they need to work on as well. So they're seeing the revenue strength. They're seeing still paying users keep up. But it's this sort of preparing for maybe things that are not going to be so rosy coming down the pike.
Indeed. All right, we're also watching Electronic Arts shares. They're on the move. The video game maker is still confident that consumers will keep gaming despite economic headwinds. For more, our tech editor Dan Halley joins us. Dan, I think a lot of anticipation for Electronic Arts, I'm sure, ahead of the World Cup. They talked a little bit about this on the earnings call last night.
Yeah, so let's just go over the numbers real quick. They had missed on earnings per share and revenue, and they had seen net bookings that were 1.75 billion. That's compared with 1.85 billion in the year ago quarter. That is to kind of be expected after this huge explosion that we saw in the gaming industry throughout the pandemic. So there's going to be a drop. The bigger issue here, I think, for them is what they're expecting for the full fiscal year. And they revised those numbers downward. They think that they're going to get between 2.79 and 2.8 billion. The expected revenue was supposed to be 7.6 billion to 7.8 billion. That's down 50 million from what they had previously said. And then total bookings, they're expecting between 7.65 and 7.85 billion. That's down from the 7.9 and 8.1 billion. So they're expecting less spending. They're saying that that's a mix of things, including the currency headwinds, as well as people may be pulling back. They did, yes, with the World Cup. They had their largest launch ever for FIFA as far as FIFA 23 goes. They said they had 10.3 million players in its first week, which is absolutely huge. They also have other franchises that are continuing to play. There's Apex Legends. People still like that. They did have their latest Battlefield title come out, which was, an absolute stinker. I mean, it just was not good. It was broken right out of the gate. And they're trying to fix that, and you feel bad for the developers that put time into that. But, I mean, that's just not going anywhere. And then, going forward, they do have some titles coming out. They have It Takes Two coming out for the Nintendo Switch. That's more of like a, friendly, like, my wife and I would play. It's not something that's going to really drive sales. They have a new Need for Speed game coming out in December. Not going to be absolutely massive. They have a remake of the game Dead Space, but that's coming in January. So, there's some big games. Then you start going further into 2023, and there's more titles there. There's a new Star Wars game that tends to do well for them. But there's nothing that I'm really seeing on their upcoming games that really just is going to knock my socks off. I think they're a company that they're so heavily reliant on their sports section. And look, people buy Madden every year, and I don't know why.
It's a great game.
I'm just confused why the stock is up.
I think
the numbers weren't that exciting.
The mobile numbers seem to be pretty good.
Yeah, but the forecasts are kind of meh. Yeah. I don't know.
I think it's that the mobile numbers aren't as bad as they could have been. Competition as far as games this holiday season is going to be kind of light. The big one coming out is the new God of War game. That's a PlayStation exclusive, though, so it's not, going to hit on Xbox or anything anytime soon. But, it probably is having to do with the mobile aspect, and then, it's not as bad as they thought it could be. But, like I said, nothing really here that's going to knock my socks off as far as upcoming titles. It's just, Activision Blizzard still has a lot. Take-Two still has, look, Grand Theft Auto 5 is 8 million years old, and it's still printing money for them. So,
as you were running through the reception of some of those core titles, that many of them being household names, I was looking at some data that came out yesterday. Call of Duty Modern Warfare 2 has become the #1 selling opening weekend ever in the franchise. $800 million through the first 3 days from its release on October 28th. With that in mind, what do we expect of this particular holiday season, as we were just breaking down, where the consumers might be starting to pull back in some spending categories? Is that the same in gaming as well?
I think gaming, there's always talk about, is it, obviously everything, there's talk about, is it recession proof? I think with gaming in particular, the titles may be less, apt to suffer the, actual game sales. They are $60, so maybe people won't be buying as often, but there are sales, that are just bonkers now. You wait a month after a title comes out and it goes from $70 to $20. So, sure, that means that the companies aren't, doing as well on margin there, but it does mean that the sales are going through. And then the bigger thing is what they have to offer as far as online play. And then that's where your net bookings come in, and that'll start to really blow up for people. I think for, Activision Blizzard and Call of Duty, that's another title that just prints money for them. And they're going to have their online game they have the multiplayer aspect going on, but then they're going to have Modern Warzone 2, which really blew up at the height of the pandemic, or at the onset of the pandemic. This is the sequel to that. I still play it every Friday, get a couple of White Claws and play with my friends. I'm going to keep doing that.
Yes.
So I'll be on there as well. But I think there are some titles that are going to continue to do well. Really, for a lot of companies, they look at the online games and they say, this is a continuing revenue stream. They look at the single player games and they say, it's not really going to do as well. But then, honestly, on balance, you can look at some of these single player games and say, oh, they blew everyone else out of the water. So I'm looking at, God of War Ragnarok and thinking that could be one of those games. So
link up with me on Xbox, Dan. We can play some NBA Jam. I'm really good at that
game.
game.
Oh, baby,
I'm
I've
very
won
good at that game.
SNES.
We're always on fire. That's what we do.
Ooh.
You're the man, gaming expert Dan Halley. Okay, before we go to break, we're watching shares of Disney off Paramount's really less than expected earnings. Macquarie's Tim Nolan is out reiterating an outperform rating on the stock ahead of Disney's November 8th earnings. Nolan thinks Disney Plus is poised to show continued upside in new subscriber additions and slowing operating losses. But he does voice a good bit of caution on the outlook for Disney's theme parks, where attendance could be hit in 2023 if the U.S. economy slips into a recession. Coming up, Dollar General faces a lawsuit from Ohio. Julie is back with that, plus a look at more of today's top headlines. That's next.
Here's a check on some of the other headlines that we are watching. Starting overseas, China locking down the area around the world's largest iPhone factory for 7 days due to a COVID outbreak. This move likely to cause further disruptions in operations for Apple supplier Foxconn, and then potentially spelling bad news for Apple ahead of the holiday season. Foxconn said in a statement the plant will continue operating within a, quote, closed loop or self-contained bubble that limits contact with the outside world. There were reports, remember, over the weekend about workers fleeing the factory because of concerns that they would be then stuck there. Chemical maker DuPont terminating its $5.2 billion buyout of Rogers Corporation as a result of the company's being unable to obtain timely clearance from all required regulators. DuPont said all parties had received regulatory approvals for the merger except from that of China's State Administrator for Market Regulation. Shares of engineering materials maker Rogers are plunging as this deal is going away. DuPont, though, is trading higher. Analysts were positive after this deal got canceled. In a statement, Rogers said it is evaluating all options in response to DuPont's notice. And Dollar General hit with a lawsuit as Ohio sues the U.S. discount retailer due to several complaints regarding overcharges. These complaints come as testing last month found $20 general stores with significant pricing errors. The lawsuit seeks civil fines of $25,000 per violation, payment of actual damages to consumers, and a permanent injunction against further violations. Sas?
Rockwell Automation shares down here after the company saw higher earnings and sales in the fourth quarter and issued a fiscal 2023 growth forecast. Let's bring in Rockwell Automation Chairman and CEO Blake Moret for more on this. Blake, always good to see you. Top of your earnings release, you note that organic sales in the fourth quarter up 20.5%. That's a very big gain against a backdrop of a slowing economy. Where are those sales coming from?
So we saw great sales in the fourth quarter. It was broad-based. We serve a wide variety of industrial markets, from automotive, which had a very good quarter, semiconductor, as we're participating in the build-out of capacity there, oil and gas, renewable energy with solar energy, food and beverage, pharmaceutical. So really broad-based across the spectrum.
With that kind of broad-based results that you have seen, where do you kind of look across the business and really identify where there is perhaps even still cost management that needs to take place at this point in time?
Well, productivity is always a part of what we're doing, even in a time like this when we're seeing double-digit growth. We saw, as you said, double-digit growth in the last fiscal year, particularly strong in the fourth quarter. And as we go forward into our fiscal year 23, double-digit growth again, with strong earnings growth as well. Productivity for us and for our customers always remains in style. A big part of our value proposition is increased efficiency in all of these industries, as well as helping them launch new lines of business. And we look inward and look for ways to be efficient ourselves.
Blake, I'm trying to figure out why your shares are down, frankly. And I don't know if it was the midpoint of the profit forecast, maybe being a little light of what analysts were predicting, but I also see your free cash flow was lower than some of the folks on the street were predicting at about $358 million. Can you talk to us about your cash position and how you guys are spending and or saving right now?
Sure. We're traditionally a very strong converter of free cash flow. And one of the things that we see in an environment like this is an increase in our inventory, particularly components, work in process, as we're managing through the supply chain constraints, bringing in largely semiconductor chips. They're arriving at different times. And so we're making sure that we're bringing in that inventory so that when that last chip arrives, then we're able to get products out the door and improve the customer service and reduce lead times to customers. The downside of that is that higher inventory is reflected in higher working capital, which has a negative impact on free cash flow.
Blake, I mentioned before your organic sales in the fourth quarter you just completed up 20.5%, but your outlook for the next 12 months, you see organic sales up 9% to 13%. How has this current quarter started?
Current quarter has started in line with our expectations. So our quarter began October 1, and so far the quarter in terms of orders and shipments is developing in line with expectations. I want to also mention, in an environment like this, there's continued volatility. While we expect a gradual improvement in the supply chain and specifically around semiconductor availability for the types of node technologies that we use, we still believe a conservative approach is appropriate as we introduce guide for the year.
I'm also curious about whether a conservative approach is warranted on things like headcount. I noticed in the statement you talked about that you're committed to investing in attracting and retaining key talent. How are you thinking about workforce and headcount right now? Are you sort of holding the line on numbers, but still focused on getting the best people in there? How does that work?
Well, we always focus on getting the best people
Sure.
in, and obviously making sure that we're an attractive destination for talent in all ways. And compensation is certainly a part of that. Increased amounts of equity as a part of total rewards, and all the other things that make Rockwell a great place to work. And with a continued low unemployment, then we recognize that talent, especially in some of the most high demand jobs, have a lot of choices. And it's a fundamental part of our culture to consider all the other choices that an employee, like a customer, can go, and to make sure that we match up really well.
Blake, good to see you. Blake Moret is Rockwell Automation CEO. Thanks so much.
Thank you.
Coming up, XPO has officially launched its spinoff RXO. We're going to speak to the new CEO of XPO. That's coming up next. XPO, now an independent company after spinning off its truckload brokerage business, RXO. And also, we've got a new CEO for XPO. That's Mario Herrick, and he is joining us now. Mario, full disclosure, you and I chatted a little bit last night at a reception at the NYSE following the formal spinoff here. And we, of course, have talked to Brad Jacobs, who is now stepping down as the CEO of the company, about the rationale behind what's going on. But just to take a step back, we have talked so much about the broader economic landscape. We've talked a lot about the buildup that we've seen in inventories in a lot of industries. What are you guys seeing across the country in terms of the flows of goods?
Julie, it was great seeing you, and thanks for having me on. So we are seeing a softer macro this year than what we saw last year, and we're hearing mixed feedback from our customers. Today, our less than truckload business is 2/3 industrial companies. And we're seeing some of these companies having more product flow through their supply chain, so they're ending up shipping more product, while others are seeing softer demand. And on the retail side, it's similar feedback. Now, this said, you wouldn't see it in our numbers. We delivered a great third quarter where we delivered record EBITDA. We grew and in our LTL business, we delivered record revenue and record EBITDA. And we're seeing an acceleration of tonnage where we flipped, which is a measure of volume, where we flipped to positive on a year-on-year basis in September, and we expect to be positive on volume in the fourth quarter as well.
Just given this backdrop, Mario, how are you investing in the business? Have you pulled back at all?
We are planning for our less than truckload business. We are continuing to plan to invest more into the business. Over the last year, we pivoted to the next phase of our LTL business. We call it LTL 2.0, which is based on capitalizing on the high return on invested capital into our less than truckload business. So we're opening up more terminals. We're adding more trailers to our fleets. We're adding more trucks. And we're seeing the success of doing so. Again, we accelerated our tonnage trends where we buck typical seasonality. And we are also bucking industry trends in terms of gaining market share as well.
In those tonnage trends, is there anything that says to you that there is a spending pullback among some of the most notable consumers that you're caring for?
So today, again, our business is 2/3 industrial companies, and call it 20-25% are e-commerce and or retail type companies. We are seeing some customers slowing down, where the consumer, for example, is buying less. But we are also seeing some retail companies having to turn through inventory to have the right type of product in their supply chain. And in that case, they are shipping more product. For the industrial companies, again, a lot of these companies through COVID had pent up demand, where now they are being able to get the product they need to fulfill open purchase orders. And that's leading to more demand, while others are seeing softer demand. So currently, it's a very mixed environment. And generally, the macro is softer than where it was a year ago and where it was earlier in the year. But using our own company-specific initiatives, we are being able to go out and gain market share by focusing on delivering great service for the customer and having capacity in our network to gain that business.
Mario, what's happening on the trucker front these days? You know, we heard a lot about the trucker shortage that even before the pandemic, right? This was something that was pretty acute in the industry. What's the status and in the industry more broadly, and then for XPO specifically?
The driver shortage obviously is not new to our industry, and it's something that did accelerate through the pandemic. Now, things are getting easier where we are now than where we were earlier in the year. Just to give you an example, in the third quarter, we saw an increase in applications per posted rec go up by 58% on a year-on-year basis. But there as well, we have a company-specific initiative that I'm very proud of that helps us counter the driver shortage. We operate our own driver schools out of 130 locations. And this year, we are on track to graduate more than 1,700 drivers to join our rank. And it's a great career opportunity for people who join our company as dock workers, and they can actually become a driver where they can make more wages and have a great career with us over the years to come.
Mario, you're following big footsteps and a big personality in Brad Jacobs. I'm convinced he's off camera there, but maybe he's not. What should investors know about you? Tell us a little about your story.
You got it. So my background is in technology. I initially, this is where my education was. Went to MIT for my engineering degrees. And since then, I used to be in the tech sector for a while, but been with XPO for the last 11 years. I was Brad's third hire on the team back in 2011. And I've been part of every decision we've made. And I've learned a ton from Brad over those 11 years. And I look forward now to this next chapter of being CEO, and look forward to the next chapter of our company that we're very excited about moving forward.
You know, in that extensive kind of work history, where do you think about some of the parallels that we've seen in previous economic downturns and how you intend to lead XPO through what is the impending or anticipated next downturn?
Well, we are modeling for different scenarios for next year, depending on if the macro further softens from here or if things do get better as well. Now, in our LTL business, it's a business that has a high moat associated with it, where you haven't had the big competitors go into less than truckload in 30 to 40 years. And that leads to strong pricing dynamics where obviously price stays positive in our industry. Even in a soft market, we anticipate still having pricing power to our customers. The second area is managing variable cost. Is that if the macro does soften, today 75% of our costs are variable based on the volume that we are moving through our network. So we would anticipate to work both the efficiency angle and leveraging our technology as well to make sure that we are managing that variable cost to the volume we're seeing in the environment. But again, our intent though is to gain market share, and we're bucking typical trends and we're bucking industry trends in terms of being able to gain more market share from our customers.
Well, good luck this holiday season. Good luck on your CEO journey. Looking forward to staying in touch. XPO CEO Mario Harik. We'll talk to you soon.
Thanks so much.
Coming up, Mastercard CEO is weighing in on the recession debate. We'll have our chat with him next. Mastercard CEO Michael Miebach weighing in on the outlook for consumers with recession fears swelling, also talking to us about inflation. Take a listen.
Well, you're not talking to the economic oracle, so I don't really know what is going to happen in the future. What I can tell you is through the lens of our business, and we do see a good chunk of consumer spending and of business spending, is that there is inflation in the numbers, so prices have gone up. But we also see, this is the more interesting story that I think is the consumers continue to spend. There is resilience in consumer spending in pretty much every part of the world. There is changes, though, in what people spend on. We just talked about the shift to the services economy, but depending on different segments within the spectrum of consumers, there is more shift to maybe necessities, so less discretionary spend, so you spend more on food versus back to travel.
Yeah.
That is at different ends of the spectrum. That could be is a trend that we're seeing. So the what somewhat changing, the absolute level not changing. We see that in Europe, we see it in the United States, we see it really in every part of the world.
Do you think that momentum continues into the holidays?
Again, back to predictions, hard to see where it's going to go. So far, we don't see any near-term changes in consumer overall spending levels. The continuation of these shifts into experiences vis-a-vis goods, I think that will continue.
Are you confident in saying that we're just not going to have a recession? You don't see any red flags in your numbers that would give you cause?
Currently, based on the data that we have, which is all past, it already happened, there is no such indication. Consumer is resilient. That resilience will last to, we have not any indication that there's a near-term recession. So we said, well, certainly we don't see it this year, but who knows? It's too early to talk about 2023.
What will MasterCard's role be in the future of crypto?
Brian, earlier we were saying whatever choices people take in payments. So some people want to invest in crypto assets, for example. So, buy any cryptocurrency. And we want to make that as easy and, more importantly, as safe as any other payment that people effect with MasterCard. So I buy a good and it's not really living up to what it is. You can basically reverse that, charge back that particular payment. And when it comes to crypto, same expectations and aspirations on safety, security, regulatory compliance. So we want to make it easy and we want to make it safe. And that's how we've been engaging a whole set of partnerships with crypto exchanges. So I can buy crypto easily through my card and I can pay out from my crypto wallet using a MasterCard send solution, which is basically a push payment back into my card or wherever it goes. So making that very straightforward. You look at other aspects of the crypto economy. The overall question of where's regulation going, regulatory compliance and things like that. We have a whole set of services that we deploy to make the ecosystem safe. So exchanges, banks, and everybody else who wants to play in the space, in the end, they all have needs that are pretty common on safety, security, so we fulfill those. And finally, there's a lot of talk out there on central bank digital currencies, which is yet another angle of the crypto economy, where we advise and work with governments and we provide testing facilities. You want to create the digital sand dollar. The government of Bahamas has done that, and they partner with us to try it out and see how that works. So we cover the whole spectrum of the crypto economy, really from the simple starting point. It's an interesting technology. People have interest in that. There's problems to solve. Payments isn't as efficient as it could be everywhere in the world.
I have this full interview with Michael now on the Yahoo Finance homepage with the nifty 350-word article that I wrote up. But also worth noting as well, not in this particular clip, he said they're already in the buy now, pay later space. And he said it pretty matter of fact, which got me wondering, well, what does that mean for a firm in Klarna if a company like MasterCard is in here and perhaps going to get in here even more?
What's that mean for a Block and an Afterpay, who are also looking at more consumers leaning into the ability to pay in different segments for a purchase that they can make today, instantly? And, where does that even kind of have a bigger type of role in the broader kind of credit annexation that consumers have right now, especially going into the holiday season?
Well, and even more broadly beyond buy now, pay later, a lot of the giant legacy financial firms are already fintechs, so to speak. They're in a lot of those same businesses, right? Maybe they're not as small and nimble. Maybe they're not as known by the public for doing that. Well, most of them do it, but I don't know what that means for the sort of longer-term competitive landscape.
But by and large, American Express, Mastercard, very good quarters, not just in the U.S., even overseas too as well. Pretty good.
Yeah, absolutely. Guys, coming up, speaking of the holidays, holiday travel season is upon us. We're going to speak with the CEO of Trivago on the back of that company's earnings report. That's next. Shares of Trivago are going on quite the trip today, up 16% after seeing revenue in the third quarter rise 33% year over year, but warned that high interest rates and inflation will continue to impact consumer spending. Trivago CEO Axel Hefer joins us now. Axel, always a pleasure to speak with you on the back of earnings here. Look, let's dive into some of the results here and some of the trends that you're seeing. If there's one catalyst that really sticks out to you from the quarter, what would you pinpoint?
I mean, the quarter showed very strong demand as we expected. People want to travel, and it's a basic need from our perspective, and also what we've seen in the pandemic. And you've seen that the demand was very strong, prices were strong, and that is obviously a good combination for us as we compare prices.
And break it down for us a little bit, Axel, where you are seeing demand both geographically and in what kind of travel.
So the Western markets were strongest. In Asia, it's obviously very, very different market by market, but generally speaking, the recovery has not been as strong as in Europe and in Americas. Kind of travel, I mean, a bit all over the place. So our top destination worldwide is London, so the big metropolitan attractive cities. But then you've also seen in the US a lot of demand for Orlando, for Anaheim, so for the Disneyland trips, family trips. Beaches were very popular. So really, I would say, very, very broad demand, and all the trips that you couldn't do during the pandemic, people wanted to do now.
Axel, Brian Chesky over at Airbnb talked a lot about on his earnings call last night, a little bit of little bit of slowdown in the holiday quarter. Are you seeing that?
No, I mean the third quarter was very strong for us. I mean, what we are seeing right now that there are first signs of a change in consumer behavior, which is exactly what you would expect. I mean, the inflation is hitting consumers pretty much everywhere in the Western world, and what we expect for next year, and we see early signs of that, are basically three things. One is that people are reducing their length of stay, so trying to save some money by staying for one day less. And there we see some early signs in Europe in particular. You do expect people to actually go to different destinations where either transportation is cheaper or the destination overall is cheaper. And again, we start to see that in particular in Europe. For example, Morocco is becoming more popular, which is it's a very attractive destination, but usually not on top of everybody's list. And then the last thing is that that you expect people obviously to compare prices more if things are getting more expensive, and that's exactly what we do. And we also see there an increase in activity.
What are the types of stays that you're seeing people lean into, especially as they are comparing prices, and where potentially are they beginning to push back on some of those prices?
Yeah, I mean the types of trips, the top destinations are actually still very similar. As I said, I mean, London worldwide, in the US, New York is actually on top of the list. But we do see that people start to move away from the top and most expensive destinations to more secondary destinations to still have a good break and to take some time off without sacrificing on the experience, but saving some money.
Axel, we're trying to just tie a lot of pieces of the economic puzzle together. So we had Estee Lauder, our earnings this morning, noting a slowdown in travel retail and specifically called out Asia. What are you seeing in your business in terms of international travels to the US and then also in Asia specifically?
Yeah, Asia is very difficult to comment on because the situation in Asia is very different market by market. I mean, generally speaking, we see some recovery, but very different. Japan, for example, we've seen a strong increase in Q3, but it's difficult to comment in general. Overall, the US is obviously in a specific situation given the strength of the dollar. So traveling from the US to Europe in particular got a lot cheaper. And so we see a lot more demand from US travelers for the top and most attractive European cities like London, Paris, Rome, etc. The other way around obviously got a lot more expensive, and you can also see that.
We've had some CEOs classify this as the golden age of travel, that coming from the Hilton CEO, while we heard from Airbnb last night that for cross-border travel, the return would be choppy moving forward from here. You know, from your purview, is it more choppy than it is kind of golden at this point in time, especially looking across some of the international destinations that you were just mentioning a moment ago?
I mean, it's difficult to say. To be honest, I think my view is somewhere in the middle. It's I do think that people will continue to travel, and I do think that the spending for traveling next year will be up from this year. On the other hand, I also do expect travelers to cut back on the nights that they stay in hotels to save some money and to compensate for the inflation that you have on travel costs. So yeah, not a bad market. I mean, the market will be up next year, but not a golden market either.
Not a bad move in the stock price here today in reaction to earnings here. We've seen them moving higher and holding on to some sharp gains as the rest of the market is waiting for the Fed. We're appreciative of the time as always. Trivago CEO Axel Hefer. Axel, thanks so much. Guys, coming up, we're going to do a deeper dive into some more earnings reports. We've got Yum Brands, Canada Goose, and Tupperware brands. Yoicks. Coming up next. It is time for Cut for Time. You hear the song, you know it. Today we focus on 3 earnings, 1 minute each. Let's put a minute on the clock for shares of Yum Brands following third quarter earnings report that saw the company miss on profits but beat on revenue estimates as same-store sales increased 5% worldwide. You did see, though, a net change lower to the downside in operating income there, and significantly so year over year, a decline of about 62.7%.
My instinct is I really want to lock in on this Taco Bell result. Same-store sales up 6%. Recessions are made for Taco Bell, but I have to call out Pizza Hut. Same-store sales up 1%, and this just continues to be a persistent problem brand for this company, Yum Brands. They need to fix it. Unclear what the solution would be to get those sales back up at Pizza Hut, but they have a key investor day in December, so they perhaps may share a little bit more of a strategy.
KFC was the big outperformer here, up 7% comps. I will say Pizza Hut, while it was only up 1%, beat estimates, and Taco Bell missed estimates, even though it was up 6%.
Oh,
I want to correct myself. In all of the different tabs I have open, I was actually looking at the wrong earnings report. Their operating profit, GAAP basis, grew 4%, and then the core operating profit up 8% there. So I was giving actually a deep tease to our next company, Canada Goose.
All right.
All right, there we go. Shares of Canada Goose. Well, they're down, I'm told. After the cold weather, Apparel posted an earnings beat for the second quarter, but slashed Q3 and full year guidance as they expect COVID-19 restriction in China to continue negatively impacting performance. Not a bad quarter for Canada Goose, just going through it, I think really took me back to when I talked to Daniel Reese over at the Goldman conference a couple weeks ago. Demand seems to be good. China appears to be the weak point, though. Also, inventory, no big builds there. So not a hugely big red flag, but I mean, it's squishy.
I don't know. This is not what you want to hear from the CFO, Jonathan Sinclair, telling analysts it is extremely challenging to project the bulk of the year's trading based on merely a few weeks of visibility, but recent events impacting trends are not supportive of our original outlook. Not supportive of our original outlook. That's not what you want to hear.
I mean, far less people are going to have the money at least to spend. And because Canada Goose had been trying to get more into kind of the average consumer, even though it's a very pricey product, the affluent consumer continues to kind of attract towards that. But there are new kind of trendier fashion jackets, coats, outerwear that is taking on more of that market share that Canada Goose once held on to strongly. However, I will say I've never been so confident turning a corner in New York City during a winter.
Same here. I love don't let me hanging. I love my Canada
How
Goose.
confident are you when you put your food, your leftovers in a container and you close it up? No, that was a bad transition.
Wow.
Shares of Tupperware brands are plunging. They are off by 43% today. Big earnings miss for TUP on both the top and bottom lines. The company reporting a 20% drop in sales compared with last year here, and just getting destroyed in terms of the shares here. It's pretty amazing. The company says it's going to take additional restructuring actions in the fourth quarter, as well as implementing stringent inventory reduction programs. Yeah, I bet.
Yeah, and look, we just heard a couple weeks ago, we got a warning from Newell Brands too as well, so perhaps this shouldn't have come as a shocker, but really I would say shame on Tupperware. They came out a couple weeks ago and really I think hyped up this new development where they're going to sell products outside of their Tupperware infrastructure into Target, and the stock reacted favorably. But now they're coming out here a couple weeks later and really just reporting a really, really ugly quarter.
Right, and that's the expansion of the Tupperware ecosystem that they were talking about in this earnings release. But the company is going to continue to really kind of move forward with this turnaround plan, but the investors are upset that the turnaround plan is not paying dividends as quickly as they would have hoped.
My mom used to sell Tupperware. I know she's watching. I remember you sold Tupperware, Mom.
I mean, how much plastic crap do we have have in our houses. Like, how much more do you need? So
she doesn't sell it anymore, just to be clear. She doesn't sell Tupperware.
I've also ordered.
No, I didn't think I was insulting your mother.
Okay.
I hoped I wasn't insulting
not at
your
all.
mother.
I mean,
I've also ordered enough from Caviar and DoorDash at this point that I just kind of keep the
You
containers.
keep the containers, of course. You don't need to
Yeah.
buy anything. Let's take a look at markets before we leave you here, as we are still waiting for the Fed. Can't forget about that. We still have a little bit of a downdraft in markets here with the Nasdaq leading declines off 0.5%. Coming up, Jared Blickery is going to do a deeper dive into Airbnb's third quarter earnings with Needham's Bernie McTernan. You don't want to miss that. Keep it here.
Welcome to Yahoo Finance Live. It's 11 a.m. in New York City. I'm Jared Blickery in for Akiko Fujita, and here's what I'm watching today. Focus on the Fed. The big rate decision is just 3 hours away. Expectations are for a 75 basis point hike. Investors are going to be parsing and dissecting every line, and that it would be from Chairman Jay Powell's presser, all to divine clues as to the future of U.S. monetary policy. And it is an earnings parade on Wall Street as investors digesting earnings from Estee Lauder, Yum Brands, Paramount, and Airbnb. We're going to break down the numbers and stock movements for you. And finally, luxury profits. The CEO of Bentley Motors tells us what drove profits to record highs this year. Praz Subramanian joins us for the interview. But first, we want to take a look at where stocks are trading right now. It's a down day on Wall Street. Dow's down about 83 basis points. The S&P 500, the Nasdaq, each off about 0.5%. And taking a look at the bond market, the yield curve has shifted lower. And this is all on the heels of that big Fed decision that we are expecting later today. And for that, we want to stick with this and bring in Yahoo Finance's Jennifer Schonberger, who's standing on the scene over at the Fed in D.C. Can't wait. What is on deck today, Jennifer?
Good morning, Jared. Fed officials meeting right now in this building behind me, discussing the economy, discussing inflation. They are widely expected to raise short-term rates by another 0.75 percentage point when they conclude their policy meeting this afternoon at 2 p.m. That would bring the Fed funds rate up to a range of 3.75% to 4%, up from the current range of 3 to 3.25. That would mark the fourth straight 75 basis point rate hike since June. An unprecedented move by the Federal Reserve since it started explicitly targeting the Fed funds rate back in the late 1980s. But it will be what Fed Chair Powell says during his press conference on the pace of forthcoming rate hikes that markets will be most attuned to. Investors expect that the Fed will signal that it will slow down the pace of forthcoming rate hikes starting in its December meeting. A few Fed officials have talked about the notion of stepping down the pace of rate hikes. The Fed wants to tame inflation while also towing the line between not crashing the economy and taking into account that monetary policy filters through the economy with a lag. So while the Fed may taper the pace, an open question remains how much higher they could raise rates and whether they stick with their current forecast. If inflation remains sticky. Right now, the Fed expects to raise rates to 4.6% on average next year. Of course, all of this contingent on forthcoming data, specifically inflation. We will get more from Fed Chair Powell during his press conference at 2:30 this afternoon. Jared?
And Jennifer, that's what I want to focus on, because all the traders, both humans and artificial intelligence, high-frequency trading algorithms, going to focus on Powell's tone there and how that's conveyed. Because we know with Jackson Hole, he was very short, brief, saying we're going to hike until this breaks or something along those lines. And then it seems like some dovish expectations have creeped back into the market with some talk about standing down. So what are traders expecting here?
Yeah, Jared, I think that Chair Powell is going to have to toe the line, as I just mentioned. He's still going to have to talk tough on inflation because it is still sticky. If you look at the core inflation rates, whether it's CPI or PCE, the Fed's preferred measure, but he's going to have to talk tough on inflation while also saying that they're going to take into account that they're not going to crash this economy. Now, he has said that pain is going to be involved here. So maybe the question is, do they accept a shallow recession? And is that why they may be signaling that it's time to start soon stepping down the pace of rate hikes? In other words, you step down the pace, you ease the pressure on the economy, but maybe that also means the Fed funds rate has to go higher eventually if inflation remains sticky.
Yeah, we're going to sort it all out in a few hours, and we know you're going to be standing by for that. Thank you, Yahoo Finance. This is Jennifer Schonberger. And now we're going to take a look at the broader markets and investors as we await the Fed's rate decision. And for that, we have Porsche Capital Management owner Michelle Connell here. And Michelle, great to see you here today. Let me just get your overview of what you're expecting in terms of fireworks, or maybe no fireworks in a few hours.
Jared, I'm probably in the same camp as everyone else, and I'm going to reiterate what Jennifer just said. I think the Fed comes out with a 75-point rate hike, and they remain conservative going forward, and they keep a stern tone towards inflation. But that being said, we're seeing some areas of weakness in some pricing, shipping, imports that are used by consumers and producers. So I think maybe sooner versus later, they'll kind of slow down the pace of increases.
Well, and then let me ask for your market reaction here. We have seasonality. The best 6 months of the year, historically speaking, is upon us here, starting with November, the end of October there. That is well understood in the markets. But more than that, there are a lot of idiosyncratic factors going on. What sectors in terms of equities do you like? What broad movements would you expect in terms of risk metrics going forward?
Well, I think because we're at the midterm election cycle, and I'm going to couple that with what you just said about where we are in the cycle. In a midterm election afterwards, between November, the end of November and April, you typically see an upswing in the market or an increase of about 14%. That being said, maybe that doesn't happen. But what gives me some solace here is that even though the last month was pretty strong for the S&P and for the Russell, we still have 50% of the publicly traded stocks that are down 50% year to date. So this is becoming a stock picker's market.
Well, and let me ask you about some of those sectors you may like. Tech really has taken it on the nose. I mean, most things besides energy are down considerably, but especially tech. Anything in there or any other sectors you're liking right now?
I still like the chip sector. I started off as a semiconductor analyst back in the day, was a little bit early on that, but you're still seeing strong demand for an NVIDIA, and I think AMD posted strong earnings. I like the data centers and the storage. And I also think Tesla has a chance. And going back to the storage area, I think Snowflake looks interesting. All three stocks that I named are down 50% year to date. But I'm not just looking at technology. There's still some good names in energy, even though energy's been the best performing sector. Shell looks really interesting. They had great earnings. They're trading at a deep discount versus their peers, about 50%, strong dividend. I like some of the industrials. Deere, I look at that kind of as a technology innovation play because they're so strong on their software and being able to maximize the acreage that are used. And that also plays a strong dividend. So it's not just one sector, but it's finding those pockets of each sector that still look attractive, in terms of their pricing and potentially their income potential.
All right, we're going to have to leave it there. We're going to find out a bunch more on this topic in a few hours. In the meantime, thank you, Michelle Connell, Porsche Capital Management owner. And now thank you. And now time for our trending ticker of the day, Canada Goose, providing warmth as winter descends on the northern hemisphere and sending the stock a tad lower today. You can see down about 5%, but rebounding off the lows of the year. And that's as the coat maker beat on revenue, raking in 277 million Canadian dollars in the second quarter. It also beat on expectations on non-IFRS adjusted earnings per share of 22 cents Canadian cents versus estimates of only 6 cents. But focus on COVID disruptions in China's luxury market. They are obscuring the outlook for global macroeconomics, and they led the company to lower its fiscal 2023 outlook. On this note, Bloomberg Intelligence is opining that the slow China reopening is already dragging early on in quarter three. Coming up, shares of Meta and Snap have been pummeled this year. Twitter now in the hands of Elon Musk. It begs the question, is social media as we know it, is it over? We're going to discuss next. Welcome back, and let's take a look at some key earnings from beauty and food and entertainment companies. Many of these brands seeing a shift in their earnings due to international headwinds. Now, from lockdowns in China to Russia's war in Ukraine. Joining us now is Yahoo Finance's Alexandra Semenova. Alex, what are the details in this latest earnings spree?
Well, Jared, all eyes are on the Federal Reserve today, but we are still in the throes of earnings season with a lot of headliners this morning. One of them is Estee Lauder. Shares were down about 6% at last glance after the company indicated that it wouldn't see a return to growth until 2023. Estee Lauder slashed its full-year forecast, blaming lockdowns in China and also saying that some retailers are taking its cosmetics and perfumes off of their shelves amid worries of an economic slowdown. Notable also that this announcement comes ahead of a crucial holiday season for them. The company now expects net sales for 2023 to decrease to 6% to 8% compared to its prior forecast of growth of 3 to 5%. And like its peers in the consumer discretionary sector, such as Nike and Levi's, it's also citing currency headwinds as a stronger dollar eats into its international profits. Now, makeup demand might be slowing down, but people are still lining up to KFC and Taco Bell. Yum Brands missed estimates on earnings per share, also citing currency headwinds and a loss in profits from its KFC exit from Russia. But it did report rising sales across its fast food chains, even as fast food restaurants are raising prices to keep up with rising commodity and labor costs. People are still flocking to them, opting for more value-oriented options. We saw that with McDonald's last week as they shy away from more expensive dine-out options amid inflation. And finally, Paramount Global is also a mover today. Shares were down as much as 10% this morning after the company missed Wall Street estimates on third quarter earnings. Paramount's profit hit was the result of larger investments in content to boost its business, while weakness in advertising revenue also weighed on the quarter. The company did cite growth in its global streaming services, but that wasn't enough to appease Wall Street.
Interesting mix of companies there, and I got to tell you, I can testify to those higher makeup prices, but I still got to be a buyer. So thank you for that report, Alex Semenova. All right, moving on to Elon Musk making big changes at Twitter, saying the service will begin charging for the blue check marks indicated as users are verified. But as social media companies overall grapple with changing demographics, can stalwarts like Twitter and Meta keep up? And here with more is Yahoo Finance's Dan Howley. So the latest in this saga, Twitter Plus, can we think of it that way?
Yeah, I mean, look, so my basic takeaway from everything that's happening with social media right now is that this is kind of a changing of the guard, where we had seen for so long Facebook and Twitter be the mainstays, the stalwarts. But now this is kind of changing over to what we have with TikTok, what we have with up-and-comers like Be Real. And the reason being is it doesn't seem like Meta really cares about social media anymore, at least as far as Mark Zuckerberg is concerned. Now, investors certainly still care. They want him to stop with the metaverse, but he continues to dump $10 billion a year into the effort. And then so far this year, we have a little less than $10 billion to this point. And then they said that in 2023, they're going to see spending on it increase a huge amount. So this is something that they're going to continue to focus on as the future of the company. Twitter, we don't know what's going on. Elon Musk is haggling with Stephen King to talk about what they should charge for the check marks to be verified. So there's still so much up in the air, and it feels like this is a moment where social media is going from what it was to what it will be. And these new companies, TikTok, AI-driven, AI-powered feed that gets people addicted. And look, I deleted it again after I said I deleted it for the first time. Just because you sit there and you scroll and you scroll and you scroll. Then you have Be Real, which is really trying to make social media feel less manufactured, though anytime a pop-up comes that says Be Real, and tells you when to start posting, a lot of people still, stage what they were doing or try to make it look a little bit better. Nobody wants pictures of people sitting in the bathroom, which is most of the time on social media. And I think, the other issue that we're seeing is that kids don't care about the main Facebook app. While that still has billions of users, we have a Pew poll earlier this year said just 32% of teens say that they use Facebook. Meanwhile, we have something like 70% say they use TikTok. 70% plus. So there's these huge swings, and obviously we could talk about Meta's performance so far. Year to date, the shares are down 72%. So
what I want to ask you, it's related to Meta and the not turnaround strategy. I guess it could be considered a turnaround strategy if you're looking at the stock there on your screen, down 72% year to date. What if Mark is right? What if Zuckerberg is right? This is what I ask myself late at night. Not always, but sometimes. In terms of the metaverse, he's plowing $10 billion a year into this project that a lot of people, including a lot of people who work for him, who voted for their feet, don't believe in. Mm-hmm. Could this be the future of social media?
It's interesting, right? Because so many companies are putting money into the metaverse, right? In one way or the other. Now, in my thinking, a company like NVIDIA is doing it really well, where they're making these ideas of digital twins, and they're trying to make it so that when companies build out factories or try to build out infrastructure, they have a kind of virtual version of the world that they can go and manipulate. And so they're not going to spend as much time trying to build out these different kinds of infrastructure, right? So that, I think, is the smarter take. This is, for Meta so far, banking on people strapping headsets to their face. I don't see people doing that. And the numbers don't bear out. The Wall Street Journal did a piece where they said that Meta had wanted at least 500,000 people in their Horizon Worlds app by the end of this year. And so far, they had to revise that number to 280,000 because only 200,000 are in there. So it's not like people are clamoring to get on board. They also just launched their new headset. It's $1,500, something along those lines. People can't buy it. It's not something that I think is going to take off in that sense. Now, there's different definitions of the metaverse. It's not just walking around with goofy goggles. There's also the idea that, I'm on my computer and I'm interacting with something, so maybe that's the metaverse. And there's all sorts of discussions of that. Maybe a heads-up display on your car, that's the metaverse. So I think that there is still room for it. I don't know, though, if it's going to be the next social media, splash. I think something like TikTok, something along those lines, will continue to do well. I just don't think people want to strap something to their face. I don't.
Yeah, there's going to have to be some kind of improvement in technology, maybe that we can't even comprehend yet. But the infrastructure, as we talk about, much like crypto, being built right now, and I need to find different things to worry about late at night. Thank you for joining us here with that report, Dan Howley. Coming up, Airbnb shares falling despite reporting its, quote, biggest and most profitable quarter ever. We're going to tell you why next. Welcome back. And some breaking news in sports. The Washington Commanders owners Dan and Tanya Snyder announcing that they have hired Bank of America Securities to consider potential transactions. And this comes as Dan himself has faced increased pressure to sell the team. Statement from the Commanders said they remain committed to putting the best product in field and continuing the work that to set the gold standard for workplaces in the NFL. We're going to continue to monitor this and bring you developments as they come in. And now, luxury British car maker Bentley announcing record operating profits for the first 9 months of 2022. Part of the reason, increased customization. Yahoo Finance Autos reporter, senior auto correspondent Praz Subramanian is here to tell us all about this. Now, we know Bentleys are made by hand, at least they used to in terms of my knowledge of it. Still, they got that level of attention to detail?
Yeah, still, they've sort of industrialized that process here. So, strong years so far for Bentley. And not surprising from what we're seeing from luxury brands. Through the first 3 quarters of the year, Bentley's operating profit more than double, like you said, Jared, to a record high compared to last year. But get this, they've only sold 3% more cars. So Bentley Motors CEO Adrian Hallmark says it's all about customers paying up for more goodies.
I've been in this industry and in this sector for nearly 28 years. I've never seen spending patterns like it, and not just in Bentley, I mean generally. I used an analogy with Wayne earlier. If you walk down the line of our production facility, even 3-4 years ago, you'd see line upon line of grey, black, dark blue, dark green cars, and the occasional red one. And it was like a dark, somber, conservative place. If you walk through now, it's like a circus. The colour, the diversity of what people are ordering, exterior and interior, has just fundamentally changed. So there's more customers out there, and they're way more interested now in self-expression and in personalization. And the second thing is what we've done with the product range. So the product range is the strongest it's ever been, and it's good compared with competition. But then also we have consciously, as we say, industrialized complexity. Rather than bringing the number of variables down, we've looked at it and said, right, we know if we can do more for customers, they invest more in the product and we might make more money.
Hallmark says they don't make more money from more horsepower, but out of more stitching, more leather, and more wood. I asked Hallmark about the luxury buyer and why they seem so insatiable right now. And he said part of it is because the company's research finds that the number of high net worth individuals has been growing over the past 20 years to the point that there's 4 times as many compared to 20 years ago.
Price inflation, Praz. I guess there's a little bit more to it than that. But let me ask you about their EV plans. We've seen all the big manufacturers take the leap, and sometimes with great results, sometimes something else. What's the Bentley case?
So Bentley, just like everyone else, they want to go full EV. By 2030, that's their goal for right now. Their first EV comes out in 2025, and I asked him about that. How's that going to compare to the Rolls-Royce Spectre, which we saw come out a few weeks back? And he said, the Spectre's a fascinating car. They like it, but they say, ours is going to be more of a grand touring car, a daily driver, because they find most of their buyers actually drive their cars every day. So they want more range, things like that. But also, talking about services, they want the charging kind of experience to be a luxury sort of experience. So they're going to have like their own sort of probably bespoke network of chargers, who knows, or working through other existing companies. But my understanding is that they want it to be a concierge, almost a luxury type of service.
You just mentioned charging, and I know that there's no agreed on universal standard right now. How is that evolving in the U.S., especially as all these goals have been brought to the forefront? 2030, 35, 40. Mm-hmm. What does the infrastructure look like in terms of EV charging stations?
I think as of right now, I think everyone would agree that there's just too few chargers out there in the public space, right? So we're seeing a lot more investment from the government here, right? That $7.5 billion meant to build out, and not only a super highway of chargers, but also just in local areas where they don't have that many, in maybe some suburban or rural areas. So we're seeing that happen. I think the big problem, Jared, is with the public companies like the Charge Points of the world, the EV Go's. It's so expensive to build these chargers, and there's still not enough, I guess, critical mass of users just quite yet.
And we will get there someday, though. In the meantime, thank you for that report, Praz Subramanian. And taking a look at Airbnb shares, trading down about 10%, having their worst day since May. That's after posting them better than expected third quarter earnings. However, the disappointing guidance is causing shares to sell off today. And joining me now is Bernie McTiernan, Managing Director at Needham & Company. I was taking a look. I was breaking the numbers last night and saw that forward guidance. Should the stock be down more?
I even think this reaction is overdoing it, to be honest. We're still seeing strong demand trends. Nights booked were up 25% in the third quarter. We had that decelerating slightly in the fourth quarter, but still up a healthy 23.5%. And then ADRs, that's the big question. That's the big focus of the bears right now. They're up 12% year over year on a constant currency basis. We have that decelerating to 7% growth in 4Q. And then on the expectation that we're going to be past peak travel in 23, we actually have them declining 4% next year. But that's really the debate here, is that when the macro is going to force Airbnb kind of off the edge of the cliff of this peak travel and ADRs, and then the implication on margins is the key focus for the bears.
And let me ask you about the nights and experiences. That number, especially the forecast, disappointed. How critical is nights and experiences to the Airbnb model right now?
Well, it's the whole flywheel, right? And so the more people that are booking, the more demand that's in the system. That's going to drive ADRs higher. That pricing lever is what flows through the higher margins. And what's really interesting is that it's really a tale of two companies, where before the pandemic, it was things like cross-border travel and urban were the major use cases for Airbnb, and those are growing really strongly. Urban was up 48%, cross-border travel was up 28 or 27% during the quarter. But there's also these new use cases now that are forming, whether it's more rural stays, whether it's long-term stays. Long-term stays are still 20% of the bookings on the platform, so proving that it wasn't just a pandemic phenomenon and people really are changing. And going on that point in terms of travel is changing. If you rewind the clock a week or two ago when United Airlines reported earnings, their CEO was channeling his inner Brian Chesky and talking about how they thought every weekend now was a 3-day weekend, and just the potential for them. So not only are they benefiting from business travel coming back, but how consumer travel is changing. And Airbnb is certainly benefiting from those trends in consumer travel that Brian's been talking about really since the start of the pandemic.
And let me talk to you about Brian now, or you can talk to us, Bernie, because I remember we were interviewing Brian Chesky early on in the pandemic. They made a huge pivot, which was a correct bet at the time. And I was impressed by the speed at which they pivoted. Some people wish the Fed could be as quick about these things, but I'm just wondering, are things changing now? Is there going to be another switch that Airbnb may be able to take hold of and maybe leave its competitors behind a bit?
Yeah, it's a good question. So supply, for example, supply on the platform accelerated this past quarter from mid to high single digit growth in second quarter up to 15% in the third quarter. Our channel checks show that Vrbo supply actually declined in October. So I think that, part of the reason is like they want you to be listing on Airbnb. They've been trying to innovate a lot on things like air cover, which is a reason why hosts would want to be with Airbnb, but also maybe why guests would want to be Airbnb too. And that's the power of the platform. When we talk about this marketplace with 30% plus EBITDA margins, the reason why they're able to generate such high EBITDA margins is because they don't need to pay for traffic. And still 90% of their traffic is coming to their platform organically. And they're letting that flow through to the bottom line. Free cash flow conversion from revenue over the last 12 months is 41%. They bought back $1 billion of shares. They have over $9 billion of cash. So the investments that they made during the pandemic are really pivots that they made, especially on the cost structure, and that they haven't changed that cost structure, that we're in a peak travel environment, should enable them to weather, a downturn. Obviously, I think bears are playing for that ADR moderation that I spoke about, being minus 4% next year that we have in our models. They probably have more than that, but the company was confident that they should be able to weather any ADR deterioration, at least moderate ADR deterioration from a margin standpoint, and they have the financial flexibility certainly to weather that kind of storm.
Well, we have to leave it there. $9 billion in cash, an enviable position for a number of companies. Thank you, Bernie McTiernan of Needham & Company. Coming up, what one portfolio manager says could be the most attractive asset class right now. We're going to tell you what it is next. Welcome back. Taken in stride, high yields, low prices, and a hopeful outlook make an enticing entry point for municipal bond investors. Allspring Global Investments Municipal Bond Fund Portfolio Manager Nick Venditti joins me. And Nick, municipal bonds, munis, they don't always capture the headlines, but they have been outperforming. We talked about this over the break here. They have been outperforming bonds, which have just been performing dismally this year. And when I say bonds, I mean Treasury bonds.
Yeah, they've been outperforming almost everything, it turns out. On a scale of 1 to Ryan Reynolds, muni bonds are looking awfully sexy, certainly on a relative basis year to date, and probably on a go-forward basis, given some of the realities we still are facing from a Fed, from a geopolitical world that we're currently living in.
And we know that municipal bonds, they have different flavors, characteristics, a lot of them backed by income streams from their local governments or wherever it may be. Specifically, what kind of flavors are you looking at here that might be better suited to investors, depending on their circumstances?
Yeah, I think there are a lot of opportunities in it's a huge market, right? 60,000 plus issuers across the country. And by virtue of that, you have a lot of diversification, a lot of options to go find alpha. Look, in a world where everyone is concerned about inflation, you have munis that, to some degree at least, are inflation proof. You know this if you own a house, right? When your house price appreciates, the county assessor is there with a new tax bill very quickly. When your house price depreciates, it takes a lot longer for that
kind of like gas prices.
That's right. They tend to be much stickier to the upside than they are the downside. And by virtue of that, muni credit looks good now and will likely look good into the future.
All right, so we're talking about credit here. It is Fed Day, so I got to ask you about the Fed. Expectations are for a 75 basis point rate hike, but are these higher, just let's step back here from the 30-mile above the earth view. Are these higher rates hurting some of the local governments, or as you said, can they just pass these on?
Yeah, I think not yet, but ultimately it will. And the reason it will is because governments are, to some degree, businesses, right? They employ a lot of people. And to the extent that their employment costs go up, so do their pension costs, so do the costs of operating these cities. In addition to that, healthcare in this country is largely financed by munis, and we all know kind of the anecdotes about how expensive it is in this world to find doctors, to find nurses, and that could, over time, add a little bit of a weight to some of these credits.
Well, what you were talking about reminded me just now, about 10 years ago, Meredith Whitney stuck her neck out, and she forecast a failure of municipal bonds that was going to be structural. That did not materialize. I'm not trying to pick on Meredith Whitney here, but there are some times in history when there have been fears that municipal governments could default, even if they're backed by income streams. What are the expectations of the economy and now supporting that view or not?
Yeah, I do think that investors need to be a little more careful in the municipal bond space than they had been in the past. Look, the reality is that for a long time, people looked at munis as the sleep easy at night asset class, that there was no risk because, frankly, interest rates always went down and credits never defaulted. And credits aren't going to default at any meaningful rate, but we are facing kind of unprecedented times. We are facing municipalities with unfunded pension liabilities that are enormous. We are facing wage pressure. And so, again, I'm by no means Meredith Whitney, but I do think that credit risk is real. And so investors in this space need to be comfortable that their investment managers are tearing apart these issuers from the bottom up.
All right, and along those lines, I'll just give you the floor here. We got quick time for one more. What do you want to talk about in terms of investments here? If you had 60 seconds, what'd you do?
I'd buy munis.
Yeah?
Look, I am bullish on municipal bonds in here. I'm bullish on an absolute basis because yields are so much higher. Look, I can go out into the world today and buy bonds inside of 10 years that yield in excess of 4%. You do the tax equivalent yield on a 4%, and that gets you above 6.5, close to 7. Most investors I know would happily clip 7% today, tomorrow, and frankly, every day until the end of time. And if you pair that with the fact that it gets pretty difficult to expect 7% equity returns over the next 3-6 months, given the realities we're facing. I'm talking about a low volatility asset class. I'm talking about limited duration with almost zero default rates. Munis look like a pretty sexy place to be.
They might be giving Ryan Reynolds something for his money. Oh my God, I totally messed it up. But I really appreciate you stopping by here, Nick. You made municipal bonds interesting for me and our audience here. It's something that doesn't always happen. We're going to have to leave it right there. All right, now, time for our chart of the day. And today we're talking about bonds and sticking with that, Chinese property bonds, that is, whose prices have plummeted to new lows with some trading below 10 cents on the dollar. This chart comes to us from the Wall Street Journal, reflects a loss of investor confidence in the developer sector following a series of bond defaults. The concern here being that the problem could worsen in the coming months as due dates are fast approaching for the hard-hit industry. Coming up, from coffee to cocktails, the co-founder of Freehold Hospitality tells us how he's making the day-to-night concept work for his business. Next. Welcome back, and let's take a quick check of the markets on the Wi-Fi Interactive. You can see the Dow is down about 10 basis points, S&P 500 down just under 0.5%, and the Nasdaq almost down 1%. Russell 2000 off a little bit more. That is down over 1%. And checking on the sector action today, utilities in the lead. That is up less than 0.5%. Industrials and financials also in the green just slightly. To the downside, it is the mega caps that are flagging. XLY, that's consumer discretionary, XLK, tech, and XLC, communication services, all of those down 0.8% or more. And checking in on the Nasdaq 100 heat map we have here, Apple, Microsoft, Alphabet, Tesla, and Amazon each down more than 1%. Meta down 2.5%. Now, imagine yourself enjoying a nice espresso or espresso martini at a bustling boutique hotel without the actual hotel. Now, that's the concept Freehold Hospitality is going for. And joining me now is the company's CEO and co-founder, Bryce Jones, along with Yahoo Finance's Brooke DePalma as well. Now, Bryce, we were talking about your business model during the break. Just give us an overview of what you're bringing to the market here.
Oh, well, thank you for having me. We're bringing to the market a work-by-day, play-by-night concept, and we're open from 8 a.m. to 3 a.m. at any given venue, serving coffee to cocktails all hours of the day.
And now essentially, you have a location, Freehold Brooklyn, you have Freehold Miami, you rent all your locations. And according to a new survey from Alignable, they said about 37% of small businesses across the U.S. were actually unable to rent in full in October. So how are you facing the inflation that's hitting rental prices? And when you look at expansion plans, how is that impacting that as well?
I mean, for us, you always have to adapt to whatever it is, whether it be rising costs of goods sold, payroll costs, or just the ability to find staff. And, the recent rent hikes, you just have to find a way. And we do that through volume, specifically when everybody else might be cutting. We're trying to invest more into programming and events, whether it be the DJ or the barista walking you through your coffee in the morning and so forth.
I got to ask you about Miami. I am a native, spent a considerable time there growing up. I'm just wondering, I haven't been down there since the pandemic, and I know the scene has changed tremendously. I'm just wondering what it looks like in terms of operating your business down there.
I mean, it's bustling. The tourism's very, very high right now. For us, we definitely chose that market as we thought it was, pretty much the best growth market in the States right now. It's held completely through the rising cost of inflation and so forth as well.
And also in Miami, you have cryptocurrency available to pay for your customers. Yeah. What sort of interaction have you seen with that? Is it successful there? Are you looking to bring it in Brooklyn as well?
Yeah, I like to compare it to, years ago, you would have a customer come in with an American Express Black Card. And for us, you don't see that card all the time. And it's similar to crypto. You don't see it all the time, but it's special when it happens. It's happening more and more frequently in Miami specifically. And I'm sure the bartenders are always excited to accept it.
Yeah, I know the bartenders always love to see those black cards whipped out here in New York. I was also asking you over the break. You have private clubs such as Soho House. You're in a different genre here. You also have that live to work situation, and you are open to the public, whereas that is a private club. So how does that difference in business model work for you?
I think volume. Soho House is a curated group that is very specific to the entertainment industry. And for us, we're trying to appeal to a variety of different demographics, whether it be the tech community, whether it be music and entertainment, and fashion. And for us, that element really brings a very diverse group that packs the place every night.
I didn't hear finance in there. No finance bros?
We love the finance community.
Okay, them too.
Finance community.
Brooke?
Just to go back to inflation here, we've seen higher prices across the board, certainly when customers are going to get groceries at the store, but also seeing less of an increase at food away from home. Have you taken any higher menu prices? And also, how has that sort of taken a toll on your customers?
I think our industry, it's a bit tougher to raise prices. Like if we raised the price of a latte to what it should be, which would be about $7, it'd be, outcry. For us, we really try to invest into volume and try to bring, when everybody else is kind of making it smaller or raising prices, we try to actually expand our programming and our events.
Well, let me ask you, continuing along the discussion of prices, labor, a huge input cost. I know I've talked to several people in the hospitality field, and the turnover is a killer. It's been a challenge for a lot of business owners to retain and just get people in the door to work the service bars and the floor and whatever? How are you dealing with these labor challenges?
I mean, to give you an example, New York raised minimum wage 4 times in 4 years. So labor's always been an issue for our industry, specifically in New York. And for us, the new market is getting people in the door. But I got to tell you, that's actually been almost a benefit of inflation in some ways, that people actually need the jobs, they want the jobs, they're here to work. And they're excited to come to work and learn more about the business every day. And we haven't really seen that for the last few years.
And it's been sort of a recovery effort by all New York City hospitality to really get back after the pandemic. You sit on the board of the New York Hospitality Alliance here. What exactly are you hearing from fellow restaurant owners, fellow small business owners, as well as these boutique hotels? Would you say that we have fully recovered from the pandemic?
I think we had an amazing 2021. I think we are cautiously optimistic about 2022 and beyond. I think the industry is going in a very positive place despite rising costs. And I think, as far as turnout and guest appreciation, we're seeing a ton of success there.
And finally, to round out the discussion, expansion plans. You going internationally, Antarctica? No, there's no public market down there. Expansion plans.
We're very much eager and willing and looking into it. We have our eyes on a couple of things, but I can't really say anything at this time.
All right, sounds
to be continued.
Sounds enticing there. Freehold Hospitality CEO and co-founder Bryce Jones and Yahoo Finance's Brooke DePalma. Coming up, even with mortgage rates above 7%, it still may make sense for some homeowners to refinance. We're going to tell you who those people are next. Welcome back. With mortgage rates at their highest levels in 20 years, does it make sense for homeowners to refinance? Now, some experts think it might. And joining me now to discuss is Yahoo Finance's Danny Romero. And Danny, when I saw this, I was thinking, wow, that the math may not work out for most people, but maybe some here.
Yeah, so there are a few reasons why someone would benefit from refinancing. The first is someone who's struggling with their finances. So people who want to consolidate their debt by using their mortgage rate as a way to lower their overall debt costs. Secondly, would be someone who's seeking cash, who wants to use the cash out refinance option, meaning which it allows them to access equity that they've built on their home. And lastly, someone who would benefit from refinancing is someone who's dealing with the end of their fixed rate term on their adjustable rate mortgage. So that means that if they locked in at that 7.08% mortgage rate, that means that their monthly payments later on in the future, they won't increase. So those are a few reasons why someone would benefit from refinancing, especially under this current environment. And Black Knight came out with data that says that there are about 133,000 homeowners that are eligible to lower their monthly payments by $325 by lowering their rate to 7.08%. And that population of homeowners got their mortgage in 2008 or before.
Now, having said all that, I want to talk about the lending side. Volumes are down. We know that prices are sticky. People might be bulking and saying, oh, I can't afford that house. What's happening with the lending side right now?
Yeah, Jared, you said it. Left and right, we've heard from different mortgage companies that they are scaling back. They're also laying off their employees due to the lack in demand for mortgages. I mean, data shows us that applications for mortgages is down 86% this year compared to last year, excuse me. Also, revenue is down for a lot of these mortgage companies as higher interest rates become really costly for them. And there's even been some lenders who deal with riskier loans that have said, sayonara, I'm no longer going to operate anymore. So yes, it is a really grim picture for the lending side, but I spoke with a loan manager who says she's very optimistic, even though they are facing these headwinds especially, but she said that she's really betting that interest rates, mortgage rates will turn around.
Danny, we got another minute or two here. You talk to a lot of people. You got boots on the ground. You go around interviewing people, talk to small business owners. What are they saying? It doesn't have to be with respect necessarily to lending. It can be about the peculiarities of their business. But what's the tone on the street in terms of some of the business owners that you're talking to?
Some of them that I've, just spoken to, inflation. I mean, that word gets thrown around. It's something that they're constantly dealing with. Also employment. I mean, we just saw those numbers just yesterday from the JOLTS, report. So we're really seeing that they are dealing with a lot of these, macroeconomic topics that we talk about on a daily, right? But I mean, we have a big decision coming up. We were just talking about that earlier about the Fed.
2 hours and counting.
You're counting it. I mean, a lot of people are counting it. And I think we have to really showcase that, this trickles down to anybody, right? We will feel the impacts. Small business owners will feel the impacts. Home buying homeowners, they will also be feeling the impacts on whatever the decision may be in the next 2 hours or so.
Yes,
you say.
And 2 hours, 2.5 hours to the fireworks. That would be the Powell presser. Keep it tuned. All right. Thank you for that, Danny Romero. All right. Now, with a little bit of time left, we do want to take a final check of the markets on the Wi-Fi Interactive. And we see the Dow down about 8 basis points today. S&P 500 down 44. Nasdaq down just under 1%. You can see nestling there by the lows of the day. All eyes turning to the Fed in a couple hours here. We're going to get that big announcement that we're going to bring to you live at 2 p.m. and then at 2:30 p.m. As I was just mentioning, we got that Powell presser. Now, what you're looking at now, that is a Nasdaq 100, and we can see Apple down 1%. So is Microsoft, Alphabet, Tesla almost down 2%, Amazon down a little bit more. And let's take a look at the chip sector. We got some positive earnings and news from AMD. That stock in the upper right, that is up over 2%, so is Applied Materials and NVIDIA. Now, taking a look at the sector leaders, only utilities and industrials are up about 0.25% each. To the downside, it's still those mega caps that are flagging now. Consumer discretionary tech, communication services are the leaders, but we're going to see some more movement in a couple hours, so stay tuned. For now, I'm Jared Blickery. Thank you for watching.
Retailers gearing up for the holiday shopping season. Our next guest, though, expects sales to be weighed down by heightened inflationary pressures as non-discretionary prices continue to rise. Bank of America retail analyst Lorraine Hutchinson joins us now. Hi, Lorraine. Thanks so much for being here. I mean, we all know the pressures that are out there, right? From rising prices for things you need, so you have less to spend on things that you want. So talk to us about the holiday season and how all of this plays out. Do you expect people to be buying fewer things or less expensive things or all of the above?
Thanks. Good morning. Our holiday forecast calls for just over 1% sales growth. We do expect people to be using their money more frugally given the pressures they're facing on the non-discretionary parts of their budget. What we're also expecting is on the discretionary side, a lot of their money's been used this year on vacations, eating out, things we couldn't necessarily do a lot of last year. So it makes for a little bit of a tougher holiday for the consumer. We would expect them to be much more focused on value and much more focused on looking for deals this holiday season.
Does that signal that household balance sheets are not healthy, as some banks have told us this earnings season?
Look, our BAC card data and the work of our institute says that the balance sheets still are healthy. It's just we've seen a little bit of pullback in spending in September, and we think that that bodes poorly for the interest in really spending up this holiday season. So we think the consumer's still in good shape, just a little bit more cautious than last year and allocating their dollars to different things.
Lorraine, one key problem in retail ahead of this holiday season, we were just showing the chart on inventory growth. The retail industry is awash in inventory. There was a lot of discounting. In this environment, who sees the biggest gross profit margin pressure, operating margin pressure, and who's at risk of coming out in early January and issuing a major earnings warning?
Yeah, look, we have earnings coming up for retail. We think that they will issue pretty cautious outlooks for 4Q because retail inventories are at all-time record highs. Now, some of this is because they brought in inventory early. Remember last year, the shelves were bare. They stocked out of a lot of goods. So they wanted to make sure they were in stock. But a portion of it is also they were forecasting demand that just hasn't materialized. So we've seen the consumer take a little bit of a step back in mid-June, and then we've seen some slowing since then in September. So we think there is too much. Where we see the biggest risk are those retailers targeting the lower income consumer. We've seen excess inventory levels at retailers like Old Navy, like Kohl's, where the consumer is it's just a little bit tighter. On the good news side, who cleans up those messes? The off-price retailers. They really thrive on problems with the inventory and excess thereof. So we think that retailers like TJ Maxx, Burlington, Ross Stores will be getting a tremendous amount of really high quality, well-branded inventory really starting this quarter.
Lorraine, that's the glass half full part of the equation. I want to go back to the glass half empty part of the equation because we all have been getting this sort of increasingly desperate emails, right, from some of the retailers offering heavy discounting. Some of the retailers, the big guys like Target and Walmart, they've said we're really addressing this inventory buildup. But across the board in retail, do you think that the inventory glut is going to get worse before it gets better? Is the discounting working to work off that inventory?
So we expect the mismatch between supply and demand to peak in the fourth quarter. So we do think holiday will be very promotional. You will get some great deals, and that'll help a stretched consumer. We do expect, though, that as we hit the end of the fourth quarter, so for retail, that's end of January, that they will have worked through it. We think January will be a very heavy clearance period, as most of the retailers are laser focused on exiting the winter season with appropriate levels. When we look to the first half of fiscal 2023, most retailers already had a chance to cut orders. So when spending pulled back a little bit in June and July, most retailers called their factories and their partners and told them to make less. They cut, they canceled. And so we do see some improvement in that in the first half of 23. Now, that doesn't mean that they'll be pristine, but versus 4Q, we think they'll be in much better shape.
Lorraine, one of your top picks is Starbucks. Now, there's this new CEO getting ready to take the helm there. Have you met with him? Have you talked to him about his plan for the company looking out over the next few years?
So Starbucks is actually covered by one of my colleagues. It was one of our top holiday picks. In my sector, my top holiday pick is Tapestry, which owns Coach and Kate Spade.
So give us more
Yeah.
details on this. Do you think in general that the higher end consumer is going to be more resilient here, and that's why you like Tapestry, or do you think Tapestry is doing something in particular right, even in the luxury universe?
I think a little bit of both, actually. You know, we think Tapestry is one of the few retailers that really did transform during the pandemic. And they took a few actions that we think are really important for the staying power of their earnings. They cut a lot of costs and reinvested those in marketing. They eliminated the bottom 40% of their styles to make their assortment more efficient. And they also added an e-commerce business to their outlet business, which we think added a new customer, a younger customer. So those things combined to give us more confidence in the sustainability of their high teens margins. And with those high teens margins come great cash flow. So we're expecting Tapestry to buy back 7% of its stock and pay a 3% yield every year. And given the stock is near trough multiples at 5 times EBITDA, we think that sets up really nicely into holiday and into 2023.
Cryptocurrency exchange Binance helping to fund Elon Musk's deal for Twitter to the tune of $500 million. Binance says it hopes to help Twitter by better incorporating crypto into the platform. Here to talk about that prospect, Changpeng Zhao, founder and CEO of Binance, and our very own crypto reporter, David Hollerith. CZ, always good to see you. Thanks for giving us some time here. Is this more of a bet on Elon Musk or more of a bet on the future of Twitter's platform?
I think, to be honest, it's a bit of both. I think first of all, we want to support free speech, and this is one of the best choices, best chances to do that. Elon Musk is a very strong entrepreneur. We want to support him too. And crypto, Twitter is a town square for crypto and most of the world's hot topics. So it's a good place to support free speech.
And CZ, Elon Musk has sort of gone back and forth, at least from what we've seen in court documents that showed his text messages. He was initially talking about doing sort of a blockchain Twitter to improve some of the problems he's laid out for the company. And then he also has said that maybe that's not possible. Maybe it just won't work. And I'm curious at this juncture, what you're thinking about a crypto implementation for Twitter might look like and how realistic you think it is.
I think Twitter today is a centralized platform. So moving that in one giant step into a fully decentralized platform is going to be quite difficult. I think we got to get there in incremental steps. And for any entrepreneur or any company in today's environment, we got to make many adjustments as time goes on. So it's very natural for his thought process to change over time. But overall, Elon is a very strong entrepreneur, and we want to support him.
CZ, Elon has been making some strategic moves with regard to who he's placing within Twitter, who he's bringing over from Tesla into the new Twitter that he sees moving forward. He's even said previously that the Twitter board that he decides to put together won't be paid if he was successful in acquiring the company. Post-acquisition, and knowing how much you believe that Twitter could improve with some of the same technology that Binance already has, perhaps, and the same ethos as well, is this a position that you would want on Twitter's board? I'm
not against it, but I'm also not actively pursuing it. I'm not very good sitting on boards. I don't enjoy those type of long meetings, etc. But if my help is needed, I'm happy to. But I'm pretty busy running Binance, and we want to give all the support we can. But we'll see what Elon decides.
Speaking of sort of sticking to your knitting and running Binance. I mean, we see obviously Elon Musk, who is running a couple other companies. Now he's sort of doing Twitter. And the initial reports coming out, frankly, have the feel of throwing spaghetti against the wall, as we say. In other words, maybe we'll charge people for the check marks. Maybe we'll take away free ads from Twitter Blue. Like, there's all this stuff sort of trickling out. It doesn't feel like there is a unified strategy coming from Musk right now at Twitter. As an investor, and as a user, what do you want to see?
So I think that's very, very normal. As an investor, as a user, and as also a fellow entrepreneur, I think it's very common to have many different ideas and see what sticks. So it's really literally like throwing spaghetti on the wall and just hope something sticks. That's entrepreneurship. So many different ideas should be tried and should be tried quickly. I think as a user, my biggest problem with Twitter is over the last year or couple of years, there hasn't been a lot of new features being introduced. There should be new features every month, every week, every day. And we'll just see what sticks.
Like what, CZ? Like what would be the thing that you would want to see from Twitter in terms of a new feature?
I actually agree with a lot of what Elon's ideas. Edit button, the way let's block spam bots. There's a lot of bots that spam me my comment section when I open my tweets for comments. And blue ticks, they should become more. There should be a cost to it. I actually really support that idea. So all of this shouldn't really take more than a week to implement each. So we should have done that a year ago. So I'm very supportive of Elon's idea. Let's move quickly. Let's try new ideas.
Yeah, to that point too, as one of the largest benefactors of cryptocurrency trading volume, thinking of this whole bot situation, we know from the crypto side of Twitter that there are plenty of accounts that share, coins and pump the price and things like that. So I'm curious, given that you're also thinking about the free speech mentality on Twitter, how do you think that problem is solved now that you have a financial stake?
I think there's a balance between free speech and also pump and dump, market manipulation, hate speech, just pure lying or fake information. So there has to be a line that to be drawn. It's not an easy problem to solve, to be honest, but I think Elon's in a much better position to solve that problem than what Twitter's doing currently. There's too many spam bots on Twitter today.
And so with regard to the hate speech, though, do you think that there is a significant policy change that needs to be enacted in order to make sure that that is removed from the platform, that it is not just a place for free speech, but also a place where free speech is not convoluted with hate speech on the platform?
I think that's a very fine line to draw. It's going to be tricky. I think between hate speech and free speech, that's a very fine line. But some of the other stuff are much more clear. Fake news, spam, scam, much easier. Yeah.
CZ, one part of making a good return on an investment like this is Elon running an effective business, whether it's sales or profits. Do you support him laying off 75% of that Twitter workforce to get those profits?
I think those are the two different things. I think laying off a portion of the staff is just to become more efficient. Twitter today doesn't have a very strong business model, but it could potentially have very strong business models. So I think those two things are separate. It's not to say, I think revenue is not by saving cost. No, revenue doesn't come from saving cost. I think Twitter's ability to generate revenue far exceeds its cost center today. There's many new revenue models that can be implemented on Twitter, like charging for blue ticks, even charging per comment, issuing NFTs for each tweet, issuing a token in the future. So all of those things can generate revenue for Twitter, and it's not limited by the cost savings.
Wingstop is coming off a better than expected quarter for sales as diners embrace the company's new chicken sandwich. It also helps from a profit perspective that chicken wing prices have started to, or they have flown lower. Let's check in with Wingstop CEO Michael Skipworth. Mike, good to see you as always. Last time we talked to you, you guys were really one of the first restaurants to call out deflation. Are you still seeing those deflationary prices, and how long do you think it will last?
Brian, we are. We're enjoying meaningful deflation in our business today, just as we were back when we spoke a quarter ago. And as we look at some of these leading indicators around our overall supply chain, it seems to suggest a backdrop of continued favorability from a commodity perspective for the balance of 2022 and into the beginning of 2023.
A lot of new menu items that you've rolled out over the course of this year, Michael. How do you continue to kind of look through some of the performance indicators in different markets as you kind of continue to look through the menu and what consumers, even regardless of pricing, what they're gravitating towards right now?
Yeah, Wingstop's in a really unique spot in that in the second quarter, our business was hit with a perfect storm, and we were able to lean into a proven value playbook, as well as pull some unique growth levers that we have as a brand. And one of those being leaning into menu innovation and introducing chicken sandwich to consumers out there. First time we've done that as a brand, and we think that's a meaningful, long-term, sustaining sales driver for our business. And just launching that, along with some of the other levers we pulled, translated to a 6.9% same-store sales growth in the third quarter. And what's really great about that growth is the majority of that came with transaction growth.
I think we talked to you about this last time, Michael, with the prices, the raw material prices coming down for you guys. I don't imagine you're cutting prices for consumers, but I imagine maybe you're keeping them steady. How long do you I mean, for the foreseeable future, do you think we'll see some stability there?
We've talked about the unique spot we're in this year where we haven't had to take any price, where the rest of the industry to manage their margins has had to take meaningful price this year. And you're seeing that start to impact some of the transactions in their business. And we've been able to lean into that value playbook and not necessarily take any price this year and present consumers with meaningful value so that they can enjoy that indulgent Wingstop occasion.
Michael, my team here doesn't think I watch football, but I in fact do. And I was watching football, and I've seen you guys start to pop up on TV. Are you getting return on that investment in the NFL, and what does it look like?
We are, Brian. We're seeing a meaningful increase in our investment in advertising this year. The back half of this year, we're increasing our investment over 35%. And you're seeing us, as you mentioned, show up in a big way in NFL, as well as the NBA that's just kicked off in live sports. And that's helping us close the gap that we have in brand awareness to other national brands that are out there. And again, another one of those multiple sales driving levers that we have that give us confidence in our ability to deliver our 19th consecutive year of same-store sales growth this year.
Are people coming in store? Are they ordering through digital app? What is that touch point, especially when you think about that customer acquisition cost and the awareness generation that you're ramping up right now?
Yeah, Wingstop's been an industry leader from an investment in digital, and we had a really strong digital business before the pandemic hit. And then obviously we saw explosive growth during the pandemic in our digital business, already a business that was heavy off premise. Over the last 3 years, through the third quarter, we've seen our sales grow north of 36%. And that digital business that I referenced is over 60% of our business today. And that's a stickiness that we've been able to really hold since consumers have started to normalize their behavior a little bit to pre-pandemic behaviors. But those digital customers that we've brought into our brand, we've been able to hold on to them and continue to build from there.
Welcome back. Shares of SoFi surging this morning after the financial services company topped analyst expectations for Q3 and raised their full-year guidance for the third straight quarter. Joining me now to discuss the results is CEO Anthony Noto and Yahoo Finance's Brian Sozzi, also in the house. Anthony, just want to ask you about the results here. Doubled your GAAP net revenue, up 56% to $424 million. How would you describe these results?
The results really reflect the diversification that we benefit from because we are a one-stop shop for financial services products, and that we provide the ability to borrow, save, spend, invest, and protect. So we're seeing businesses like personal loans offset businesses like home loans and student loans, in addition to our SoFi checking and savings account, where we're offering 2.5% on checking with direct deposit and 3% later this week on savings. driving really strong account openings, which leads to deposits and it leads to more spending. We're seeing very strong trends in Invest, which is also diversified. We have single stocks as well as cryptocurrency, robo accounts, and ETFs. Then we also have a credit card and insurance products. So the continued growth that we're seeing with our sixth consecutive quarter of revenue is a reflection of our ability to overcome market volatility, the macroeconomic backdrop, because of the diversification of the businesses that we have.
Anthony, you mentioned on the earnings call a little while ago that you haven't really had a year where everything came together. Do you think you have that year next year?
I think from a SoFi operating standpoint, we do. This year was spent transitioning to a bank. Last year was spent transitioning to a public company and navigating the process with a SPAC merger into a public company. The year prior to that, we were still in build-out mode on the technology stack platform. Our Galileo and Technisys businesses are doing quite well, and that was a big part of the story back in 2020. And all that time, really dealing with a depressed student loan refinancing business because of the federal student loan moratorium. So the economy is definitely volatile, and there's a lot of uncertainty. If it stays at a contraction of -2 or -1%, I think we're going to be well positioned to continue to drive great trends, especially with the student loan moratorium ending in December.
And when that does end in December, Anthony, what does that mean for your first half results next year? Is it a profit boom? What does it look like?
You know, there's so many variables that we'd have to know to answer that question. I think if the environment is exactly the same as today, which is unlikely, we would definitely benefit from a resurgence in student loan refinancing demand and still strong trends in the businesses that are doing well now. And we believe our home loan business will be in a much better position by early next year, given the number of changes that we've made in the technology and the ability to close faster on a purchase mortgage, which is more critical than in a refinancing market. So I feel like we're going into the year set up to do really well and set more records. If the economy stays where it is or slightly less from a contraction standpoint, we'll be in a really, really good spot. We want to compound growth. We grew 51% this quarter on a year-over-year basis in revenue with really strong profits and 61% member growth. We want to keep those growth rates quite high.
Anthony, your company is growing strong, and I want to know if there's anything in your earnings results that would indicate trends, maybe that reflect what's going on in the larger economy, something that might surprise us, or just kind of confirm what's going on, the big picture here.
Well, the higher interest rates as a result of the Federal Reserve raising them to try to offset inflation and cool down the economy is driving a refinancing boom for personal loans. People are refinancing out of revolving rate debt into fixed rate term debt. And so that business is definitely benefiting from that trend. The interest rates that we're providing on checking at 2.5% and 3% on savings later this week are a direct result also of higher interest rates. We are passing on the rate increases in our other products, and the deposits that we're getting are allowing us to do that at a lower cost. So there's a lot of complementary elements of our business where one fuels the next. We call that the financial services productivity loop, and that's what you're seeing play out in our results.
Anthony, switching gears just a little bit, as the former COO and CFO of Twitter, what is your take on everything we've been seeing there?
I would say, first and foremost, I think Twitter has unbelievable potential, and that potential needs to be unlocked through the right product innovations. I think historically, the company, what I've seen as great potential, it has the best content in the world, regardless of what's happening in the world. You can see that on Twitter. The challenge is the content is there. It's hard to extract it through the product interface. And there's always been this challenge of getting a consensus view where everyone on board inside the company or at the board level. And I think for the first time, you have a single owner and a single leader that could be decisive. And the reason that's so critical is you need to iterate at an incredibly fast pace to figure out what types of product changes will actually unlock that value. And it's really hard to do in a state where there are so many stakeholders that have a say. Now there's one that gets to control the decisions and the consequences and the accountability. And I think that's the right formula, whether it's the right team and they pick the right things and they execute well, I have no perspective.
What type of products do you think would work well? Does charging $50 to get on the platform or for the blue check mark, does that make sense?
I was having fun with the debate on Twitter, hopping into that conversation. I have a lot of insights of what would work, but it's not really in my position to talk about them. It's really up to that team to execute the way they see fit. But I think they should have billions of users, given the content they have that's so valuable, and they should be valued in hundreds of billions of dollars, not tens of billions of dollars, if they can unlock that value.
It looks like we got time for another one. I happened to be reviewing your Twitter feed earlier this morning. I know you're a big aficionado of the NFL. Having served in an executive capacity there at one time, any predictions for the season?
I don't have any predictions for the season other than we really love our relationship with Stan Kroenke, the Los Angeles Rams, and Dean Spanos from the Los Angeles Chargers. It's been a great partnership with them. It's really provided us with the leverage in building our brand awareness that we thought it would. They far exceeded our expectations with what they have at the venue. They just announced 2 shows for Taylor Swift at the end of her tour, which will be phenomenal. We had the Super Bowl last year. The Olympics will be there, as well as the World Cup, and this year the College Football Championship. So I call it the 8th wonder of the world. It's an iconic platform. Every artist, sports league will want to play on that platform, and it's been a great partnership that's brought us really strong credibility and awareness. So couldn't be happier with the relationship.
Anthony, I'm excited about the new Taylor Swift album. Big fan, big fan, huge.
I'm excited about anything that causes you guys to cover SoFi Stadium from a media standpoint. So
well done,
talk
sir.
about it as much as you can.
We're all getting excited here. Really appreciate you stopping by. SoFi CEO Anthony Noto and Yahoo Finance's Brian Sozzi. Thank you for that.
The FOMC's 2-day meeting underway and a 75-point basis hike all but certain for tomorrow. Attention already turning to the Fed's next meeting on December 14th and whether or not inflation has decelerated enough to justify a smaller move, even just a quarter point. Our next guest has been nominated for a Pulitzer Prize for his work covering the Fed and is out with a new book on the former Fed chair and current Treasury Secretary Janet Yellen. Nice to have John Hilsenrath, Jim, apparently, senior writer for the Wall Street Journal, in studio with us.
I've been called much worse.
Yeah, believe me, today probably, right? Good to see you, man. So let's
look on Twitter.
no better barometer.
Exactly.
So let's talk about tomorrow's meeting. All but certain, as we mentioned there, 75-point hike. What's your biggest question about what we'll hear from Jerome Powell?
Well, I think so. He's kind of opened the door to slowing down the pace of rate increases. And the question is, does he open the door?
How does he open the door?
Well, he said, if we see clear and convincing evidence that inflation is slowing, then we'll consider it. So the question is whether in the meeting itself, they've started to talk about that. Frankly, I actually think the really important moment isn't tomorrow. It's not the Fed meeting. It's next Thursday. Because next Thursday is when the CPI inflation numbers come out. And he said they want to see clear and convincing evidence. So that's when you look for the clear and convincing
Do you think
evidence.
they have seen it?
No.
Okay.
No, I think that they've been disappointed. I think they were starting to see some signs of it this summer. And the last couple of readings in these CPI reports were very disappointing.
So, John, what about some of these issues or concerns that people have that the Fed isn't taking enough time for things to digest and be reflected in the real economy?
I think that's a totally fair and legitimate question. And it's surprising to me that you don't hear more of that coming out of the Federal Open Market Committee itself. You know, there's a lot of very independent-minded Federal Reserve Bank presidents who you would think some of them would say at this point, all right, we've done a lot. Let's slow things down and see how it's doing. But, you know, Jerome Powell has the Fed really moving in the direction that he wants, and that's to move very aggressively. I think one of the real concerns is that there's a lot of momentum that you get behind Fed decisions. When they do 0.75 of a percentage point, it's hard to get off that because if they slow down, then everyone says, oh, they're going to stop. And if they stop, everyone says, oh, they're going to cut rates. The market is always 2 steps ahead of them. So the Fed is kind of stuck in this path of continuing to do what they're doing, or else because they're afraid that the market's going to get ahead of them.
And John, just taking a step back, just your assessment of the economy right now, because when you take a look at the latest GDP report, when you take a look at the jobs data that we got out this morning, job openings, every single thing or most data points still point to the fact that it is a very resilient economy. Yet there is this fear out there that we are going to slip into a recession. Where do you stand on that debate?
Well, we got a good GDP report a week or so ago, 2.6% in the third quarter, and it contracted in the first half of the year. The worry is that, that's the best we're going to get this year. We're seeing a big slowdown in housing. We're seeing consumer spending slow down. The rest of the world is looking very weak. So I think and the economists that we survey every quarter are saying recession in 2023. So I think that's a real risk. And I think the Fed has kind of potentially created a momentum behind all these rate increases that they're having a hard time scaling back, which is why they're going to be praying on Wednesday night, next Wednesday, not this Wednesday, that those inflation numbers start to soften because, they probably would like to slow this thing down at this point, but they lose credibility if they do it before the inflation numbers tail off a little bit.
So, John, when you think of the conversations behind the scene, when you do have these periods before the Fed makes an announcement like this, especially as you've studied how Janet Yellen has moved and the family dynamic that came into sort of the policy making there, give us some insight into sort of the conversations that might be happening right now.
Well, I think the most important thing you have to think about when you're watching the Fed, and the market is always watching the Fed, is it's a very glacially moving institution. Unless there's an actual crisis in their face when they can do things overnight, they tend to take months and months and months to move the ship in a new direction, which is why they were behind the curve on raising rates to begin with, because it took them too long to say, oh, wow, we're out over our skis. We kept rates too low for too long. And they might be running into the same problem now on the back end of this, that they're going to want to see clear and convincing evidence, that's Jay Powell's terms, before they slow the pace of rate increases. Well, by the time they've slowed it down and stopped it, we might already be in a recession. So, what I would say about the debate is it's very slow moving. And I always try to kind of look at just kind of incremental changes. Is there somebody new in there saying, well, what about this or what about that? And so I haven't done these press conferences in a while. If I were doing it, I would want to know, well, how did the debate change? Not what did you do today, but what did you start talking about that we might see in the next meeting or two in December or January?
So let's bottom line it. Goldman has 75, 50, 25, and 25 again in March. Do you agree with that consensus?
Oh, you know what? I don't.
You don't do that.
That's the answer. I think I'd kind of rather talk about kind of risks and stuff like that. And I think there's a risk that they're going too far, and that they've moved too fast, too far. And the risk, I think, is to the financial system. So, the economy has been growing, very fast and needs to slow down, and I understand all that. But when the Fed raises rates aggressively, even when it raises rates slowly, stuff tends to break in financial markets. And so, what I wonder about is what's breaking out there right now that we might be learning about in 1, 3, 6 months. And so, we might find out about it. We have to see inflation slow down. That's been the bottom line all year, and it just hasn't happened, which is disappointing, I think, for every American right now.
It is disappointing. It certainly caught Treasury Secretary Janet Yellen off guard, I think, a bit, just in terms of how sticky this inflation has been. I know you had a number of conversations. We have your new book here on set. Congratulations.
Thank you for holding that up.
Of course.
I've got your bottle of champagne under my chair.
There we go. We'll crack it open for you. But I guess your takeaway from the biggest lessons that maybe she has learned in her more than 2 decades in Washington, and then also pointing to the fact that there have been some rumors that she could be stepping aside as Treasury Secretary following the midterms. Your thoughts on that? And I guess who could potentially be the next Treasury Secretary?
Right. So let me take the last question first. So I asked her about this just a week and a half, 2 weeks ago. And she said to me very emphatically, she does not intend to leave the job. And that she likes doing it. She thinks it's important. She could see herself staying there for 4 years. Given the fact that these rumors have been going around, I doubt she would have said that unless A, she had really thought it through, and B, unless she knew she was talking to the Wall Street Journal. I don't think she would have said it unless she had told the White House she was going to say it. So when she says she plans to stick around after the midterms, I believe her. Right now there's a lot of rumors out there, but you never know where they're coming from. They just kind of float around in Washington, and sometimes, and they get repeated. When the person who the rumors are about says, I don't intend to leave very publicly, I don't know. I mean, maybe I'll be caught off on this, but I doubt she would have said it unless she believed it and she had told the White House she was going to say it.
And then the biggest lessons from the 20 years.
So, that's a big long answer. I'll say 2 things. First of all, there's a lot of ideological debate in Washington and over the airwaves, and conservative policies, liberal policies, spend too much, tax too little. What I found is that in watching her career is that the big mistakes that have been made over the years, they haven't been ideological. It's been human error. It's been kind of misjudging where you are right now. So this inflation is a great example of it. So the federal government dumped money into the economy during COVID, in part because we had been through a decade of very low inflation, and they thought they could. And they were learning the lesson of the last expansion and applying it to this one. And they fought the last war, and they misread the situation, and now we have inflation. I would call it human error more than ideological error. And it boggles my mind because we debate ideological issues all the time, but it's really like, are you making the right, and this is what she said to me, you've got to look at the facts on the ground right now and read the environment. The other thing I'd say about Janet Yellen that kind of drew me to the story is, this is a woman in a very male-dominated field, a field that hasn't been very friendly, frankly, to women over the years. She broke every single glass ceiling in that field, and I think you can learn some lessons about the workplace, balancing work and family from her story. One of the great parts of the story that I focus on in the book, it's actually a love story. Yellen and her husband, the partnership that the two of them formed, him taking on this guy won a Nobel Prize in economics, right? He took on full responsibilities at home, and she took on equal responsibilities in the workplace, and the two of them together became the most powerful, influential couple in the economics industry by creating a partnership, equal partnership on both sides. It's a really interesting story.
Yeah, certainly a remarkable story. And like you said here in the title, Yellen, the trailblazing economist who navigated an era of upheaval. John Hilsenrath, great to have you on set. Thanks so much for joining us.
Yeah, that was fun. Thanks.
Higher rates don't tend to mean good things for REITs or real estate investment trusts, largely due to the increased cost of borrowing. Now, Kimco Realty isn't playing into that story, however. It's an outperformer in the commercial real estate space, with shares up more than 16% in just the past month. And strong third quarter results are pushing that bullish narrative on Wall Street, with revenue up 18% from just a year ago. For more on that, we want to bring in Connor Flynn, CEO of Kimco Realty. Connor, it's great to see you again. So it doesn't look like, when we talk about the fact that the real estate market is slowing down, a possible recession looming, obviously you would think it would mean pretty concerning time for your business. Kimco, though, seems to be in a pretty great position. What's your assessment just of where you stand and what we could likely see over the coming months?
It's great to see you too. Thanks for having me. Kimco is in the sweet spot of retail right now. Grocery anchored shopping centers, which is what we primarily own, continues to be in the retail revival. You're seeing it with demand across all the different square footages that we have in our shopping centers. And a lot of it has to do with some major takeaways that we were net beneficiaries of the pandemic. So the big key is really understanding that brick and mortar versus e-commerce, that debate is really settled. It really is a combination of the two that is the sweet spot that makes retailers more profitable and connect deeper with their consumer. And that's what's really driving the robust demand across our shopping centers, is when you think about the big powerhouses of e-commerce, they're actually all opening physical stores, and they're using those stores not only to sell merchandise out of it, but using it as last mile distribution fulfillment. And that's the game changer. That's really what's driving our robust results and allowing us to beat and raise multiple times this year.
Oftentimes we've heard about the death of brick and mortar, Connor, and yet the numbers are astounding right now. Retail vacancies in the second quarter, 6.1%, the lowest in 15 years. More stores opened than closed in 21 for the first time since 1995. What is pushing people back to stores and in some cases away from e-commerce?
Well, I think a lot of it has to do with human nature. I think when some things get taken away from you, all of a sudden you start to realize how much you really need that, or you want it. And I think that's what happened. And what we're seeing is a robust surge in services. So a lot of people during the pandemic really spent all of their dollars on goods. And now you're seeing it really shift back towards the service part of the economy. And with the grocery anchored shopping center, that really comes down to the hair salons, the nail salons, a lot of the medical, the health and wellness uses that are doing quite well today. So you're seeing it across the spectrum of what really works today in retail. And the fascinating part is the consumer still is engaging in the shopping center on a higher rate than they were even last year. And that's good news for shoppers, and that's good news for retailers. And obviously where sales go, we can increase rents then.
Connor, when you take a look at some of your larger tenants, you have all the big names from TJX to Home Depot to Whole Foods as your anchor tenants. They make up about 54% of your space there. But you also have large exposure to small shop tenants, making up 46% of your portfolio. With the risk of recession, fears that maybe some of the smaller shops won't be able to pay their rent. Are you starting to see any evidence of this?
We're looking for it, but we haven't seen any cracks yet. And one of the things to keep in mind with the small shops, which sometimes makes you think about maybe the local pizzeria, our small shops are large national chains. So JP Morgan Chase is actually the largest small shop tenant that we have in the portfolio. And you go across the top 50 small shops, and all of them are national and typically a high credit rating company. So we've seen it just across the board in terms of demand right now, really driving our results. And it's a nice part to be where I can let the results speak for themselves, because a lot of people had made up their mind on physical brick and mortar retail, and you could talk until you're blue in the face. And sometimes it's better to just let the results speak for themselves.
Just curious what you make of these new numbers out from Alignable that show 37% of small businesses unable to pay their rent for the month of October. The number we just showed, 50% in Massachusetts. New York and New Jersey right there on its heels. Pennsylvania also in the top 5. These are states where you have properties.
Yeah, that's an interesting stat. I mean, think about the Kimco consumer and the Kimco shopping center. We're typically the first ring suburb in the major metropolitan areas across the country. And that's where the affluent shopper continues to engage in the shopping center. I'm thinking that stat may include maybe some of the lower demographic areas. And when you think about the inflationary pressures that people are really dealing with today, that's where we've seen, I think, the lower demographic really feel the brunt of the issues that are facing the economy today. Is the inflationary impact is really having a dramatic effect on that lower demographic profile. Fortunately, Kimco is positioned really in the higher affluent areas. The first ring the first ring suburb is where, again, you saw the suburbanization effect take hold in the pandemic. So again, we were a net beneficiary from that migration pattern.
And Connor Flynn, always great to have you, CEO of Kimco Realty. We look forward to having you back again soon. Thanks so much for joining us.
Rising rates have led to tough times in the housing market. Both buyers and sellers stuck on the sidelines, with the 30-year fixed north of 7% for the first time in 20 years. There are some exceptions to the rule, however. Alyssa Hellman is a broker for My Southern View. Alyssa, nice to see you. So the Wall Street Journal Emerging Markets Index lists Johnson City, Tennessee. I feel like I should sing it every time, thanks to Darius Rucker. That's number one on the list, ahead of Visalia, California, Elkhart, Indiana, Northport, Florida, Fort Wayne, Indiana, round out the top 5, and your town, Raleigh, North Carolina, cracking the top 10. What do these cities have in common in terms of real estate markets?
Absolutely. So I think the biggest thing that you're seeing with rising rates is affordability has gone dramatically down. And so when you look at markets like Johnson City, like Raleigh, the one thing that a lot of those places have in common is you can still find affordable homes and compete in a way that a lot of these really competitive markets, such as San Francisco, Chicago, places where buyers were really priced out, they can still, with higher interest rates, compete and afford in some place like Johnson City or Raleigh.
Now, it's interesting because, Alyssa, we know a lot of people move to suburbs, they move to other areas for affordability reasons when they were able to work remotely because of the pandemic. But do you think that's going to be the case now as employers put more pressure on some workers to return to the office?
I do. I actually have seen 2021 and 2022, both were years where I saw a dramatic influx of relocation buyers coming to Raleigh, not unlike many of the other markets that you guys mentioned. But part of that was getting priced out in these bigger markets. Right now, when you look at interest rates, you're talking about the average 30-year fixed being 7%. That means that 85% of current homeowners have a lower rate. And so it doesn't make a lot of sense for those folks to move. So when you start looking at affordability, how can I afford my next place? Where do I want to be for 5-10 years? A lot of those other markets are really coming into play and coming into the conversation where folks are saying, maybe I want to be closer to family. Maybe I want to be somewhere else where my paycheck isn't stretched as thin as it is in other markets.
In particular, those first-time buyers who really been priced down. I think those are the ones you're finding in that top 10 list. So let's talk about the underlying issue here, which of course, mortgage rates continue to get worse. If you can put in context what a mortgage rate means when it's north of 7% in terms of how much more an average monthly payment has gone up. And if I can tack on to that, how high do you expect rates to get in the next 6 months?
Yeah, so I'll answer the second part of that first, because I think it's the less scary answer, I guess. But my attitude is, I think we've probably seen interest rates peak. I think that they've risen dramatically in the last 6 months and in a way that really wasn't predicted. The other element to that is we got pretty spoiled. Rates being lower than 4% for long periods of time, which we saw in 2020, 2021, a good portion of 2022. That's not the norm. It's not normal to see rates. It wasn't that long ago that I was closing more homes at 2.75 or 3%. Those are dramatically low rates when you look at the historic history of where rates have been. So I do think that we've probably capped out where we're going to be. I don't think that we'll see a decrease back down to that necessarily 3% or 2.5% even. But I do think that we'll start to see a leveling off. The first part of your question, though, it's a big change. Homeowners are paying dramatically more just based on interest rates. What I'm having to have a conversation, especially with a lot of first-time home buyers about, is if they got approved with a rate at 3.5%, 4%, I'm having to say to them, you really need to speak to the lender again before we go ahead and write an offer, because rates have risen so much that it's actually priced some first-time home buyers and some just in general buyers completely out of the price point they were looking. So they're having to just adjust the price point altogether.
And I want to ask you about the inventory picture, because obviously if you're a homeowner and you're seeing where these mortgage rates are headed, you want to sort of sit tight, enjoy your equity, or perhaps, wait till the market's frothy again. What is the expectations for inventory given the slow pace and the lack of confidence we've been seeing from home builders?
Yeah, I actually think that's had a lot to do with the slowdown. It's less about rates and more about where a lot of sellers are. We had insanely low inventory, especially in Raleigh, for years due to the feeding frenzy that these low rates were causing. People were saying, I'm not going to move because I don't know if I can compete in this craziness that the market is. Now you're seeing people saying rates have gone so high, I'm locked in at 3.5% or 4%. Why would I go out and upsize or downsize and be in a mortgage that's going to be more expensive at that rate? So I think you're seeing a lot of sellers stay put. But that said, real estate is one of those basic human needs that is always going to function. So even in, the recession of 2009, you saw people buying and selling homes. It still happens. We're still seeing need-based moves. We're still seeing people out there saying, hey, now that there's a little fewer buyers out there, maybe I can actually compete. Maybe I'm up against less competition. So there's some really good opportunities if you can find the right mortgage rate. The other element to that I think is really important is we're so used to saying, okay, I'm closing on this house, I've gotten my mortgage, and now I can forget about mortgage rates until I'm ready to buy again. That's not what we're advising anybody to do now. Instead, I'm saying, go ahead, find the lowest rate that you can, but once you've bought, keep your eye on rates. When you see them start to decrease, look at refinancing and save yourself some money there. Just because you buy at the rate at a current rate right now doesn't mean that that's the rate that you have to stay at throughout the course of you owning that home.
Refis have all but disappeared at the moment. Alyssa Hellman, nice to see you. Thanks so much.
In this episode of Influencers, Gregory Zuckerman, author of A Shot to Save the World.
I think we're too close to this miraculous development of these vaccines to appreciate the enormity of it. I really do think it's modern science's greatest achievement. I believe that this pandemic is going to end, but this virus is not going away. It's going to be endemic. It's going to kind of melt into the background, but we're always going to have things cropping up. I write the same story all over again, over and over. I write about overlooked, underappreciated individuals achieving something that the experts told them they couldn't do.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Gregory Zuckerman, award-winning journalist, special writer at the Wall Street Journal, and author of the new book, A Shot to Save the World, the inside story of the life or death race for a COVID-19 vaccine. Greg, nice to see you.
Great to see you, Andy.
So congratulations on the book. A lot to talk about. You've noted that you wanted to focus on the triumphs, I guess I should say, of the development of the vaccine. And one thing you talked about was a lucky break that occurred with regard to mRNA research, which occurred a couple years before the pandemic, which probably allowed for the rapid development of the vaccine. What would the world look like if the pandemic had arrived 5 years earlier? Do you think we'd still be waiting for a vaccine?
It's a great question. So I think we're too close to this miraculous development of these vaccines to appreciate the enormity of it. I really do think it's modern science's greatest achievement. And to your point, the technology was not ready a few years ago. So we need to be grateful that the pandemic, that this virus emerged at a time when the scientists I write about in my book thought they had an approach that would work. They weren't sure. We're talking the end of 2019, very early part of 2020, and they turned around, they created these really effective protective vaccines. But again, a few years earlier, I don't think we would have been nearly as lucky.
But there's a few different types of science that have been applied to the different vaccines. Do you want to just go through them and sort of layperson's term, which I know is your specialty?
Sure. So mRNA, we are familiar with that approach, that vaccine approach, because that created the Moderna as well as the Pfizer vaccines. mRNA is short for messenger RNA, which is just a molecule we have inside of us. It transports instructions from the DNA to the part of the cell where proteins are created that we live on and we depend on every day. And it was always this sort of dream of scientists to create mRNA in the lab. Well, if it's so important in the body, maybe we could create a synthetic version, just like there's, sugar, natural sugar, and synthetic version of sugar. So the idea was, well, if we could create mRNA in the lab, we could tell our bodies to create any protein. And that was the idea. That's the gist of the mRNA approach. It's a vaccine, it sends a message. And the message, obviously, in this case, is an instruction for the body, the immune system, to create the protein. The protein in this case is the spike protein. So like any other vaccine, it's an education for the body. And the other approach I write about, the adenovirus approach, that led to the J&J as well as the AstraZeneca vaccines. That's a really interesting one too. That one also took years in making. And I write about how that began really with the HIV effort to solve HIV. We haven't figured that one out yet, but they shifted, these scientists, and said, okay, we can't do HIV, but we're going to get a vaccine for COVID.
Yeah, Dan Baroque, one of the scientists working on that later endeavor I spoke to, has been, and you're right, been working on that for a very long time. But switching back to mRNA, you do focus a lot on Moderna, which could have been one of the biggest losers in the race for the vaccine, ended up being a big winner. How much credit should the Moderna CEO get here? It sounds like, his background as a salesman was sort of key in bringing this all together.
Yeah, he's a fascinating character. For years, people whispered about him. They suspected he was exaggerating Moderna's ability to create either vaccines or drugs. There wasn't much proof. They were a very secretive kind of firm. He was very hard on his employees. You can read about it in the book. People were collapsing in the office, outside the office, at home, hitting their heads, being rushed to the emergency rooms. He was firing people left and right. Very difficult, and yet inspirational too, and hard driving. And he had a vision. His vision was that mRNA was going to save lives. And he felt he needed to push his people hard. He's a little bit of a Steve Jobs kind of character in that regard. And he said, guys, one day we're going to be the ones to step up in a crisis. And he was right. And maybe it takes somebody like that. And like you said, He's a great salesman, and he raised billions and billions for Moderna over the years without any proof of concept. And people were jealous. There were a lot of envy in the industry, but turns out that that money was well spent, and people made a lot of money investing in Moderna.
Yeah, and I heard, whispers in Boston in that biotech community about him for a while, just what you're sort of saying, Greg. And even while they were sort of getting up to speed, that, maybe charlatan is too strong a word, but they were serious doubters. Do you think those people, are sort of eating crow right now?
So Andy, in my book, people compared him to Elizabeth Holmes. They said, just like Theranos, there's nothing there to this company, Moderna. And, you can understand it to some extent. They didn't have any proof. They had spent years working on drugs, and I write in the book, they gave up on making mRNA work for drug. They had to pivot to vaccines because it wasn't working with drugs, and vaccines is not a really popular area for a lot of pharmaceutical companies. So are they eating crow? Yes. But, there is some reason why they were skeptical all those years, but in the end, they were wrong.
Right. Operation Warp Speed. Where do you come out on that? I mean, this was a Trump administration program, controversial. There were some, let's just say, colorful people steering it. But was it effective, Greg?
So like most every other topic in society today, it's sort of black and white, me against you. Either Operation Warp Speed saves everything and we have to give Donald Trump all the credit, or it was useless. I come down somewhere in the middle, meaning that Operation Warp Speed was very helpful. There's a lot of money that was given to these companies, resources too, little parts that were necessary from all over the country that were brought to the necessary spots by Operation Warp Speed employees. But you also have to remember that Warp Speed made an early bet on a different vaccine, the AstraZeneca vaccine. It did not give money to Moderna early on when it was desperate for money. And Moderna, as recently as May 2020, was running out of money and couldn't get money from the government, couldn't get money from private industry, from public, from foundations, from Merck. They went to Merck. And they were almost unable to create these vaccines. One more reason to be grateful for what happened. So Operation Warp Speed was very helpful. In the end, Moderna did get a lot of money from Operation Warp Speed. Others did too. But you don't want to say it was all due to Warp Speed, the success of these remarkable vaccines.
There is the prospective case where the government's going to suggest that every person in America gets a booster, a Pfizer booster as well, right?
Or Moderna.
Or
and I
Moderna,
think
right.
that is coming, right? And also just sort of down the road, I believe that this pandemic is going to end, but this virus is not going away. It's going to be endemic. It's going to kind of melt into the background, but we're always going to have things cropping up, areas that aren't vaccinating. We're going to have issues. It's going to morph, and we got more strains. I'm not saying this for people to be too concerned. I do think Pfizer, Moderna, and the other companies can adjust their vaccines. So you'll go in and there'll be second and third generation vaccines. You'll go into a doctor's office and get a COVID vaccine, but it'll be an all-in-one, maybe with a flu vaccine. Maybe they'll throw something else in there too. So I don't want people to be too discouraged, but the vaccine researchers that I write about, they're trying to stay ahead of this thing.
Yeah, I mean, is that a losing battle? Is it going to be like the flu? We're going to continue to need new vaccines all the time? I mean, this seems like it's not going to just end, as you suggest.
Yeah, it won't.
Right.
It won't. But I wouldn't call it a losing battle. I think we'll stay ahead of it. And these vaccines are so much more effective than the flu vaccine. So if you've got protection of 70, 80%, and it's even higher for hospitalization and death, it will allow us to return to to a normalcy, really, in society.
You hear that other countries' vaccines are not as effective, like the Chinese vaccine. I don't know where the Russian vaccine stands. I heard there was one in Cuba that was not effective at all. Like, why is that?
Well, they use different approaches. So I write in the book a little bit of the Russian approach is a variation on the one that you mentioned with Dan Baruch and the J&J one. It's not quite as good. And frankly, we just don't have as much data that's reliable. It doesn't help that Putin himself didn't take the vaccine for months and months. He wouldn't take it. So listen, if that was the only vaccine in the world, either the Russian one or the Chinese one, I think we would all embrace it and take it. It's largely effective, but just not as effective. mRNA, as revolutionary as it is so much better than these other vaccines.
How come Merck and Sanofi and other companies that are known as leaders in this space were not at the fore?
That's a great question. And frankly, when I started researching this book, I kind of expected the vaccine giants to be the ones to save us. I mean, Merck is the one that created the MMR vaccine that we're all familiar with, the mumps, measles, rubella. They're a vaccine giant. So is Sanofi, as you say, and GSK. And yet they sort of drag their feet. I write about some internal rift within Merck about whether to pursue a vaccine for COVID-19 or not. GSK and Sanofi teamed up, but their approach isn't quite there yet. I would argue that vaccines until this past year are not a really sexy area for big pharmaceutical companies. You get one every few years, or once a year, once a lifetime maybe. There's just so much you can charge for a vaccine. And as a result, I think the big pharmaceutical companies had mixed feelings about chasing after a vaccine for COVID-19.
There's no money there?
There is, as we're seeing that this past year, but at the time it wasn't clear. And listen, you put all this work into it, and they've done this. Merck has chased vaccines in the past for things like Zika and such that have dissipated, have gone away, and they wasted tons of money, resources, et cetera. Opportunity cost was high. So if you're going to chase after a vaccine, and when you don't even know if there's going to be a need for it by the time you develop it, it's a risky business proposition.
Right. Moderna just recently announced an agreement with Gavi, which is the Vaccine Alliance, to ship more vaccine doses to areas around the world that are still behind in 2022. Is this too little too late?
I think it's popular to criticize Moderna. You see how much money they're making. There were always these suspicions about them. I think in the back of people's minds, they remember those questions, and they're eager to criticize Moderna. I'm not here necessarily to defend them, but I do have to note that they didn't have a partner. Unlike BioNTech, which worked with Pfizer, Moderna couldn't find a partner. Merck turned them down. So they had to do it all themselves. And they've been taxed. They've been going to the limit. I know the people internally, they believe that they wish they had been able to produce more, but their vaccine supplies were scooped up by the West. They paid the most and they got there early. And now they're trying to help elsewhere. Is it too little too late? I would say it's slow and happening, but I also understand what's going on internally within Moderna. They are just destroyed physically, psychologically. It's been a really difficult year, even though they've made a lot of money.
By the way, you just solved a little mystery in my brain, Greg. BioNTech, that's how you pronounce it?
There are different ways of pronouncing it. Even internally, they pronounce it differently. But yes, that's why I pronounce it BioNTech. You can't go wrong that way.
It's like Tesla and Tesla. We asked the people there how to pronounce it. They said either.
Really? That's funny. I didn't know that.
What about mRNA research? Where do you think the next breakthrough is going to come from there, and how will this change the development of future vaccines?
So there's a lot of excitement now about what mRNA can do besides COVID-19. Ugur Sahin and BioNTech have been working on cancer vaccines for many years. They're very excited to take the billions they're making right now and shift and focus on other pathogens, ailments. And so is Moderna. So we're talking about everything from lupus and MS, turning off the immune system, just like we've been able to turn on the immune system, perhaps for autoimmune kind of issues. Malaria, some people are going after. Dan Baruch, as you mentioned, AIDS. So some of these same vaccine specialists, revolutionary, pioneering researchers that I write about in my book are shifting to all kinds of new challenges. Now, I want to caution just a little bit because until this past year, mRNA has proved pretty disappointing when it comes to drugs. And there are some vaccines coming up, I believe, for things like RSV and CMV, some viruses that are very lethal and harmful for some people. But I want to have a little bit of caution in terms of revolutionizing the world, but I'm excited about the future.
I want to ask you about vaccine hesitancy. As someone who intricately knows how these vaccines came to be, what do you make of these continued conspiracy theories around them, and how much are they hurting efforts to get everyone vaccinated?
So, Andy, I speak to a lot of vaccine hesitant audiences, and I enjoy doing so. There's always a split. There are some people who are reasonable and cautious, and for good reasons. They're wary. I get it. These vaccines were developed in 330 days from the time the sequence was revealed until they were authorized, and historically, that's just remarkable. I mean, the average vaccine took 10 years until last year, and the fastest was 4 years. So here we are coming in 330 days. So I understand the wariness, and mRNA has never been proved effective. That said, one of the reasons I wrote my book is to show that it was years of research. It wasn't done quickly. They didn't cut corners in any way. What we've been able to do, and partly thanks to Warp Speed, was we were doing things simultaneously. We were developing, testing, and manufacturing a vaccine. That's never been done before. Why would you spend billions of dollars to manufacture a vaccine if it's not even authorized or approved yet? No one ever did it historically. So those are the kind of reasons why I think some people were hesitant, and I think they should be reassured by the fact that there were corners cut. And this process, this research, these vaccine approaches took years. And that's partly why I wrote the book. Now, in terms of conspiracy people, conspiracists, you're not going to make much headway there, sadly.
You've been skeptical, my understanding, Greg, of that you've been skeptical of the so-called lab leak theory when it comes to Wuhan and China and the origins of COVID-19, the idea that it came from the Wuhan lab. But the pandemic's origin has been really difficult to pin down definitively. How much have you focused on that question in your reporting, and do you think we'll ever have a clear answer there?
So I am skeptical of the lab leak. I'm even more skeptical that China created this vaccine. And my reporting is based on talking to top virologists, structural biologists, et cetera, around the world. And the view is that it's a little bit like HIV. HIV, for years, there were suspicion about that as well. People accused the CIA, the US government, the US Army, KGB of creating this virus because there was no natural host. There was no evidence of the animal that had the original virus. And then they found one. It took years, about a decade or so. And likewise, we haven't found the host here, but I think it will be identified. It takes a little bit of time. Those people who say it was created by China, and then they said, well, it won't spread in China, we'll only make it spread elsewhere. That seems preposterous. And the lab leak is a possibility. I'd say it's a 5 or a 10% possibility. But if you just remember that animals, we're encroaching on wild kingdom all the time, cutting down trees. Viruses are jumping all the time from animals. We saw it with SARS. We saw it with the earlier coronaviruses, MERS. Others. So to expect this one to be unusual and surprising and to have been leaked, it's possible, but unlikely. I'm an Occam's razor kind of guy.
Right. Is the wet market, does that come into play, you think, or is that kind of a blind alley?
No, I think there's a good possibility that it spread there. I'm not sure it originated there necessarily, but historically, that's how the first one spread too. The first SARS in China in a wet market. There's a good chance that that's how it spread.
Right. In recent weeks, well, we talked about the pill a little bit. I just one last follow-up question on that. And so, is that a big breakthrough or not?
I think it is. I think it's going to be a kind of a 1-2 punch that's really going to help us get out of this pandemic as long as people continue to get vaccinated. But we've got this backup of pills that are quite effective. I think modern science is going to be fixing this thing and addressing this thing and helping us out of this pandemic. Yeah.
What do you make of Tony Fauci? I mean, is he this American hero, or, listen, we're both journalists, we're like, it's not all that. Or is he all that, Greg? What do you think?
I think Tony Fauci is a hero. His whole life is dedicated to public health. It's a remarkable and quite frankly, just depressing idea that we as a people or part of our country have turned on those who look out for us. Is he perfect? No. He advised us early on not to wear masks. He couldn't have been more wrong about that. There were all kinds of mistakes he and other scientists have made. But for Tony Fauci and his colleagues at the NIH, others, they could have quit years ago and made a fortune in private industry. And they didn't. Why? Because they look out for our health and they're trying to give us good advice and guidance. And he's also pushing the research, and he behind the scenes made a lot of contributions in terms of these vaccine approaches that I write about in my book. So we owe him and his colleagues a great deal of gratitude. They're not perfect whatsoever. They make mistakes left and right, but who doesn't?
Yeah, I think you're so right making that point that, of course, he could have become the top scientist of a giant pharma company, be anonymous and very wealthy, living in a nice suburb and all that, but he decided.
And then we would criticize him for the revolving door and how dare they go for private industry after a public. Yeah, they get it criticized either way.
Yeah. After everything that's happened over the past 18 months, do you think we're better equipped now, better prepared for the next pandemic?
Well, I think so, given that mRNA has been proven and we figure out how to manufacture it efficiently, distribute it. Took us a little while, but we've learned a lot of lessons in terms of trials as well. So mRNA now we can depend on. So the next big pathogen, lethal virus that emerges, I think we can adjust and create vaccines quite quickly. Other lessons I don't think we've learned. I mean, as a nation, we don't look out for each other like we should We're a group of individualists, and that's helped us arrive at these vaccines. And only in America could these vaccines have been created. Granted, there's one from Germany, but even the German CEO I've talked to said, without American investors, venture capitalists, people rolling the dice on their approach years ago when they went public, when they were raising money, these vaccines could not have been created. So there's a lot to be proud of as an American, but there's also a lot to be discouraged about how we get advice from our brother-in-law or some video that we saw on YouTube as opposed to our own internist. It's pretty discouraging, both for me, but also for the creators, the pioneers that I talked to for my book, when they see that all their hard work has led to this split, and some people resistant and pointing fingers at them for their efforts. It's quite discouraging.
In the time left that we have left here, Greg, I want to ask you a little bit about you and the process in writing books. How did you decide to do this particular book?
So I was deep in my basement office in New Jersey, locked down like everybody else, and kind of discouraged about the world. And I thought it could be a fun project to trace and speak to the researchers, the scientists, the pioneering kind of remarkable innovators that are behind these vaccines. I didn't know at the time that they'd be proven effective, but I kind of made a bet that they would, and I tracked them along the way. So in some ways, it was a healthy distraction for me, gave me encouragement. And my book is about what went right as opposed to what went wrong. I wanted it to be an upbeat book that gives us hope about the future, because these vaccine specialists, they've turned their focus on other pathogens and illnesses and viruses. And we're going to need them again, sadly, I think, in the years ahead.
And finally, Greg, so this is one of several books you've written. Is there a common thread, or how do you choose what to write about? I mean, it's such a big commitment. You know, I read the last one that you did about Jim Simons was great, but you know, you're kind of rolling the dice yourself in the sense that, like, you're picking something, you're committing to it, and you hope that it resonates, right?
Yeah. So Andy, one can criticize me because, and I only realized this after I've sort of passed in my manuscript, I write the same story all over again, over and over. I write about overlooked, underappreciated individuals achieving something that the experts told them they couldn't do. And I write about that over and over again, unlikely heroes. I just happen to, that resonates with me. I find that fascinating. Why is it that conventional wisdom is so wrong so often? All my books, my first book was about the financial crisis and the individuals who anticipated it. Shouldn't have been these guys. And then I wrote about the energy revolution. It should not have been these frackers in Oklahoma who turned this country around. It should have been Chevron and BP. And like you said, my last book, The Man Who Solved the Market, is about a bunch of scientists who don't even care so much about capitalism and business, who have the greatest investment firm in history. And this time it's a group of companies and approaches that were overlooked. mRNA and these companies, Pfizer, notwithstanding, BioNTech is the key company behind the vaccine, Moderna, and the others I write about. So I'm taken with that theme. I think it's one that you can learn a lot from, and hopefully readers enjoy it as well.
Well, as one reader, I certainly have, Greg, and so keep on doing it. I didn't realize that. I didn't notice that theme throughout. So now I will be noticing that when, if and when you do another one.
Yeah, I didn't notice it myself until I passed it in. But yeah, I like that theme. A little bit of a David and Goliath, but I think there are lessons that can be learned about overcoming obstacles and criticism even, and skepticism from the so-called experts.
Greg Zuckerman, author of the new book, A Shot to Save the World, the inside story of the life or death race for a COVID-19 vaccine. Thanks so much for joining us.
Oh, great to be here.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Fed's latest decision on interest rates. FOMC officials are seeing hiking rates by another 75 basis points. Right now, we're seeing markets really tiptoe in that Fed decision. All three major indices slightly in the red. Now, here's what else is on tap for this hour. Tuning into Paramount, Yahoo Finance's Ali Canal has some instant analysis on earnings results out of Paramount, which was also whacked by a Wells Fargo downgrade earlier in the week. And swiping the plastic, I talk with Mastercard CEO Michael Miebach on why he doesn't see a coal-filled holiday shopping season. And CEO Chatfest will also check in with the CEOs of XPO, Trivago, and Rockwell Automation to get a pulse on the global economy into year end.
Brad, over to you.
All right, thanks so much. Big Fed day. We're going to get to the decision later on this afternoon, but taking a look at how the major averages are moving on today's session going into that announcement and then the press conference as well. You're seeing the Dow down by about 0.4%. Let's set the mood with some candlesticks here and take a look at some of the larger movements that have been taking place there. Also getting just another look at some of the other major averages here on the day. We'll try to get markets back later on. Oh, there they are. Okay, well, anyway, we've moved on. We're going over to sectors right now. Sectors on the day, as we had seen some major laggards throughout the early morning session, we've now seen all 11 S&P 500 sectors in negative territory, move into negative territory. Financials has also slipped into the red. That's flat, but to the downside. Take a look as well at consumer discretionary as we've been tracking that. That's down by about 0.3%. And with that in mind, I want to take a look at some of the retail names as I've been tracking those. And you've got a lot of red in retail right now. Amazon hyper waffling, Walmart down 0.5%, Home Depot down 0.4%, and take a look at the declines in Lowe's, moving lower on the day by about 1%. Also, you've got a host of others. Just to put this in broader perspective here at some of the declines on the day, you've got, of course, Bed Bath & Beyond as well. That's down by about 1% right now. Julie, over to you.
Thank you very much, Brad. And we're also watching shares of Paramount that are down about 9% after an earnings miss, as investments in its content, marketing, and international expansions bite. With a recap of the media giant's earnings and the broader streaming landscape, we've got our own Allie Canal joining us right now. So, Allie, tell us about this quarter and what stands out and what happened.
Yeah, well, good morning, Julie. It's very clear investors are not too happy about this. A miss on both the top and bottom lines. As you mentioned, profits really suffered as a result of those greater investments in marketing, content, international expansion, which Paramount has been really committed to. Weak advertising revenue as well. That declined 2% in the quarter. That's a big macroeconomic challenge that the industry as a whole has been grappling with. That weighed on the company's bottom line. CEO Bob Bakish, though, he focused on the company's subscriber wins for the quarter. We did see a significant amount of growth. Paramount Plus adding 4.6 million subs for a total of 46 million. Pluto TV also seeing continued success with 72 million monthly active users. And as a whole, the company has nearly 67 million subscribers across its direct-to-consumer services. And executives said that there's more room to run here. The problem, though, that Wall Street seems to have is on the profit side. Can DTC alone save Paramount amid these linear TV challenges? We heard from Wells Fargo's Steve Cahill earlier this week. He issued a second downgrade in less than a month on the stock. He suggested that Paramount take on the role of an arms dealer, similar to what we've seen from Sony, maybe license out or sell off some of those assets. Bob Bakish was specifically asked about this strategy on the earnings call, but he said that's not really part of their vision. He's really committed to keeping content on the platform. He says that's ultimately how you deliver value. Bakish also confirming that price hikes will be coming. He actually said this on our air during Yahoo Finance's All Market Summit. No timeline has been given on that, but that's something to look out for as well. Overall, though, investors really struggling to find that silver lining. Shares seem to be accelerating their losses a bit, down over 9.5%.
Allie, while we have you and we're zeroing in on the entertainment landscape, Netflix's ad-supported tier, that launching now too. Do we have a sense of where some of the conversations around where the what actual content will be on that ad tier are starting to net out?
Yeah, this is a big point of conversation right now. This ad tier launching officially in the U.S. tomorrow. And the company did warn that about 5 to 10% of programming will not be available on this ad tier due to ongoing conversations surrounding the rights to air ads against some of this content. The Wall Street Journal confirming that those talks are still ongoing with several major studios. And that includes some big guys you're seeing on your screen now: Disney, NBC Universal, Sony Pictures, Warner Brothers Discovery, Lionsgate. Some of these studios provide original content to Netflix. Others offer reruns, license their content. And we're talking about some pretty big shows here: Grey's Anatomy, The Crown, You. So it's very important that Netflix can get this right. Experts that I've spoken with have said advertising is the future for this company as it competes for subscribers and the revenue that comes along with that. We have Disney's ad tier coming out next month. Many players in this space already. So Netflix tariffs, really trying to take a bite out of that market share. But in order to do that, you have to have the content of both the user side and the advertising side. So this is something that we will have to watch very closely as this ad tier rolls out.
All right, nobody let Penn Badgley know that he might not be on the ad-supported tier. He might get upset. We know what happens then. Thanks so much, Ali Canal. We appreciate it. Switching gears, everyone, investors saying it's a match as dating app specialist Match Group reported an earnings beat. The company, which owns popular services including Tinder, Hinge, and Match.com, saw a boost in users and subscriptions in Tinder. That's just even as a widening or a weakening global economy threatens some of the spending here, particularly from its lower income consumers. But this is notable, especially given how the reopening would certainly thrust a lot of attention towards people who were just looking to get back out. And year over year, that was the construct. How much of the reopening in 2021 in Q3 back then would actually protrude or permeate over into 2022 and remain kind of this normalized level?
I guess the only thing I can really add here is love is not recession proof. I mean, really, if you've lost a job recently, you don't have money to go spend $200 on a date night. That's how I read this quarter.
Yeah, I mean, so the company, last quarter was not great, right, in terms of the earnings in particular. And so this reminds me oddly of Intel a little bit, where basically the company comes out and says, we're going to be disciplined on headcount. We're going to be disciplined on expenses. And that seems to be, in this environment, what the street wants to hear. These reassurances that these companies are reading the room, so to speak, and that they understand that we're going into a tricky time. So that seems to be the sort of big picture here of why Match is reacting so well to this report. You wouldn't think that Intel and Match would have much in common, but that's the theme I see, at least.
No, I don't think Tinder, I think there was weakness throughout this report. I think they highlighted that really through and through. They lost customers in some parts of the business.
Well, for Match, for Bumble, all of them are trying to build up the amount of revenue that they're seeing on each individual user by offering some of the incremental kind of add-on costs, whether that's being able to move yourself to the top of somebody's queue, whether that's being able to say, just send somebody a gift through the platform, which to me is a little creepy. But if that's your
10 things you should not do. X.
Jesus. Yeah, I mean, the paying users here is what it's going to continue to come down to, where they're seeing that paying user kind of increase. And I think it's really going to come back to, as well, the amount of word-of-mouth marketing that actually takes place among those paying users. Because if some paying users are saying, you know what, at the end of the day, this is not really working for me anyway, then you could see a deceleration there.
I mean, there's also some internal stuff going on. There's no permanent CEO for Tinder right now. The CEO of that group left earlier in the year, and they have not replaced them. And so this is something that they need to work on as well. So they're seeing the revenue strength. They're seeing still paying users keep up. But it's this sort of preparing for maybe things that are not going to be so rosy coming down the pike.
Indeed. All right, we're also watching Electronic Arts shares. They're on the move. The video game maker is still confident that consumers will keep gaming despite economic headwinds. For more, our tech editor, Dan Halley, joins us. Dan, I think a lot of anticipation for Electronic Arts, I'm sure, ahead of the World Cup. They talked a little bit about this on the earnings call last night.
Yeah, so let's just go over the numbers real quick. They had missed on earnings per share and revenue, and they had seen net bookings that were 1.75 billion. That's compared with 1.85 billion in the year ago quarter. That is to kind of be expected after this huge explosion that we saw in the gaming industry throughout the pandemic. So there's going to be a drop. The bigger issue here, I think, for them is what they're expecting for the full fiscal year, and they revised those numbers downward. They think that they're going to get between 2.79 and 2.8 billion. The expected revenue was supposed to be 7.6 billion to 7.8 billion. That's down 50 million from what they had previously said. And then total bookings, they're expecting between 7.65 and 7.85 billion. That's down from the 7.9 and 8.1 billion. So they're expecting less spending. They're saying that that's a mix of things, including the currency headwinds, as well as people may be pulling back. They did, yes, with the World Cup. They had their largest launch ever for FIFA as far as FIFA 23 goes. They said they had 10.3 million players in its first week, which is absolutely huge. They also have other franchises that are continuing to play. There's Apex Legends. People still like that. They did have their latest Battlefield title come out, which was, an absolute stinker. I mean, It just was not good. It was broken right out of the gate, and they're trying to fix that, and you feel bad for the developers that put time into that, but I mean, that's just not going anywhere. And then, going forward, they do have some titles coming out. They have It Takes Two coming out for the Nintendo Switch. That's more of like a, friendly, like, my wife and I would play. It's not something that's going to really drive sales. They have a new Need for Speed game coming out in December. Not going to be absolutely massive. They have a remake of the game Dead Space, but that's coming in January. So, there's some big games. Then you start going into further into 2023, and there's more titles there. There's a new Star Wars game that tends to do well for them. But there's nothing that I'm really seeing on their upcoming games that really just like is going to knock my socks off. I think they're a company that they're so heavily reliant on their sports section. And look, people buy Madden every year, and I don't know why.
I'm just confused why the stock is up.
I think
the numbers weren't that
The
exciting.
mobile numbers seem to be pretty good.
Yeah, but the forecasts are kind of meh. I don't know.
I think it's that the mobile numbers aren't as bad as they could have been. Competition as far as games this holiday season is going to be kind of light. The big one coming out is the new God of War game. That's a PlayStation exclusive though, so it's not going to hit on Xbox or anything anytime soon. But it probably is having to do with the mobile aspect, and then it's not as bad as they thought it could be. But like I said, nothing really here that's going to knock my socks off as far as upcoming titles. It's just Activision Blizzard still has a lot. Take-Two still has. I mean, look, Grand Theft Auto 5 is 8 million years old, and it's still printing money for them. So,
as you were running through the reception of some of those core titles, that many of them being household names, I was looking at some data that came out yesterday. Call of Duty Modern Warfare 2 has become the #1 selling opening weekend ever in the franchise. $800 million through the first 3 days from its release on October 28th. With that in mind, what do we expect of this particular holiday season, as we were just breaking down, where the consumers might be starting to pull back in some spending categories? Is that the same in gaming as well?
I think gaming, there's always talk about, is it, obviously everything, there's talk about, is it recession proof? I think with gaming in particular, the titles may be less, apt to suffer the, actual game sales. They are $60, so maybe people won't be buying as often, but there are sales, that are just bonkers now. You wait a month after a title comes out and it goes from $70 to $20. So, sure, that means that the companies aren't, doing as well on margin there, but it does mean that the sales are going through. And then the bigger thing is what they have to offer as far as online play. And then that's where your net bookings come in, and that'll start to really blow up for people. I think for, Activision Blizzard and Call of Duty, that's another title that just prints money for them. And they're going to have their online game they have the multiplayer aspect going on, but then they're going to have Modern Warzone 2, which really blew up at the height of the pandemic, or at the onset of the pandemic. This is the sequel to that. I still play it every Friday, get a couple of White Claws and play with my friends. I'm going to keep doing that. Yes. So I'll be on there as well. But I think there are some titles that are going to continue to do well. Really, for a lot of companies, they look at the online games and they say, this is a continuing revenue stream. They look at the single player games and they say, it's not really going to do as well. But then, honestly, on balance, you can look at some of these single player games and say, oh, they blew everyone else out of the water. So I'm looking at, God of War Ragnarok and thinking that could be one of those games. So
link up with me on Xbox, Dan. We can play some NBA Jam. I'm really good at that
game.
Oh,
baby, I bought an SNES.
We're always on fire. That's what we do.
Ooh.
Young man, gaming expert Dan Halley. Okay, before we go to break, we're watching shares of Disney off Paramount's really less than expected earnings. Macquarie's Tim Nolan is out reiterating an outperform rating on the stock ahead of Disney's November 8th earnings. Nolan thinks Disney Plus is poised to show continued upside in new subscriber additions and slowing operating losses. But he does voice a good bit of caution on the outlook for Disney's theme parks, where attendance could be hit in 2023 if the U.S. economy slips into a recession. Coming up, Dollar General faces a lawsuit from Ohio. Julie is back with that, plus a look at more of today's top headlines. That's next.
Here's a check on some of the other headlines that we are watching. Starting overseas, China locking down the area around the world's largest iPhone factory for 7 days due to a COVID outbreak. This move likely to cause further disruptions in operations for Apple supplier Foxconn, and then potentially spelling bad news for Apple ahead of the holiday season. Foxconn said in a statement the plant will continue operating within a, quote, closed loop or self-contained bubble that limits contact with the outside world. There were reports, remember, over the weekend about workers fleeing the factory because of concerns that they would be then stuck there. Chemical maker DuPont terminating its $5.2 billion buyout of Rogers Corporation as a result of the company's being unable to obtain timely clearance from all required regulators. DuPont said all parties had received regulatory approvals for the merger except from that of China's State Administrator for Market Regulation. Shares of engineering materials maker Rogers are plunging as this deal is going away. DuPont, though, is trading higher. Analysts were positive after this deal got canceled. In a statement, Rogers said it is evaluating all options in response to DuPont's notice. And Dollar General hit with a lawsuit as Ohio sues the U.S. discount retailer due to several complaints regarding overcharges. These complaints come as testing last month found 20 Dollar General stores with significant pricing errors. The lawsuit seeks civil fines of $25,000 per violation, payment of actual damages to consumers, and a permanent injunction against further violations. Saz?
Rockwell Automation shares down here after the company saw higher earnings and sales in the fourth quarter and issued a fiscal 2023 growth forecast. Let's bring in Rockwell Automation Chairman and CEO Blake Moret for more on this. Blake, always good to see you. Top of your earnings release, you note that organic sales in the fourth quarter up 20.5%. That's a very big gain against a backdrop of a slowing economy. Where are those sales coming from?
So we saw great sales in the fourth quarter. It was broad-based. We serve a wide variety of industrial markets from automotive, which had a very good quarter, semiconductor, as we're participating in the build-out of capacity there, oil and gas, renewable energy with solar energy, food and beverage, pharmaceuticals, so really broad-based across the spectrum.
With that kind of broad-based results that you have seen, where do you kind of look across the business and really identify where there is perhaps even still cost management that needs to take place at this point in time?
Well, productivity is always a part of what we're doing, even in a time like this when we're seeing double-digit growth. We saw, as you said, double-digit growth in the last fiscal year, particularly strong in the fourth quarter. And as we go forward into our fiscal year 23, double-digit growth again, with strong earnings growth as well. Productivity for us and for our customers always remains in style. A big part of our value proposition is increased efficiency in all of these industries, as well as helping them launch new lines of business. And we look inward and look for ways to be efficient ourselves.
Blake, I'm trying to figure out why your shares are down, frankly. And I don't know if it was the midpoint of the profit forecast, maybe being a little light of what analysts were predicting, but I also see your free cash flow was lower than some of the folks on the street were predicting at about $358 million. Can you talk to us about your cash position and how you guys are spending and or saving right now?
Sure. We're traditionally a very strong converter of free cash flow. And one of the things that we see in an environment like this is an increase in our inventory, particularly components, work in process, as we're managing through the supply chain constraints, bringing in largely semiconductor chips. They're arriving at different times. And so we're making sure that we're bringing in that inventory so that when that last chip arrives, then we're able to get products out the door and improve the customer service and reduce lead times to customers. The downside of that is that higher inventory is reflected in higher working capital, which has a negative impact on free cash flow.
Blake, I mentioned before your organic sales in the fourth quarter you just completed up 20.5%, but your outlook for the next 12 months, you see organic sales up 9% to 13%. How has this current quarter started?
Current quarter has started in line with our expectations. So our quarter began October 1, And so far, the quarter in terms of orders and shipments is developing in line with expectations. I want to also mention, in an environment like this, there's continued volatility. While we expect a gradual improvement in the supply chain and specifically around semiconductor availability for the types of node technologies that we use, we still believe a conservative approach is appropriate as we introduce guide for the year.
I'm also curious about whether a conservative approach is warranted on things like headcount. I noticed in the statement you talked about that you're committed to investing in attracting and retaining key talent. How are you thinking about workforce and headcount right now? Are you sort of holding the line on numbers but still focused on getting the best people in there? How's that work?
Well, we always focus on getting the best people in, and obviously making sure that we're an attractive destination for talent in all ways. And compensation is certainly a part of that. Increased amounts of equity as a part of total rewards, and all the other things that make Rockwell a great place to work. And with a continued low unemployment, then we recognize that talent, especially in some of the most high demand jobs, have a lot of choices. And it's a fundamental part of our culture to consider all the other choices that an employee like a customer can go, and to make sure that we match up really well.
Blake, good to see you. Blake Moret is Rockwell Automation CEO. Thanks so much.
Thank you.
Coming up, XPO has officially launched its spinoff RXO. We're going to speak to the new CEO of XPO. That's coming up next. XPO, now an independent company after spinning off its truckload brokerage business, RXO. And also, we've got a new CEO for XPO. That's Mario Herrick, and he is joining us now. Mario, full disclosure, you and I chatted a little bit last night at a reception at the NYSE following the formal spinoff here. And we, of course, have talked to Brad Jacobs, who is now stepping down as the CEO of the company, about the rationale behind what's going on. But just to take a step back, We have talked so much about the broader economic landscape. We've talked a lot about the buildup that we've seen in inventories in a lot of industries. What are you guys seeing across the country in terms of the flows of goods?
Julie, it was great seeing you, and thanks for having me on. So we are seeing a softer macro this year than what we saw last year, and we're hearing mixed feedback from our customers. Today, our less than truckload business is 2/3 industrial companies, and we're seeing some of these companies having more product flow through their supply chain.
To Yahoo Finance Live this Wednesday, November 2nd. We are moments away from the Fed's decision on interest rates. Wall Street widely expecting a 75 basis point hike. Let's take a look at how the markets are trading ahead of this decision. We had the Dow not too far from the flat line, still though in positive territory, up though just 24 points. S&P in the red, off just around 0.3%. We are seeing some selling in the Nasdaq. Taking a look at the Nasdaq 100, that's off about 0.7%. Some pressure on some of those big tech names that we'll hear about more in just a couple of minutes here. Let's take a look at the bond market. You have the 10-year still in the red this afternoon, the yields pulling back just a bit. The sector action as we head into this decision, utilities, industrials, financials, healthcare, the only sectors holding on to gains this afternoon. Bringing up the rear, we have consumer discretionary, communication services, and technology, the worst performers this afternoon. Rochelle.
All right, well, you mentioned those U.S. bond markets. Let's get you up to speed on what's been happening there as we're seeing some of the short and longer term bond yields pulling back slightly, though, off some of their session lows for the day. We're seeing, as with the 5-year, we're seeing that's down about 1/3%, the 10-year down about 0.5%. The 30-year pulling back the most, though, down almost 1%. Now, let's also take a look at what we're seeing with the 2-year, because that's actually impacted the most by Fed policy expectations and also reflects sentiment about the outlook for the Fed funds rate. As we take a look at the 2-year, also under pressure here, so one we'll be keeping a close eye on. Dave?
Thank you, Rochelle. Let's check out tech stocks ahead of this decision. Always the most sensitive area to Fed rate increases. Probably part of the reason they are down 31% year to date. Part of the reason they are up just less than 2% over that powerful October versus what we saw in the Dow up 13%. You see Meta, Apple, Amazon, Microsoft, Alphabet, all down on the day ahead of this decision from the Fed. Let's get more from Jen Schomburg ahead of the big decision from Jerome Powell. Hi, Jen.
Rate hike, the Federal Reserve raising its short-term benchmark interest rate by 0.75 percentage point to a new range of 3.75% to 4%. Now, the Fed laying the table for perhaps a slowdown on future rate hikes, saying in the statement that in determining future rate hikes, they will take into account the cumulative effect and the lag in monetary policy on the economy, inflation, and financial developments. The Fed reiterated that it expects ongoing increases in the interest rate until it achieves a level that is, quote, sufficiently restrictive to get inflation back down to that 2% level. Now, the Fed still views inflation as high and views the job market as strong, pointing to strong job gains and a low unemployment rate. This marks the fourth straight 75 basis point rate hike since June, an unprecedented move for the Federal Reserve since it started explicitly targeting the Fed funds rate back in the late 1980s. The vote was unanimous, and while the Fed pulled another jumbo rate hike today, we will wait to hear from Fed Chair Powell on whether he will signal slower rate hikes ahead. We'll get more from him in less than 30 minutes. Time. Back to you.
Yeah, Jen, the rate hike this afternoon taking rates to the highest level that we've seen since January of 2008. When you take a look at this statement, I know you're just getting a couple of minutes here to look through this, but how has the language evolved from the last meeting? Because a lot of the focus, at least from the market's perspective, is what it's signaling when it comes to December and then out into 2023.
Right. So as I mentioned, Jana, the major thing that changed in the statement is that they seem to be setting the table for perhaps a slowdown in the pace of rate hikes. Some might call it a potential pause at some point going forward. I see it as a slowdown. They said that in determining the path forward for future rate hikes, they're going to take into account the cumulative impact of rate hikes that have already been done, as well as that lag effect, right? Typically, there's an 18-month lag effect when it comes to monetary policy. So they're going to take that into account as they look at the impact on the economy, inflation, and financial developments.
All right, a big thank you there to our very own Jen Schonberger. We'll be keeping an eye on you. Don't go anywhere. Well, for more on the Fed's decision, let's now bring in Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager, also joining Sarah House, Wells Fargo Senior Economist. And as we're already seeing, the Dow up about 340 points just on that announcement, even though we knew obviously that this was expected. So, Joanne, what's your initial reaction to this? This was widely baked in at this point.
Yeah, no surprise here. And very little changing in the statement that we've seen so far. Clearly, the big news will come with the press conference. I think there was some concession to and recognition of that growth is moderating. And I think that might suggest to the market that the end might be in sight for rate increases. And we do expect another rate increase in December, potentially also in March. The Fed does have a really big challenge here trying to get this inflation under control when there are so many factors that have contributed to it, from rising wages in the tight labor market. We saw some new data on that yesterday, and also from continuing shortages in various parts of the economy. So the Fed has a hard problem. The market's finally recognizing that it's going to take some time to solve, but they now may be thinking, okay, next year may not be as bad as it could have been, with rate increases at least petering out.
Sarah, what do you expect to hear from Jerome Powell?
So I expect that we'll still hear that he is utterly determined to bring down inflation. But I think we'll also hear a little bit of a tone that we've seen in the statement here, and that we're getting to a point where we're at more of a crossroads when it comes to policy. So the committee, of course, has already done tremendous tightening to date, so raising the Fed funds rate by 375 basis points in just 8 months. But we need to take into account how much tightening has been done. And so there's going to be a little bit more nuance, I think, in the outlook. But I think it's important to remember that even as the Fed is signaling that it might be ready or might be in a place where it can begin to slow the pace of rate hikes, that the committee is far from done from policy tightening.
Joanne, when you take a look at the Dow's reaction right now, we're up just around 267 points. We were up over 300 points just a minute ago. S&P in the green. Nasdaq now back in positive territory, up just around 0.4%. The excitement that we're seeing from Wall Street, is that a bit overdone at this point, just given the uncertainty out there and the fact that the Fed is going to keep raising rates, it sounds like?
You know, I think the Fed said something that really should have been obvious to everybody that sort of understands how they work. Is they made an explicit statement that they're going to take into account the cumulative tightening that has already taken place when they gauge how much more tightening needs to happen. Now, and of course, that there will be lags, and they would take those lags into account before deciding whether to tighten any further. So, I mean, that should have been obvious to people, but I think that came as perhaps some reassurance to the market. And remember where we are. I mean, the market, the S&P 500, the Dow, the Nasdaq certainly, has already traded off significantly when you think about the rate increases that were signaled starting about a year ago. And I think investors, particularly long-term investors, are looking forward, and they're saying, hey, stocks have become pretty inexpensive here. At some point, these rate increases are going to cease. And in fact, we have more rate increases behind us than we have in front of us. So that rate increase headwind, particularly to growth stocks, is now going to be tapering off and potentially reversing as we get into the second half of next year. So it's a good time potentially to buy some stocks if you're a longer-term investor.
And Sarah, we did see some of the balance sheet tightening start to slow in June. How much of an indicator, though, is that of how far away we might be from the Fed perhaps plateauing or at least pivoting at some point?
So I think we're still some ways in terms of reaching that terminal rate. So right now, our expectations is that we'll continue to see the Fed hiking through probably the March meeting. But I think we have to also acknowledge that inflation is quite stubborn right now. And so we're still expecting core PCE inflation to be running a little bit under 4% annualized through the first half of the year. And so I think that's going to keep the Fed on guard when it comes to its policy stance. So still looking at a pretty tight stance of policy. And it's also not just about how far the Fed ultimately takes the Fed funds rate, but I think we also have to bear in mind how long the Fed will keep that policy rate at such an elevated height.
And Joanne, as important as this day is, it's hard not to look ahead to Thursday with the CPI number that's next Thursday. If you're Jerome Powell, what can you point to if you want to say, all right, we see inflation beginning to come down? Where?
Well, you know, used car prices, for one, is one area, and they can go through that whole list and point to different areas where prices have come down. that's the one that consumers probably find most understandable, and they're seeing it happen, particularly if they're in the market for cars. But there are a lot of elements in the pricing figures that are starting to come down. But the Fed is also going to be aware that house prices, which have risen so much, only slowly make their way into the CPI inflation figures, and that is still a positive contributor. But if you look out 6 months or a year, they'll be able to anticipate that those also will start to recede. And that's, I think, why you see inflation expectations longer term still anchored around 2.5%. I'm talking longer term. And in the medium term, probably going back towards 4% next year. So, there's clearly signs that the Fed can point to that inflation is starting to moderate.
Sarah, what do you make just in the odds of a recession? Obviously, that is a huge concern still with Wall Street. Some of those projections have been pushed out into later next year. Where do you stand on that?
Yeah, so we're expecting that the U.S. economy will enter into recession around the middle of next year. Right now, we've seen the economy stay out of it, essentially because consumers are drawing down savings to continue to fund spending. We've already seen some sectors like housing effectively already in a recession, given how much we've seen new construction and sales decline. But I think as we get further out into next year and consumers increasingly running on fumes in order to spend, that we think it's going to be harder to maintain the growth in the environment that we have been. So we're already seeing labor demand begin to edge down. So we're expecting hiring to slow. And that's further going to weigh on real disposable income among households at a time when inflation, while moderating, still remains very high and is keeping real income from actually growing.
And Joanne, you've called this a market of contrast. In terms of what investors should own, as they're trying to make sense of some of the stickier parts of inflation versus some of the parts that are going down, how do you approach this if you're an investor?
Yeah, this is a really unusual setup if we do end up in recession, which isn't looking increasingly likely. It doesn't look uniform at all. We still have some parts of the economy that are expanding. Car production, for example, still facing shortages from the chip side. Services, still trying to find enough labor to operate. And so when you look as an investor, you have to be able to distinguish which parts of the economy are going to be hit the most by inflation. And that primarily is where inflation bites the most, which is really the mid to lower end consumer, which is really going to feel that pinch. So it's going to be challenging potentially for sort of mid-range retail, mid-range restaurants to keep drawing in those customers. But the bargain opportunities, where am I going to shop to save money at TJ Maxx or a Target? After they've now cleared out their inventories and stocked the right stuff, they could be real opportunities. And we like those two stocks particularly. And then you have to look at the luxury brands, some of them continuing to do well. You have to watch the inventory situation. But the high-end consumer really isn't going to feel the pinch so much from this inflation. Gas, food, is a small proportion of their budget expenditure, so that they're not going to be hurt that much. So it really is a time to pick and choose where to go. Favor the luxury consumer, retail markets, and really stay away from the mid-range where folks are, companies are likely to see a fall off in their foot traffic as folks go bargain shopping at a place like TJ Maxx.
All right. Joanne and Sarah, stick around because we're going to be coming back to you in just later on this half hour. Let's bring in Dennis Lockhart. He's a former president of the Federal Reserve Bank of Atlanta, getting his take on the 75 basis point hike that we just got from the Fed. And Dennis, I want to start here because the Fed is laying out this possible rationale for a slowdown in the pace of rate hikes, saying that in determining the pace of future increases in the target range, a committee is going to take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation. I know you were specifically watching the language here, the change that we could potentially hear from the Fed. What's your takeaway on that statement?
Well, I'm not surprised at today's rate move. I think that was everybody expected that. I am a little surprised at the inclusion in the statement of language that gives some hint of what the path of policy might be. That's a little bit unusual. I think it's welcome because they're acknowledging that they're getting close to a restrictive point, and at some stage we'll be looking a lot more tactically at whether to add further rate rises or to pause. They're signaling that they're getting into that zone, and I think that's a good thing. And of course, they want to keep their options open as much as possible.
So, Dennis, based on that and other evidence you're taking into account, do you expect 50 next month and then a pause in 23, or keep hiking?
Depends on the data, of course, and we can't forget that. They're always going to be looking at the data and looking for some signs of progress against the inflation problem. I think it's quite plausible that they step down to 50 next month. I even say that's likely. Then they have a meeting January 31st and February 1st and another meeting in March. I think it's a little early to project those rate hikes if they actually occur, because it's going to depend on all the inflation reports and analysis they do between now and then.
And Dennis, they did say they would take into account the cumulative tightening, as well as some of the lags that people were concerned about in the real economy showing up. The Fed says that they're keeping that in mind. And this was a unanimous decision. Are you surprised? Because we were hearing a little bit of dissent as to how fast the Fed should be going right now.
Well, let's remember that the list of voters is a subset of the total committee. And so a unanimous decision on the 75 basis point increase doesn't necessarily reflect that there isn't a fairly robust debate during the meeting among those who think we should slow down and those who think they should keep at it and perhaps raise 75 next meeting or even thereafter. So you just don't know what the discussion is. The minutes that come out in 3 weeks will give us a much better sense of that. But I'm not surprised that it was a unanimous. I don't think anyone had a basis on which to dissent at this meeting.
Dennis, two questions here. You've been in this room before, and I know we've asked you this in the past, but at this point in the economic cycle, when there's so much uncertainty, when we do have 5 inflation prints between now and the next Fed decision, what kind of conversations do you think are going on inside the Fed? And when you take a look at inflation right now, signs that it could potentially be cooling, how confident are you that we will see significant cooling here in the coming months?
Boy, I tell you, I have been surprised at how persistent the inflation picture has been so far. I think it's very hard to conclude that inflation in any way is really broken out to the downside. It is still a very troublesome picture when you take all of the different components into effect or into consideration. Your earlier speaker correctly said autos seem to be softening, perhaps shelter and housing is softening, but it's still a little bit early to draw that conclusion. I think they will be talking among themselves about messaging, and that is if they decide to step down, how do they frame that decision exactly? And it's a little bit of a tricky communication problem, I think, for Jay Powell and for his colleagues.
Earlier this week, sir, BlackRock was out with a note saying we think the Fed will only stop when the severe damage from rate hikes is clear. Do you fear severe damage? And if so, where would we see it?
I've been saying now for many weeks that the more persistent inflation is, the greater the chances or probability of a recession, simply because they have one crude tool that they're using. It doesn't address every root cause of inflation. And if inflation continues, they're going to be highly tempted to continue to use that tool. So the risk of overshooting or oversteering is very definitely there. And, I just think that you have to consider the possibility of a recession of some severity. I'm not sure what severity in 2023.
And we know that Chair Powell had talked about pain for the U.S. consumer, for the everyday American with this. For people who are wondering what this means for their credit card bills, how should they be bracing themselves for this period?
I spoke yesterday to someone from the retail industry who gave me a sense that the consumer is already adjusting to some extent, and that most of the spending in this particular chain of stores is on essentials, not on discretionary items. And I think that's probably what's happening. The overall consumer numbers are holding up, but the constitution of consumption is shifting to essentials. And I think you're going to see particularly those at the lower end of the income spectrum doing that more and more, and with more and more difficulty, frankly, if essentials continue to rise in price.
And just real quick, I guess just your reaction to the market's reaction to this. And I know you're more of an economy guy, not so much an equity person, but when you take a look at the euphoria that we continue to see in the markets when the Fed is still saying that they're going to raise rates, it just might not be as aggressive. Do you think a move like this is justified?
Now, we'll see if it holds for the next couple of market sessions, but I think what you're seeing right now, and the Dow is up, 202 points, is sort of a sigh of relief mini rally after a lot of suspense building up, or not so much suspense, but let's say just building up to the decision and the announcement by the Fed. And I think what the Fed has done today, as well as has said, sort of confirms the expectations that were already priced into the market, and the market is responding positively to having their expectations affirmed.
The markets are walking through a desert searching for any hope that there might be water on the horizon, aren't they? Dennis Lockhart, great to have you here, sir. Appreciate that.
Thank you.
All right, joining us now for a closer look at the bond market reaction, R.J. Gallo, Federal Hermes Senior Portfolio Manager. Good to see you, sir. Let's first get your reaction. We knew the 75 was coming. Anything inside the language surprise you, in particular the mention of the lags with which monetary policy affects economic activity and inflation?
Well, I think you and all the prior guests who just spoke before me are focusing on the right things. That the addition of that language elevated the importance of the idea that when you get closer and closer to a destination, you slow down, just like when you're driving a car. And that's what they're telling us. The acknowledgement of the lags, the cumulative tightening that's in the pipeline, the signal is clear. They're getting closer to their pause. It'll probably be early to mid 2023, call it 475 or 5. And then they have to stop and wait to see the cumulative impact of the tightening. The fact that the bond market is reacting with the steepening, where 2- and 5-year yields are double digits richer, makes some sense. This new language, I think, forecloses, at least for now, the concern that they're going to keep going 75. And I think it affirms expectations that were built off of recent FOMC members' speeches and appearances that this day was coming, this idea of slowing the pace and getting closer to the pause.
But RJ, when we're getting closer to a destination, I'm looking down at my GPS and I'm seeing the time go down 10 minutes or so. We're not seeing that in inflation. We're still at a 40-year high. What evidence is there that we are closer to the destination, which is 2%?
I'm going to stay with the car analogy.
Okay.
If you are going to drive your car by looking solely in your rearview mirror, you will hit a wall or another car. That's what the Fed would be doing if they looked solely at CPI and PCE, realized past inflation, while driving the car of monetary policy as the economy moves forward. They need to look forward and anticipate. It's undeniably clear that monetary policy is not instantaneous. Mortgage rates have surged, but other interest rate sensitive sectors are only now starting to feel the pain, the cumulative impact of a sharp and aggressive tightening that is already underway. They need to look through the windshield as to where the car is going. Lags take time to overcome. We cannot set policy solely on realized past inflation. The Fed is heartened, by the way, by the fact that inflation expectations are all pretty much south of 3%, whether you look at tips or you look at surveys. So they are acting in a manner that keeps those expectations relatively contained, and they can't set policy solely on realized inflation. It's like driving a car looking solely in the rearview mirror.
So Ajay, then, in terms of what we saw with Q3 real GDP, obviously we know that the Fed is data dependent, but with so many different indicators pointing in different directions here, what does this mean for not just the likelihood of a recession, but how deep of a recession we might be headed for?
Q3 GDP was an upside surprise propelled heavily by the surge in exports and the drop in imports. The post-pandemic world has been dominated by heterogeneous reopenings, all kinds of distortions to global trade patterns. Who actually thinks exports are going to keep growing at a double-digit rate? Very few people. The economy is slowing. in China. The economy is likely going to be in a recession in Europe. Global growth is slowing. Our exports are not going to continue to expand that pace. If you X out the impact of trade and government spending from the Q3 GDP release we just had, it was 0.1% at a seasonally adjusted annual rate. 0.1. That wasn't that strong of a GDP print. The underlying internals, when you X out trade in particular, as well as government spending, are weaker. The midterms are coming up. Government spending is not going to be surprising to the upside when we have divided government with Republicans controlling perhaps the House and the Senate, certainly the House.
RJ, certainly when you take a look at the market's reaction, they're not waiting for the press conference just in terms of how they are interpreting this additional sentence that was put into the statement. But when we look ahead to that press conference from Fed Chair Jay Powell, what are you hoping to hear? What will you be listening for over the next 45 minutes or so?
The new language that we've all been talking about is going to get questions from the media that's assembled in the room there. They're going to want to drill down for further meaning there. It's a challenge that Chairman Powell faces getting in front of them at any session, but he actually has a unique challenge now. This language, which I think was unanimous across all the voters, suggests that they're opening the door to the pause. It's not right away, but we're getting close. We're getting close to our destination, as I said before. There's going to be a lot of questions about how the market should interpret that new language. Why was it put in there? Clearly, the committee, on a unanimous basis, feels like it belongs there. Can Chairman Powell still sound hawkish on inflation while acknowledging the need for a pause and not open the door to a huge rally? Former President Lockhart mentioned it earlier. It's a tough act. It's not an easy task to communicate such subtleties to the markets, which often trade on sound bites. So there's the risk that he gets up there and tries to talk back or walk back the language in the statement. That seems like a low risk. I think he may elaborate on it in a way that will get further bullish response from potentially equities and from the intermediate part of the Treasury curve, for example.
So then, RJ, on behalf of investors, if you were in that room with Jay Powell, what would you want to ask him?
Interestingly enough, I think that the bigger questions come down to quantitative tightening, the Fed's plans with respect to the balance sheet. They've made their pace of balance sheet reduction abundantly clear, but there's plenty of talk, including talk at the Treasury Department, of the need to sort of bolster liquidity. Bond volatility, both implied and realized volatility, has been extraordinarily high this year, and liquidity conditions have likely something to do with that. I'd be interested to see what Fed staff at the Federal Reserve Bank of New York, working with the Treasury, what they're thinking about, what measures could be taken to allow the balance sheet to shrink, to be consistent with the overall monetary tightening, but to do so in a way that might be less disruptive to the functioning of the marketplace.
RJ Gallo, always great to have you. Federated Hermes, a senior portfolio manager. Thanks so much for joining us this afternoon. And let's kick it over to Jared Blickery as a closer look at some of those gains that we're seeing, at least across the board when it comes to the equity markets.
Yes, and don't...
In the U.S.
In the U.S. And don't call it a pivot. Some great commentary there. And I'm going to delve deeper into this, but I just want to point out the Dow, S&P 500, NASDAQ, all in the green now, not the case earlier in the day. And I just want to go over some of the movements in the bond market. Here's a 5-year T-note yield. It is net down 9 basis points. You're going to see everything down on their yield curve. 10-year T-note yield, that's down 5 basis points. And the 30-year on the long end down a little bit less, 3 basis points. The very short end down 3 basis points. You can see the 13-week, that tracks what the Fed benchmark is doing, the very shortest end, and it has recovered somewhat. Also, the U.S. dollar, very important. That has taken a leg lower. But you got to think, all of this was set up by that Tim Rouse article in the Wall Street Journal about 2 weeks ago, and there's a lot of pressure on Fed Chair Powell right now. Is he going to deliver what he doesn't want? Is that going to be a stock market rally? The Fed officials have been on record saying that's not what they want to see in this instance. So I have to agree with our prior guest. It's going to be a very difficult tight wire act for Jay Powell to navigate here as he takes questions and isn't too bullish or optimistic. I guess we're going to have to apply the Goldilocks test with 2020 hindsight here, guys.
Has to be just right indeed. Jared Blickery, thank you so much. All right, well, as we await comments from Fed Chair Jerome Powell, let's bring back Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager, and Sarah House, Wells Fargo Senior Economist. So, Sarah, obviously we're seeing increased market reaction here, but obviously we're still waiting for the exact wording to come from Fed Chair Jerome Powell. Just how tough is this balancing act going to be in terms of the wording of this?
Well, I think it's still going to be very tough because I think he's going to want to demonstrate that the committee is still very much committed to bringing inflation down, restoring inflation back towards its target, but also acknowledging the fact they've done a lot of tightening to date and it's time for things to slow, but they haven't given up on that inflation target. And so as some of the prior guests mentioned, I think it's going to be difficult to make sure that the market maybe doesn't run away with that somewhat more dovish message than the Fed has been signaling over the past few months, but balancing it with the fact that, yes, there's been a lot of tightening to date, but there's still a lot of work to do when it comes to inflation.
And Joanne, perhaps Lloyd Blankfein, the former chairman at Goldman, tweeted it best. I imagine Jay Powell and the rest of Fed governors are right now sitting with the thesaurus, trying to find the right word that means pause or not pause, depending on who's listening. So what's the language you'll be listening for? What's the Fed drinking game, coffee, if you will? Is it data dependent?
Yeah, who knows what thesaurus they're using, but data dependent is a term I'm sure we will hear again. I think they will get into specifics to try to create that balance. One area is to be clear that house prices went up a lot, renters is up a lot. That's going to feed into keeping inflation on inflation. The labor market remains tight. They could cite the recent data on that. On the other hand, they are also likely to cite data that shows that the economy is slowing a bit, whether that comes from the liquidity constraints that we are starting to see pop up in corporate debt markets, government debt markets. We're seeing credit spreads widen. We're seeing bid-ask spreads widen. So there's clearly a liquidity constraint that should tamp down some of the economic growth that we've been seeing. They can cite that as the other side, that their policies are having an effect, but that they need to do more, that there's definitely more work to do given the pressure on wages, given the housing data. And so I think they'll have enough data in their arsenal to be able to strike that balance. I think they'll try to emphasize, that they are data dependent and that looking at inflation in the past, is only part of the data that they use, that they're doing a lot of observation of the economy in real time to gauge how much more work they have to do. And if, again, you look from an investing perspective, I think it's pretty clear there are fewer rate increases to come than we've had to date. And that does suggest a little bit of less of a headwind to stock valuations going forward from here. And I think that's partly what the market is reacting to.
And Sarah, in addition to the inflation data, obviously the CPI prints, the 5 prints that we're going to be getting out between now and the next meeting is going to be a big focus. What else, in addition to jobs, will you be focusing on over the next 4 weeks?
I think consumers. I think consumer spending, in addition to just the labor market and inflation data. So we've seen weakness in business investment. We've seen weakness in residential investment. As RJ was talking about, we can't see the strength in exports go on forever, but how the household sector does, how willing it is to spend down the savings, lean on its balance sheets, I think will be pivotal for how long we can see the economy continue to expand and continue to put pressure on inflation.
All right, there is the Fed Chair, Jerome Powell, walking to the podium. Let's listen.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food, and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby. Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean. And we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. There are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina. Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity there. With the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but, we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy. And we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common.
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of us, one of the policymakers, violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending? I
don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why why the rate curve is doing what it's doing. It can be doing that because it expects cuts, or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up. You also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right. But if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road, and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on on that, what's the level we need to get to rates. And, I don't know what we'll do when we get there, by the way. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So
How big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
You know, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
You know, it's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects. Although I think overall, I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path has narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the Beveridge curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now. And it really hasn't, although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Fed Chair Jay Powell just wrapping up his news conference after the central bank raised rates by 75 basis points for the fourth time in a row. Rates now at the highest level that we have seen since 2008. But it was Powell's commentary that really sent stocks on a wild ride over the past 45 minutes or so. He was trying to strike that both that dovish and hawkish tones, going through some of those headlines as to why we saw equities bounce all over the place, the driving factor why we're in the red at this point with the Dow off 139 points, and Powell saying that it's very premature to think about pausing rate hikes. On pace for future rate hikes, he said that there's still ground to cover. Ongoing rate increases are appropriate, at least at this time. He also said that the ultimate rate level will be higher than previously expected at the last September meeting. And pairing that with that dovish tone too, Dave, it was interesting because the market really wanted to hang on to anything that they could in terms of a dovish tone from Powell. And we did see that, and we saw it reflected in the market earlier this afternoon when Powell did come out and say that he could potentially, or the Fed could potentially, pause rates at the December meeting or at the following meeting in 2023. So they're trying to figure out exactly which way the Fed is going to go.
Yeah, again, the markets, as I said earlier, kind of that guy walking through the desert, just desperate for any drink of water. They took that one sip and raced up, but then Powell reiterated, not just once, but twice, again, that word that you just said, premature. It's premature to think about pausing, and that's what really is the big picture takeaway. And if there's two, and I'll throw this one to you, Rochelle, he reiterated that, again, this was also twice, and that's why it hit me, that if we over-tighten, we have the tools to respond. In the other case, we will entrench inflation expectations. That's what really gives you a sense of the direction moving forward for the Fed.
I mean, I will say in this meeting, we heard much more about the lag effects than we've heard in previous meetings. Obviously, that's a concern that we've continued to hear from some economists and investors as well. And he talked about the three questions that are front of mind, how fast they're moving. He said expeditiously, but he said that's less important than the other two questions, which were how high, and he said sufficiently restrictive to reach that 2% target over time with inflation, and then how long to remain at restrictive levels. And he said that time may come, that there may be discussion about it at the next meeting. But then, as we mentioned there, we also heard him saying, look, it's very premature to be thinking about pausing. So he was clearly trying to walk that fine line there. But as we saw from the market reaction, we did see the Nasdaq turn negative first, followed by the S&P. But it's when he talked about it being very premature that we then saw the Dow also falling into negative territory as well. He talked about inflation being the possibility of it being entrenched. He said that there was no clear way of assessing that. But as you mentioned there, that he could use the tools from perhaps over tightening versus not doing enough and then having to keep going back and forth and allowing inflation to become entrenched. So he tried to walk that tight line. But as we see from the market reaction, markets not really on par there, definitely a lot more hawkish perhaps than they were expecting, Shauna.
Certainly looks like that, Rochelle, with the Nasdaq off nearly 2% right now. Okay, we want to bring in the Great Hill Capital Chairman. We have Thomas Hayes joining the show here to help us break down what we just heard from Fed Chair Jay Powell. And Tom, when you take a look at those headlines, trying to walk that very fine line, not trying to sound too hawkish, also didn't want to sound too dovish. Did you do a good job?
A fair job. I think to Dave's point, it's, equity bulls looking for a drink in the desert. He didn't give us much water, that's for sure. But he did leave on the table the possibility of a downshift in December from 75 to 50 or the next meeting. So the point is that the pace will be slowing at some point, even if the terminal rate is going to be higher. So we came into this meeting thinking the terminal rate might be about 4.6 to 5. Coming out of this, I do think that the downshift will be a positive thing. I think the markets will take 24 hours to digest this, and then we'll start to look company by company. But if you look at the seasonality that we're going into right now, we do have the election coming up, and that's coming up very, very shortly. The average return for the S&P in the 12 months following a midterm election is 18.6%. So he's trying to throw cold water on it. He has left a downshift. He came out to the cumulative tightening. He's going to take that into account. He's going to take into account the lag. And then he completely threw cold water on it with the it's premature to pause. So it's kind of double talk here. I think on balance, we've got two more CPI prints before the December meeting. We have the jobs report. Unfortunately, the JOLTS report was a little hot yesterday, so we're not expecting miracles from the jobs report on Friday. 200,000 non-farm payrolls. If it comes in hotter than that, market's going to price in 75 in December pretty quickly. If it comes in light, then maybe that downshift still is on the table.
And there's no real indication that CPI number on Thursday is going to be any better. We haven't seen, I mean, yes, used cars, we can see. He reiterated the labor market is a big problem. What else did we learn today that we didn't know an hour ago?
Yeah, the labor market is definitely running hot. I mean, we were just talking about restaurants in Connecticut. You can't get a reservation at a good restaurant in Connecticut. So the economy continues to run hot. Labor market's hot. Inflation's hot. I know that there have been major speakers come out say owner's equivalent rent is miscalculated. It's going to take 9 months to show up in the inflation numbers. We agree with that. The question is the Fed willing to wait and look through the windshield versus the rearview mirror? And right now they're looking a lot through the rearview mirror and not maybe enough through the windshield. I think a good model to look at where we are right now is in 1948, post-World War II, when we'd borrowed a lot of money for the war to fight a visible enemy. Debt to GDP got to 120%. They ran inflation above trend for about 3 to 5 years, 3 to 5%, and that ratio dropped from 120 down to 63 in just 5 years. So we might have to run inflation above trend. He did acknowledge long-term inflation expectations remain anchored. If you look at 5-year inflation break-evens, they're at 265, so they're getting close to the target. And Chair Powell has reiterated he's very concerned about expectations more than actual inflation. So long as that long-term expectation stays anchored, we could start to see the downshifts that we've been looking for. If not in December, certainly in the following meeting.
And as some investors are looking through the tea leaves here, we know that Jay Powell was asked about the 3-month yields, talking about the inversion getting close, not there yet though. And he did say that although it's his preferred measure, they are going to monitor it, but he did seem quite tight-lipped on that. What are your expectations about what the yield market is telling us?
Well, you initially saw bonds get bid on the news that they were going to actually pay attention to lagged effect of monetary policy. And by the time he finished the press conference, we're basically unchanged. The dollar sold off huge initially when we saw we're going to take into effect the cumulative tightening and we're going to take into effect the lags. Now the dollar is just off a little bit. So basically we're unchanged here. He came out way more hawkish in the press conference than in the original statement. So the market didn't love that. But like all of these Fed meetings, what we usually find is the first move is often the wrong move. So give it a day to digest. I think as people say, it's very rare where we come to the table and we say, the economy is strong, this is really bad news, what are we gonna do about it? So I think it's a mix here. If you look at earnings for this quarter, they're up 2.1%. They were expected to be up 2.8%. You back out energy, they were actually negative 0.6%. So he is destroying demand. If you look at the GDP for Q3, plus 2.7. If you back out the exports, which was a lot of energy and petroleum products, you actually had negative GDP. So their policy, they have to start to acknowledge that it is working on a lag basis. We started in March. Negative GDP, that in actuality, that would be the third negative GDP quarter if you backed out exports, with earnings coming in slightly lower than expected. So these things are working on a lag basis, and the fact that he kept that downshift on the table, I think, is that drink of water in the desert, Dave.
Well, Tom, what if we don't see that downshift, though? Because there's already been criticism out there that the Fed has been way too hawkish up until this point. This was the fourth 75 basis point hike in a row. Powell did say he doesn't have a sense that the Fed has over-tightened or that they have moved too fast. Are you at all concerned that they have been too aggressive up until this point?
I do think when all is said and done, they'll find that they've been too aggressive and they'll have to pivot and actually start to cut sometime in 2023. As we've seen throughout history, it's always the case that they over-tighten. The question is how much they're going to look through the rearview mirror and how much they're going to look through the windshield. And right now, they're solely looking through the rearview mirror. And the reason the market initially rallied was that they said, okay, we will take into effect the lag basis, but then they discounted it completely. So I think when you look at the seasonality of the market, look, if the data comes in strong, it means the economy is strong. The market here at a multiple of 16.3 versus the 18.5 for the last 10 years, a lot of this bad news is priced in. You know, the Nasdaq down 30%, S&P still down 18%. We have priced in a decent-sized recession at this point, but stock selection and sector selection is going to be critical. You can't just say wholesale, all in, risk on. You really have to look case by case moving forward.
Okay, RJ Gallo made the same reference. Look through the windshield and not the rearview mirror. Yeah. Fine, you look through the windshield and tell me how they can even begin to consider pausing.
Yeah, well,
based on what data?
Well, I think first and foremost, you look at commodities. They've completely rolled over since June, so that's going to be felt in the economy. You do see the GDP numbers. Basically, if you net out exports, you're looking at 3 consecutive quarters of negative GDP growth. That's material. You look at earnings coming in lower than expected. You back out energy, you got negative earnings growth year on year. So this is only going to accelerate. So what we would be nice is to see some back off in the CPI numbers, some of the inflation prints between now and December to give them cover. They really need cover. They can't say, we're going to predict that the CPI numbers are going to come down in 6 months, therefore we're going to pause. Give them something to hang their hat on, whether, you know, it doesn't appear that it's going to be the jobs report on Friday after the jolts, but we've got 4 major prints between now and December, and maybe they don't downshift in December, and maybe it is the meeting afterwards, but he did effectively toggle and say, if not December, then the meeting thereafter, in which case people can start to see the light at the end of the tunnel, and the terminal rate, maybe it's not 4.6, maybe it's 5. But so long as inflation expectations, the 5-year break-even stay anchored at 2.6, I think they'll be able to downshift sooner than everyone thinks, and certainly in the first quarter of next year.
As we've been talking here, the losses accelerating. Dow now off 351 points. Nasdaq off nearly 3%. All right, Tom Hayes, thanks so much for joining us in studio.
Thanks for having me.
Michelle?
All right, well, let's break down some of the biggest takeaways from the Fed's press conference today with Yahoo Finance's Jen Schoenberger, who was attending there. So, Jen, what were your big takeaways?
Good afternoon, Rochelle. Fed Chair Powell laying the groundwork to begin slowing down the pace of rate hikes, though he says he believes rates now need to move higher than previously forecast. He says the Fed is going to start talking about potentially slowing the pace of rate hikes at the next couple of meetings, and will have a discussion with other Fed officials at the start of next meeting. Take a listen to the chairman.
I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last 2 press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
And you heard Fed Chair Powell saying that the pace of moderating rate hikes isn't as important as how high they could ultimately take the Fed funds rate. He says the job is not done on inflation. In fact, inflation hasn't come down, and it's pretty much where we were a year ago. He says it's premature to begin thinking about or talking about pausing rate hikes, and that we still need to get to a sufficiently restrictive level on rate hikes. So he doesn't also think that we have over-tightened, or that the Fed has over-tightened at this juncture. And again, the Fed raising rates by 0.75 of a percentage point this afternoon to a new range of 3.75 to 4%. So Fed Chair Powell standing hawkish at this juncture. Back to you.
Certainly sounds hawkish, and that certainly seems like what the markets believe at this point with the losses that we're seeing across the board. The S&P off just around 2% right now. Jen, what stuck out to me was some of the commentary that he made on the labor market, once again reiterating that the labor market is extremely strong at this point, that demand far exceeds supply. And then also consumer spending. When you said consumer spending showing modest growth, fiscal headwinds haven't really restrained spending up until this point, and all that points to a more hawkish Fed in the future.
Yeah, I mean, certainly the Fed chair believes that the job market does remain strong. pointed to a number of levels there, notably that the unemployment rate remains low, job gains continue. You saw the JOLTS data. And so that really gives the Fed more room to raise rates without causing a deep recession. And he says that he and the other Fed officials are hopeful that cooling the labor market will not mean that we ultimately have layoffs, but more just fewer job openings and those sorts of junctures to try to bring down the level of tightness as opposed to an outright layoffs that would be akin to what you would have during a recession.
Certainly a ways to go with unemployment rate at a 50-year low. All right, Jen Schomburger, great job. Thanks so much. Well, there's plenty to come here on Yahoo Finance Live. After the break, investors have more direct access to treasuries, but find out what strategy you should employ following today's Fed decision. The CEO of Dine Brands tells us how Applebee's and IHOP are succeeding despite recession fears. And earnings from Etsy, Qualcomm, Robinhood, and Roku are all on tap. We'll bring you the numbers as soon as they break. Don't go anywhere. The Federal Reserve announcing another 75 basis point rate hike today. But what does this hike mean for investors and their bond portfolios? Joining us now to discuss is Alex Morris, FM Investments President and Chief Investment Officer. He joins us as part of our weekly ETF report brought to you by Invesco QQQ. So, Alex, when you take a look at the reaction that we're seeing play out in the bond markets, yields on the 10-year Treasury moving to the upside once again right now at 4.10. What's your takeaway, I guess, from what we just heard from Powell and what this means here for investors?
Well, I think the chairman makes a good point. None of us have a crystal ball. I read the statement before coming here, and everything looked fine until the press release happens. And I think it's pretty clear rates are going higher, and they're going to stay there for a while longer. And long term, I think the Fed is making clear they will get a handle on things. So things will come back to normal. It's just going to take a while. And that's more or less what we should expect. These things don't happen on a dime, and when they do, we all get very nervous and overly excited.
So then, Alex, for retail investors who are wondering how they should be approaching treasuries right now, talk about the ETF and some of the ways that they can get into this, perhaps if they're a little bit risk averse.
Sure. So first of all, we built the ETFs because investing in treasuries is a tried and true strategy, but yet remains stubbornly difficult for most investors, retail advisors and otherwise. They trade in fractions, they have messy cash flows. They're not as simple to trade as stocks for a variety of reasons. And we built these single security, single treasury ETFs to make that much easier. You know, folks start looking at the yield curve and they start looking at all the various issues, and it becomes very complicated very quickly. So as you start to look at how do you want to approach this, you know, you want something as security of a treasury, but you don't want to make a mistake in how you invest in it. So we built access to the most liquid, most straightforward treasuries today, which are the on the runs. Folks who are really looking for short-term havens really should look at something on the shorter end of the curve, which is for us the 90-day product. And those who want to take a much longer-term view on the economy and where the Fed will ultimately land things should look towards the farther end of the curve, which for us is in the 10-year product.
So when you take a look at demand right now for these funds, what we're seeing playing out, given the fact that it is such an uncertain environment, I guess if people are second guessing what they should be doing when it comes to investing in treasuries, what's one or two things you would advise them to take into consideration?
The first thing we tell everyone is this too shall pass, right? So not to fall off an long-term asset allocation or long-term game plan. You know, timing the market never really works terribly well. But if you're more worried about short-term movements, stay on the shorter end of the curve, you know, continue to remain invested, but don't think this is the opportunity to try to outrun the market. You won't be successful, and if you do, it'll probably catch up to you pretty quickly.
And Alex, you said that treasuries are, quote, finally interesting again. Talk about this period that way and give us some context given how we've historically seen the market move.
Sure. So for the last little pre-2008, treasuries had a long history of being somewhat elevated. Then all of a sudden we entered a decade of zero interest rates, which is something that hadn't really been seen or thought of before. And many investors have come up and gotten used to, you know, relatively low-cost capital that can fuel all sorts of things in the bond market in new and interesting ways, as well as the equity markets, which we certainly saw in the past decade. Now as rates go up and we look backwards, you know, 20 years ago, rates were higher than this, and certainly in the 80s, substantially higher. So now as we move rates up to try to destroy some demand, as Chairman Powell made very clear, now we have to decide how do we get access to yield as well as have some negative correlation, at least historically, to the equity markets. Traditionally, that's been treasuries. Certainly credit spreads have started to widen but haven't cracked yet, which is still a good sign for the bond market. But for those who have been risk on and now are looking for a safe haven, treasuries have traditionally been that location to go to, and we built products to make that easy to access.
Access certainly important, especially for retail investors trying to get a handle on all these movements. Alex Morris, thank you so much for joining us this afternoon. All right, coming up, Paramount is generating a lot of buzz on Wall Street today, but that's not a good thing. We'll tell you why shares are falling next.
Now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Fed Chair Jay Powell also saying it's premature to talk about pausing the rate hikes here. We're seeing that reflected in the markets this afternoon with just about 18 minutes to go until the closing bell. You're looking at the Dow off 348 points. Nasdaq, the worst performer of the three major averages, off just around 2.7%. Jared Blickery has a closer look at the big board of some of the selling that we're seeing as a result of what we just heard from Powell.
That's right. Let's go through some of the market movements here. I think it's instructive to view what happened first and then what happened next. At 2 p.m., we got a bullish tilt to the markets, and that's based on expectations that the Fed might eventually, pare back the blistering pace of rate hikes. But Powell put a quick end to that early on in the presser. And you got to think that the Fed is actually doing its job here. The Fed doesn't want to see stocks higher on a day when it's contemplating or at least signaling that it might back off the rate of rate hikes here. And that's what we're getting. So the S&P 500 down 2%. I'm going to go through some other markets here. Volatility is up. You can see the VIX. The VIX is actually net down from that time period. And so that's pretty interesting. Going to make a note of that. 5-year T-note yield did drop on that announcement, and then it basically came back to the entry point. And then the 10-year T-note, it's actually higher based on the 2 p.m. print that we got. Finally, here's the 13-week T-bill rate that tracks closely what the Fed's short-term, the Fed funds market is doing right now. Now, the U.S. dollar index ended higher as well. So all of this is signaling that there might be some more risk aversion in the markets, although we're getting a conflicting picture here between yields and the dollar. I think we're going to see that sorted out over the next 24 hours. Also want to show you what's happening in Bitcoin, because this would be the supreme irony if Bitcoin actually led the way. Didn't fully participate to the upside, wasn't as up as much as some of the equities, and now it is given those back. So Bitcoin foretelling the future that maybe we have to wait a few more announcements before we're going to get that final pivot that everybody's been expecting. That would be some irony right there. Let me just close with some of the sector action and some heat maps that we're looking at. Everything in the red right now. I was talking about the hit that we were taking to yields. Normally that would benefit some of the mega caps, but not today. We're seeing consumer discretionary, tech, and also communication services down more than 2%. So again, it's probably too early to parse out what these movements quite mean. Going to take another day or so, but in the meantime, stocks are down. Maybe Chair Powell did his job.
I guess so. Even energy down 2.2%. Wow, good stuff. Jared Blickery, appreciate that. All right, Fed Chair Jerome Powell addressing the state of the housing market in the wake of today's interest rate hike.
The housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very carefully, much more carefully managed by the lenders. So it's a very different situation and doesn't present doesn't appear to present financial stability issues.
Rising mortgage rates have soured housing demand recently, but there is some good news, a glimmer today, if you will, with the 30-year fixed falling a bit to 7.06% from 7.16% a week ago. That's according to the Mortgage Bankers Association. Now, rates are still near 2-decade highs, and we also saw applications decreasing for the 6th straight week. And now, lenders and other companies in the industry are reeling amid the broader slowdown. CNBC reporting Wells Fargo was processing about 18,000 retail loans early in the quarter, down almost 90% from a year earlier. And mortgage staff at the bank are bracing for layoffs. It's not just the big lenders. Opendoor, a home flipping company, announcing layoffs of 18% of its employees. That amounts to roughly 550 people. And the stock is down 4.5% on the news and extending losses in the wake of the Fed decision. And look, when we bake in the 75-point hike and the fact that it is, again, premature to think about pausing, you got to factor 30-year fix driving up at least a quarter of a point. They're going to continue to go up, and the housing market will continue to slow. And Rochelle, that probably is going to cost thousands of jobs in the mortgage industry.
I mean, and you referenced that CNBC article. Obviously, when you have this slowdown, think of where we were during the pandemic-fueled boom in the housing market. It was just a matter of time when you now see the downside of that. You're also seeing the higher mortgage rates. And so they're obviously far off their peak. And we know that they began cutting workers in April, Wells Fargo did. And so a lot of people, some of the sources mentioned in the article there, saying that some of these, though, have been a mix of some voluntary bankers sort of seeing the writing on the wall and moving on to other positions. So kind of clouding the picture as to how much of this has been voluntary versus how much of these layoffs had to be done. Now, we know that last month, CFO Mike Santomassimo told analysts that we expect it to remain challenging in the near term. It's possible we have a further decline in mortgage banking revenue in the Q4 when originations are seasonally slower. So certainly bad timing on top of everything else. But obviously a very tough time there, and a lot of people at Wells Fargo concerned about job security, Shauna.
Yeah, and I don't think this comes as a huge surprise given the massive slowdown that we've seen in the industry. We've been talking to a number of guests about what we are seeing play out in the mortgage industry specifically, and how challenging it's likely going to be over the coming quarters, given the fact, what we just heard from Jay Powell today, that he is going to remain hawkish. Or it's still premature to talk about pausing rates or even any sort of pivot. So certainly it's going to be a tough time ahead. There was a recent data out from Black Knight saying that just 133,000 U.S. homeowners at this point can save money by refinancing at today's rates. And that's down, Dave, from a peak of over 19 million in late 2020. So really that really just illustrates how dramatically this industry has changed over the last year and a half or 2 years, from the peak of the pandemic to this, I don't want to call it a bust. That almost seems a little bit too aggressive at this point, but a significant slowing that we are seeing play out in the mortgage industry and layoffs as a result.
And Powell said they're looking for some softening in the labor market. If they're looking really hard, they should look at the mortgage industry. That's where you'll see the beginning of some cracks in the labor market. Coming up, Electronic Arts voicing optimism following its latest earnings, much of it having to do with one of the company's most popular video game franchises. Stay tuned.
It's time for Triple Play, the 3 stocks that we're watching in the last 10 minutes of trading. We've got MoneyGram, Paramount, and Electronic Arts on deck. Now, my pick is person-to-person payment service MoneyGram, the company debuting a feature allowing US consumers to trade and store Bitcoin, Ethereum, and Litecoin via its mobile app. Now, the company joins others attempting to bring real-world cryptocurrency and blockchain use cases to life for everyday consumers. In a statement, Alex Holmes, MoneyGram's chairman and CEO, said, "Cryptocurrencies are additive to everything we're doing at MoneyGram. MoneyGram enables instant access to over 120 currencies around the globe, and we see crypto and digital currencies as another input and output option." Now, this isn't MoneyGram's first foray into crypto, but it's moving more conservatively this time, with just a few more established crypto tokens. Its previous partnership with Ripple came to an end last May after Ripple got sued by the SEC in December of 2020. Of course, Coinbase recently joined a number of groups in arguing that the SEC's case threatens the broader industry. So still a lot of volatility to be had here, but MoneyGram, though, still pressing ahead here, Shauna.
They're pressing ahead. It's not doing a lot for the stock today, though. When you take a look at the market, the reaction, although obviously there's a bigger macro picture going on in today's market action, but certainly if you take a look at the stock, down just a fraction here, so not a lot of excitement. I think potentially MoneyGram's move here, you can make the argument that it could maybe be a step forward into making Bitcoin cryptocurrency, taking that mainstream, giving access to more and more users in terms of that. There was a recent Deloitte survey saying that there certainly is appetite out there for users to be able to get access to cryptocurrencies and use that as part of their transactions. 3/4 of retailers plan to accept either cryptocurrency or stablecoin payments within the next 2 years. 3/4, 75%. That number stuck out to me because I thought it was a bit high when you think about how many transactions are actually done with Bitcoin or other cryptocurrencies today. All right, my pick today is Paramount. It's a top trending ticker on Yahoo Finance. Look at that, losses of just over 12%. Shares are sinking after revenue missed Wall Street estimates. A number of headwinds facing the company, including the rise of cord cutting and a slowdown in the advertising market. Now, sales from its TV media segment falling 5% from the previous quarter to $4.9 billion, and advertising revenue dropping 3% to $1.9 billion. Paramount Plus was a highlight for the quarter, though. 4.6 million new subscribers were added. That was actually better than what the street was looking for, what many analysts were anticipating, bringing its total to 46 million customers. Dave, comparing that to its larger competitors, obviously just a fraction of subscribers, but they are headed in the right direction.
They are. Variety, though, reporting some layoffs coming as they consolidate with Showtime. Some positives coming to Paramount Plus. You've got Top Gun and Smile coming to the format by the end of the year. And, of course, that Walmart Plus subscription half price. That includes a free Paramount Plus subscription, so some catalysts there. My play is EA, Electronic Arts, shares up on its latest earnings report. Despite a post-pandemic pullback in gaming and currency headwinds, EA did beat on revenue and EPS. The company touting a record-breaking launch of FIFA 23 with over 10.3 million players within the first week, signaling the biggest launch period ever in EA Sports FIFA franchise history. They added this year's title has been played in more than 200 nations worldwide. The CEO, Andrew Wilson, saying the entire global football community across our ecosystem will benefit from the unique holiday timing of the World Cup, and that's because of the change of the schedule because of the heat in Qatar. It's now just 18 days away, by the way. They did lower their annual bookings forecast to between 7.65 and 7.85 billion from 7.9 to 8.1 billion. Overall, the gaming market is expected to grow just 2% in 2022, so you're really seeing some shrinking there. Earlier this week, EA also announced a 3-game deal with Marvel, which will start with an Iron Man game. The stock up just about 2%, was up much higher, but like the rest of the market, pulled back a bit, down about 4% year to date, Michelle.
I mean, I will say, you couldn't have asked for better timing if you partnered EA, FIFA, and the World Cup. You want to talk about a match made in heaven? I'm super excited for the World Cup. You will hear me talking about it constantly. So yes, a boon there, obviously. Someone even on Twitter challenged me to a FIFA match. Well, I was like, I don't even play the game. Why am I even in this? But
oh, you don't play?
I gotta try. I don't even play, but I might, just out of spite.
All right. I'm very excited for the World Cup, too, getting underway very, very soon. All right, well, coming up next, we are counting down to the closing bell on Wall Street. We'll be right back.
All right, just a few minutes away from the closing bell on this Wednesday Fed day. Jared Blicker here to break down the market action. What are we seeing, sir?
A lot of red, so maybe the Fed is doing its job if it doesn't like to see green markets on Fed day. Who's to say? Nasdaq down over 3%, so is the Russell 2000. I'm going to show you inside the Nasdaq 100. Mega caps really taking it on the chin here. Apple down more than 3%, so is Microsoft, Alphabet, Tesla down 5%, Amazon 4%, Meta 4%, Costco 3%, and the list goes on. And let's take a look at the sector action to see what's going on. These are the tech-heavy and mega-cap-heavy sectors that we see down here. Utilities, the least dirty shirt in the laundry basket. That's still off 0.9%, followed by financials and healthcare. So all in all, not the best banner day for equities. We'll have to see what happens tomorrow. But here is our leader in sentiment index, not index, but markets. We see KWEB, that's a Chinese internet ETF. You can say divorced from the current day. Other than that, it has been a weak day for a lot of these fringe market. Let's take a look at the travel sector. And we are here for the closing bell.
Stocks ending the day in the red as we wrap up the trading action post Fed Chair Jay Powell's presser there. And look at those losses ending at the lows of the day. The Dow off 506 points, S&P off just around 2.5%. Nasdaq, the biggest laggard here in today's action, off just nearly 3.5%. A lot of those rate-sensitive stocks, many of them tied to the tech sector, leading today's sell-off. And the market's really focused on the fact that Fed Chair Jay Powell saying that it is too premature to think about pausing rates, saying that there is still plenty of ground to cover. Ongoing rate increases seem appropriate at this point. So let's talk about what this means for the markets going forward. For that, we want to bring in Sam Stovall. He's CFRA's research chief investment strategist. And we also have Michael Kushma, Morgan Stanley Investment Management Chief Investment Officer of Broad Markets Fixed Income. Sam, let me start with you. I guess just your reaction to what we heard from Fed Chair Jay Powell and the selling that we saw as a result.
Well, Shauna, I guess I'm not too surprised because the Fed has been telling us for a while that it does not want to make the same mistakes that it did back in the 1970s. It doesn't want to end up pausing or even pivoting before they know that inflation is under control. And we've also seen over the last week several reports, whether it's Q3 GDP, construction spending, or the expectations for Friday's jobs report, that the Fed still is engaged in an uphill battle with inflation.
And Michael, we heard from previous analysts, they commented that the markets were just a little bit too enthusiastic about what they thought they were going to hear from Jay Powell. And as we see from the sell-off that we saw today, that seemed to be the case. What is it that they are missing when it comes to this picture right now?
Well, I think that Jay Powell said something along these lines in his press conference today. There's three elements to monetary policy: how fast, how high, how long. And we hadn't even gotten to the concluding how fast they were going to go. Only today that he's really start talking about, yes, at some point we're talking about slowing down. So not even yet finished with phase one, which then is, well, how high do we have to go? So they're not even clear about how high they have to go. And then they're certainly not clear how long they will have to stay. I did think the emphasis on not wanting to, they want to take into account the long lags on monetary policy does suggest at some point they will slow down because the monetary tightening so far will impact the economy, but it's premature to talk about slowing down yet.
So to Michael's point, Sam, how high do you have to go? Do you think we're talking about a Fed funds rate around 5? And do you factor in hikes through March?
Yeah, Jared, I think we're going to see the Fed funds rate right now. Our target is between 5 and 5.25, and that number itself is suspect to being raised over the coming months. Our belief is that the Fed will raise rates by 75 basis points in December, and then we'll engage in another 50 basis points in the February timeframe. So the Fed's not done yet, and I think it's going to be in the 5s before we hit a terminal rate.
Sam, what about the risk then of the Fed going way too far? I know Powell saying at least up until this point, he doesn't think that they've made the mistake of tightening too much. But if in fact we do see another 75 followed by another 50, where does that put us?
Well, I think that even from the very start, at least a mild recession was something that investors had to anticipate. Anytime that the year-on-year percent change in headline CPI exceeded 6% going back to the late 1940s, we ended up with a bear market and a recession. That bear market ended up being deeper and lasting longer than average bear markets without recession. So just the fact that the Fed was already 750 basis points behind the curve, meaning that normally Fed funds rate is higher than that year-on-year CPI number at the start of rate tightening programs, but this time around things were reversed by that 750 basis points.
So, Michael, by erring on the more hawkish side with these comments, how should investors be thinking about this period between now and the next Fed meeting?
Well, I think it's as the Fed has said multiple times, they've given up on forward guidance. The world is too uncertain. We don't know what's going to happen, so it's very data dependent. We'll have to see the flow of data. However, in order to be more confident about the disinflationary trajectory, they'll have to see multiple months of improvement. Between now and December, you don't have a lot of time. So even if we get a better inflation print this month and early December before the next Fed meeting, it might well not be enough. It may be enough to keep them at 50, but to go less than it, I think it's not feasible at all. So 50 is sort of the minimum next month. But going forward in 2023, it does become extremely data dependent. And right now, the momentum in the U.S. economy is a bit on the upswing, and job growth is slowing, but at a fairly slow pace, such that the unemployment rate is likely to stay low. So again, the danger, if they prematurely slow the pace of tightening and then move maybe to easing too soon, the economy will just reaccelerate again, and they'll be in a worse position at the end of next year.
That's a good point. And Sam, circling back to your 75 and 50, how do you invest into those conditions?
Well, I think you have to continue investing from a defensive perspective. Looking at my momentum model, basically it is the old standby of staples, healthcare, utilities, and also to energy. And whereas you want to be avoiding those groups that tend to get hurt the most by rising rates, which would be your growth areas, communication services, technology, real estate. So right now it's, playing it close to the vest with defensive sectors is probably the best way to go.
Sam Stovall and Michael Kushma there. Thank you so much for joining us on this Fed Day with your market breakdown. Dave?
Thanks, Michelle. An earnings alert here. Qualcomm has now reported. Dan Halley is here to break down the numbers. You can see shares moving to the downside about 7% after hours. Dan, what are we seeing?
Yeah, so they met expectations on revenue. They came in at 11.39. The expected was 11.4. So you can, kind of round up there, and they're meeting it. But as far as adjusted EPS, they missed. They came in at $3.11 versus expectations of $3.13. But the big deal here is for the next quarter, their Q1. They have expectations for adjusted EPS of $2.25 to $2.45. The expectation, though, from Wall Street was for them to announce $3.40. That's a big difference. So that's why we're starting to see, or potentially why we're starting to see, that stock price start to slip now, down around 5%. And part of that has to do with the smartphone market and how we're seeing weakness there as far as people not necessarily needing or wanting to go out and buy smartphones, making these big kind of pricey purchases when the economy is, we're hearing so much about a potential recession. And I think that seeps down to the average consumer. And so they kind of pull back on that kind of spending, especially on something like a smartphone where, look, if the one in your pocket works, you don't necessarily need a new one. It's more of a luxury buy when you don't have those kinds of issues. So I do think that that's probably something that we're going to continue to talk about. Obviously, Apple had a lighter quarter than expected for their iPhone sales. So that's a pretty good indicator of how the rest of the industry is doing, especially since, it's Apple.
Hopefully we get a read on if that Apple relationship is going to continue longer than we originally thought, which could certainly help. Dan Halley, thank you. Good stuff there with Qualcomm earnings. All right, Roku has now released its third quarter earnings after the bell. Yahoo Finance's Ali Canal has those numbers for us. And look at that stock, Ali, down 20% after hours.
It's pretty stunning, and it was an interesting story after the market closed, after we got these earnings, because it surged and then it came way down. So let's break down what investors initially reacted to. We had a beat on revenue, $761.4 million versus the expected $702.35 million. Also a narrower adjusted loss per share of 88 cents versus the expected $1.22. So a beat there on both the top and bottom lines. Also a beat on active account growth. But here's the bad news, and that's what's driving down the stock by more than 20%. It's their guidance. The company now sees fourth quarter adjusted EBITDA loss at about $135 million versus the expected loss of $45.5 million. So that's a huge discrepancy that Wall Street is reacting to. Net revenue guidance for the fourth quarter also lower, $800 million versus $897 million expected. And we're just getting news as well that Roku CFO Steve Loudon plans to leave the company in 2023. So this is just a lot of information for investors to digest. In the earnings release, the company said, quote, as we enter the holiday season, we expect the macro environment to further pressure consumer discretionary spend and degrade advertising budgets. Now, advertising is what's been talked about with a lot of these tech companies, especially following the results of Meta, Snap, Alphabet. The state of digital advertising largely in question amid a lot of these macroeconomic challenges. So a lot of near-term headwinds for this company. They have been spending pretty aggressively. They did say they were going to cut back on headcount, but right now investors not too happy there, with shares down more than 20% in after hours.
Quite the sell-off indeed. A big thank you there to our very own Ali Canal. All right, well, stay with us. Coming up, we're taking a closer look at Qualcomm's earnings. The stock sliding on that weak guidance. As you can see, they're off more than 6%. Stay with us.
Let's take a look at Robinhood. Their earnings report just released. You can see shares up just around 2.7% and beat on both the top and bottom lines here for Robinhood. Sales coming in $361 million. The estimate was for $355.2 million, a narrower loss than expected as well, a loss of 20 cents. The estimate out there was for a loss of as much as 31 cents. Transaction-based revenue coming in at 208 million. That was short of what the street was expecting, though. Crypto revenue also coming in a bit light there, 51 million. Estimate out there was for 56 million. Monthly active users totaling 12.2 million. That was a bit lighter than what the street was hoping to see at 13.7 million. Average revenue per user coming in at $63. Estimate out there was for 62.58. So a better reading on there than what we had initially anticipated from the street. But the beats on both the top and bottom line, specifically what we're seeing in revenue, 361 million, better than what the street was looking for at 358 million. That's a big reason why shares are up just over 2% in after-hours trading. Rochelle?
Meanwhile, a different story for Qualcomm, moving downwards there. You see they're more than 7%. That's after reporting fourth quarter results. We have Christopher Rowland joining us, Susquehanna International Group Senior Equity Analyst, to really break this down for us. So as you dive into this earnings report here, what was it that you think was really the problem?
Yeah, there are a confluence of headwinds that they're now experiencing. So they, at the same time as seeing a rapid deterioration in demand, they've also seen supply constraints ease for most of their competitors. So this has resulted in elevated channel inventories that are now going to take multiple quarters to fully get through.
How'd the guidance look?
The guidance was dreadful, truthfully. So we're looking at about 9.6 billion versus estimates of 12 billion. So this is probably the worst Qualcomm guide I remember in multiple years here. They also lowered their overall outlook for total handset volumes from, they were previously at mid-single-digit declines. They're now at low double-digit declines for the calendar year. So pretty dreadful.
Chris, going into this earnings report, you had 165 price target and neutral rating on the stock. You said that this was the worst guidance that we had seen in quite some time. So what does that mean for just in terms of what we could potentially see over the coming quarters? And are you changing your rating because of this?
Yeah, our rating right now is neutral. We downgraded shares last year on a bigger, broader semis downgrade for the entire industry because we were worried about this. We were worried about over shipping. For Qualcomm, this is a fantastic company that is reinventing themselves. We're going to take a fresh look at this after we have this reset overall. But Qualcomm over the next few quarters is going to have to work through this inventory. And if we get line of sight into clearance on that inventory side, we would get perhaps more aggressive.
And Christopher, in terms of where you see the growth story coming, in terms of what's going to be driving growth for Qualcomm, especially after this earnings report, where do you see the opportunities?
Yeah, their biggest opportunity is going to be automotive. They recently, this quarter, held an automotive day, and they have some significant opportunities, for example, ADAS and autonomous driving. That will be a very, very big push for them overall as they continue to diversify outside of just handsets. But in handsets, 5G is not done yet globally. India is just starting to ramp 5G, for example. That'll be a new opportunity for them as well. And then they're moving into RF components as well to compete with guys like Skyworks and Qorvo on that side of the handset as well. So we view that as opportunity for them entirely.
This is stock already down 37% year to date. We were expecting or are expecting some news on that relationship with Apple and how long it may be extended. What do you expect there?
Yeah, if you hear anything, let me know. But the expectation right now is that the internal modem development program at Apple is taking longer. They are going to need at least another year here. And so Qualcomm right now is in the catbird seat in terms of negotiations. They will likely be able to negotiate nice prices for their modem and their 5G modem and content into that phone for at least another year. But we'll see where they go from there.
Chris, we're going to get the earnings call underway very shortly. I guess, what's the number one thing you want to hear from management? I know guidance is your big focus here, this large slump that they are expecting to see in terms of the smartphone industry. But what's the number one thing you're hoping to hear?
Yeah, number one is going to be this handset slump that we're in. What inning are we in? How much of the shortfall here was actually true demand versus inventory digestion? How long is this inventory digestion going to take? And when might we get to the other side of it? Is this a 1 or 2 quarter event, or is this going to last well into the second half of next year? These are the things that are important for me.
All right, we're looking forward to hearing you back after that. Christopher Rowland, SIG. Appreciate that, sir. Thank you. Let's have another earnings alert now as shares of Etsy are moving well up, almost 10% on their Q3 earnings. Yahoo Finance's Ali Garfinkel here with the numbers. Ali, what are we seeing?
Great to see you, Dave. So, we're getting some good news out of tech today. Etsy's popping on that gross merch sales beat. It came in at $3 billion as opposed to the expected $2.9 billion. We also saw a revenue beat, Dave. About 600 million as opposed to the 563.6 million expected. We did see a loss per share at 762, and there were slight misses, right, on active buyers, active sellers, but it's that Q4 revenue guidance, Dave. We've seen so many revenue guidance misses for Q4, but Etsy's coming in within the range between 700 and 780 million as opposed to the expected 744.6 million. So good news out of Etsy today. We'll see if they can keep it up.
Yeah, you talk about another company that desperately needed that good news, been beat down 58% year to date, but up double figures now on that news. Great stuff, Ali Garfinkel. Appreciate that. Coming up right here, shares of Roku have slid by roughly 75% year to date. See what Wall Street expects from the streaming platform for the rest of the year. Next.
Amid a broader market sell-off, Dine Brands ending the day modestly higher after reporting better than expected third quarter results. Yahoo Finance's Brian Sozzi sat down with the CEO of Dine Brands, John Payton, to discuss the key to its brand's success in the past quarter. Take a listen.
We had a really good quarter. Applebee's had its 7th consecutive same-store sales growth. IHOP had its 6th consecutive same-store sales growth. Average weekly sales for both brands is now equal to or exceeding 2019. And that's because our brands are trusted and well known by our guests. You know, in tough times like this, people flock to brands that they trust. And Applebee's and IHOP are about great value. They always have been, and that's couldn't be more important than it is right now.
There's nothing like taking a bad day at work and just having 8 pancakes, John. I mean, why not? Those multigrain pancakes at IHOP are my jam. But take us through each brand. What are you working on with Applebee's?
So Applebee's is focusing on its core menu, really great marketing innovation. So this summer, for example, they partnered with Top Gun, and they partnered with Fandango. And so for every $25 you spent at Applebee's, you could earn a free ticket to Top Gun. And so Applebee's does really creative marketing like that. I think they've got the best television in the business. They really focus on nostalgic music, and you know, this is a time where they're really attracting their guests, and they're also very focused on promotions right now. You know, really rich promotions. So at Applebee's, it's 12 shrimp for $1 with a steak.
Wow,
you know, and
12 shrimp for $1?
Yep, with a steak. You know, and that's the kind of, you know, value-added promotion that our guests need right now, right?
Really
because you know, it's tough times.
So you mentioned tough times in that type of promotion. Is that, I mean, have you seen sales slow down because of a promotion like that, or you know, what made you run that?
We run promotions like that because we know, right, with the inflation the way it is and the cost of living, particularly for our guests, you know, it is a tough time right now. So our brands have been through this before. They're both positioned as, you know, value-oriented brands in their category, and they know what's needed at times like this. So that promotion for Applebee's, IHOP is just finished up 2 by 2 by 2, which is 2 pancakes, 2 proteins, and 2 eggs for $5. And both of those promotions drove traffic, which is why we had quarter-over-quarter same-store sales growth.
Is the environment so tough that you're going to have to continue these promotions into the holiday season?
The environment is tough, right? And so, you know, we really lean into the love that people have for our brands, and the promotions, you know, will continue. You know, but I should also say that we're working on things that drive the longer term, right? So at the same time, we're very focused on our consumer and how they're feeling right now. You know, IHOP just launched its loyalty program, you know, the International Bank of Pancakes, which is that's really clever, right?
That is clever.
And you can earn pan coins, and you redeem them in the stack market. And so, you know, we launched that program in April, and we've already enrolled 3.5 million people, and that's 1 million more than we thought we would do at this time, which really speaks to, you know, the power of the brand and the need for loyalty, you know, and that's the way we're really leaning into growing the brand.
If you're running promotions like that, does that mean you've seen a peak in inflation?
Yeah, there's good news here. So through the first half of the year, the cost of goods, food and goods into our restaurants was up about 22% in the first half of the year. The back half of the year, Applebee's will be more like 14, 15%, and IHOP is just down a couple of points because eggs and wheat, which drives pancakes, are still very high. So, you know, we think it's going to allow our franchisees to, you know, start to edge back toward more historical price increases, which are about 2 or 3% a year, versus the 7 to 11% that they took in 2022.
Is finding workers still a challenge?
Good news there as well. So for the last 4 or 5 quarters, we were stuck at about 90% of what we would consider full staffing. And in the last couple of months, it's 92, 93%. And we're finding that even the hard to fill jobs are getting more applicants, like cooks in the kitchen. And so we're moving from recruiting to, it's all about retention now. And our franchisees are getting very creative to make sure that they retain their new team members. They're offering signing bonuses, retention bonuses, recruiting bonuses. They're extending 401k to a broader portion of their team members. Tuition reimbursement. You know, so it's all about keeping the people we've got.
I don't want to get too wonky on this, but I recently talked to the team at Chipotle, and they've started to put in robots into their kitchens. Do you see a place in your restaurants for that?
We do, right? So, we talked about staffing, and, we're assuming that maybe 92, 93% is the new normal. And at the same time, we need to help our restaurants become more productive, particularly as costs grow as well. So we're looking at, we're testing a robot in one of our IHOPs that can serve food.
Really?
And then
Does it flip pancakes?
And not yet, but that's coming. And take the dishes back. It's like a little R2D2. And guests love it, right? Because it's clever, but it makes servers more efficient. We're looking at robotics in the kitchen, about for fryers to automate frying and things like that, as well as server tablets. We've got server tablets at 500 of our Applebee's, which makes servers more efficient. They turn more tables, they earn more tips, and so automation and robotics is a big part of having our restaurants be more efficient in the future.
When does Applebee's get back to opening up restaurants?
So Applebee's just finished last year a purposeful and deliberate 3-year refinement of the brand. We closed about 300 restaurants that were, where the market had moved away from them or they were unprofitable. And so now we've got a core of about 1,600 restaurants that are, in great markets, are profitable and are super strong. And so, we envision transitioning to net growth starting in next year or early 24.
And IHOP too?
IHOP is a real success story. So we're going to open 50 plus restaurants this year. And that's during, a time when the cost of constructing a restaurant has really become more expensive. So our franchisees are leaning into IHOP because of the success we've had and their belief of it in the future.
Thanks to Brian Sazi and Dime Brands CEO John Payton. And Dave, interesting stuff there because he was very optimistic in terms of what we could expect here from the company going forward, but certainly a number of headwinds. And what he said about labor really highlights what's going on so many levels in terms of the trend that we're seeing play out in the economy and the inability or tough time that so many companies are having getting people through their doors.
Per usual, we are aligned on our interpretation of an interview. Yeah, it's in a fascinating dynamic in the restaurant industry right now. He's talking about retention. They used to have recruitment bonuses. Now they have retention bonuses. They're talking about tuition reimbursement. I've talked to a number of restaurateurs that have already built and are ready to go with beautiful restaurants. They are hiring recruitment firms, Rochelle, just to try to staff restaurants. And you have a lot of power if you are that employee, if you can manage a restaurant, to go in and call your own shot and raise your wages. It's a really bad dynamic if you're John, but if you are looking for a job in the restaurant industry, now is the time.
I mean, it's been a tough dynamic because you can go to restaurants around the DC, Maryland area and you just can't get a table because there just isn't the staffing. So it's good to see them investing on that front. I thought it was very interesting that 12 shrimp for $1 if you buy a steak. I mean, people are looking for a good deal. So clearly trying to make everyone happy. They're trying to make the workers happy. And of course, clearly the customers as well. So yeah, a really interesting interview there.
Let's talk a little bit more about some good deals that you could potentially get because we've been focusing on this inflation story so closely, especially today in the aftermath of the Fed decision. As many food giants and grocery stores raise prices, one is doing just the opposite for Thanksgiving. Aldi is going to match 2019 prices for holiday staples. Starting today, prices will be cut 30% from where they are now. And Rochelle, this news coming at a time when it is needed for so many Americans. Turkey costs are projected to rise 23% this year. Wells Fargo saying that the overall cost of a Thanksgiving basket is going to cost 14.9%, basically 15% more than it did a year ago. So the fact that Aldi is coming out offering these prices is same at what we've seen just around 3 years ago. Certainly a move that is welcome from so many of their customers.
And we know that the avian flu obviously took a toll on the turkey population, which then in turn is driving up prices. Now, this Thanksgiving price rewind promotion, as they're calling it, it's not just on your turkey, it's your appetizers, desserts, sides, beverages, all discounted up to 30%. Now, Aldi is a brand that's very well known in most parts of Europe. But no, a lot of people, we were discussing this earlier, haven't ever shopped at Aldi before. So perhaps a good chance to sort of get in the door there once you see prices discounted this much.
Yeah, they're a private company. That's how they can do that. They don't have to worry about shareholders, right? But, Gen Z, the popular trend right now that you're seeing, of course, we're also on TikTok, is they're saying it's pizza for Thanksgiving dinner. They're looking to save a few bucks. And back to what John Wise told Brian Sazi, food inflation at 22% in the first half, down, still up, but down to 14, 15% in the second half. So at least a little bit of good news on the food inflation front.
Some relief, and we got a ways to go there. All right, coming up next, shares of Roku plunging in extended trading following the earnings that we just got. We've got analyst reaction when we come back.
Earnings alert now. We're watching shares of Roku plummet after hours. Down 18% now, sliding on weak guidance. That's a stock already down 75% year to date. Tom Forte, D.A. Davidson, Managing Director, Senior Research Analyst, is with us. Tom, good to see you. What is moving this stock down so far? What do we learn?
Yeah, so I think what we're seeing is that the weakness in digital advertising is extended to connected TV. So it started kind of with Snapchat, then it moved to Meta platforms, then it moved to YouTube, and now clearly we see that it's hitting Roku, and I think that's what's weighing on shares after hours.
And what about competition in this space for Roku? Obviously, you have Google, you have Microsoft, other companies who are really vying for these over-the-top devices and streaming services as well.
So that's a great question. Here's how I think about it. So Roku's always had very tough competition. So it's always kind of been swimming with the sharks, if you think about it that way. The good news for Roku and everyone you just mentioned is that you're seeing all these linear television ad dollars move online. You see Netflix with a $6.99 advertising-supported service coming out. So it isn't that the challenge right now is that the money isn't moving online fast enough. And what you're seeing for Roku is the scatter market's kind of drying up. So the short-term advertising market for Roku is the challenge.
Tom, going back to what you just said there, just in terms of the advertising market here, clearly a massive challenge in the letter to shareholders. Roku saying that we expect these conditions to be temporary, but it is difficult to predict when they will stabilize or rebound. Any insight or prediction just in terms of when you see this picture potentially improving for Roku?
So two things. One, I had at one point thought that political advertising on Hulu, on Roku, or things of that nature could kind of be a stopgap, but clearly that's not the case. Number two, I think you point to the early days of the pandemic. Digital advertising went negative in April of 2020. And then once we realized the economy was in better shape than we thought it was in, digital advertising rebounded pretty significantly. So I think at this point in time, when will we have the same conditions? When will we start thinking that the economy's headed in the right direction? And that's when I think the digital advertising dollars will return. And that's when things will improve for Roku. Hopefully that'll be sometime in 23.
So there's the when and there's the what is the catalyst, Tom. I know they're selling now smart home products in Walmart. It's got an app with iCloud video recording. How significant is that, or what else is there that would be the catalyst?
That is very significant. So the only challenge for Roku there is if you think about the profitability of the hardware. I've got a TCL Roku TV behind me, a Roku soundbar, things of that nature. Generally speaking, they're selling the hardware at break even. And they make most of their money on the advertising front or on their operating system for smart TVs. So I think it's encouraging that they have the brand to extend essentially into smart home, but that won't be a huge needle mover from a profitability standpoint. Really need to see the advertising resurgent there to drive profits.
So Tom, what's the monetizing story here for Roku?
The monetizing story is that you have this tremendous opportunity. Viewership for OTT now is ahead of broadcast TV. It's ahead of cable television, but the advertising spend is still skewed toward linear television. As that moves over time toward over the top, that's a tremendous opportunity for Roku and for others. And I think that's why I'm still bullish here despite the near-term headwinds.
Tom, Steve Loudon, CFO of Roku, leaving the company. He's been with Roku, been CFO there since 2015. Roku without Loudon involved. Any concern to you?
Steve's been an excellent CFO, but if you looked at the hires actually they made intra-quarter, they're getting a lot of high-priced and high-quality talent to come to Roku to advance the programming efforts, to advance proprietary content. So I'll certainly miss working with Steve. I think it's a great opportunity for the next CFO, but the good news is that they're still getting great executives to join, despite, as you pointed out earlier, that the stock's down 75% year to date.
Another 17% plus here in extended trading. All right, Tom Forte, always great to have you. Thanks so much for reacting to these earnings release here with us. All right, coming up next, a new index revealing which city is a top emerging housing market in the U.S. The mayor of that city tells us what makes his town so desirable. Next.
The Wall Street Journal and Realtor.com collaborate on the Emerging Housing Markets Index, which considers data on return on real estate investment, economic health, and quality of life. And with a population just over 70,000, Johnson City, Tennessee came out on top. Johnson City Mayor Joe Wise with us now on the economy and the housing market. And good to see you, Mr. Mayor. And the obvious question is, the Wagon Wheel song by Darius Rucker, or number one on the Wall Street Journal emerging markets list. What was a bigger deal there in Johnson City?
Well, we've had more time to think about the Wagon Wheel song, but we certainly find them both to be exciting references, I suppose.
Mayor, what do you attribute all this excitement to? The fact that people are coming from all over the country, it sounds like, having interest in your relatively small city. What's driving that?
I think there are a number of factors that have contributed to it. We've, as a city, made a sustained investment in infrastructure, and particularly the deployment of direct fiber to every residence and business in our community to provide 10 gig internet. So that makes it a place that people can work remotely in a time when people are contemplating working remotely. But then alongside of those things are quality of life considerations. We're home to East Tennessee State University that offers doctoral programs in medicine and pharmacy and nursing and physical therapy and many other allied and health science fields. And so with that comes a parallel medical community with a local children's hospital, a level 1 trauma center. And so folks can come to Johnson City and find in a relatively modest sized town the resources, the services, and the quality of life features and amenities that you might associate with significantly larger cities than Johnson City.
Yeah, Mayor, we just had the average price, the median home price in your city up on the screen there, $379,000. That's up from $350,000 just 3 months ago, up significantly on a year-over-year basis. What do you make of the dynamics that's playing out in the housing market in your city, and what we could potentially see to prices here in the coming quarters?
Well, that's something we're mindful of. Every good news has some consequences that may not always be favorable. And so we're aware of the potential risk to affordability and potentially the concerns around the quality of life that might be changed if we had a significant influx. And so as a community and as a city, we're making very deliberate efforts to look at growth management and making sure that when all the dust settles, the things that made Johnson City desirable as a place to live remain true of Johnson City for those who live here now and those who might live here in the future.
How did the pandemic actually boost the economy, boost the real estate of your town?
Well, I think remote work. We began the process of deploying the 10 gig internet through our local energy authority years ago, before we knew there would be a pandemic in 2020. And so really, we were readying the capacity for remote workers, particularly long before the culture had an inclination to really be pursuing it the way we've seen over the last several years.
And once people return to office, how do you make sure people stay and don't leave Johnson City?
Well, I think part of that is proximity. We're at the crossroads of Interstates 26 and 81. We are within about a day's drive of virtually everybody in the eastern half of the United States. And so for a lot of professionals, a community like Johnson City provides them the best of both worlds. We're only a few hours from places like Charlotte or Nashville or Atlanta. And so if your job doesn't require you to physically be in a specific location Monday to Friday, which lots of people's jobs do not, this might just be the right fit.
Based upon the video I'm seeing, sir, I have got to come visit Johnson City, Tennessee. Mayor Joe Wise
will be our guest.
That. We will come see you. Thanks for being with us. All right,
Thank
Shauna,
you.
let's take a look at what's trending after hours.
I'm going to take the trip with you. Those
Let's
pictures
go.
look nice, didn't they?
Let's do a road show in Johnson City.
I like it. All right,
Bring
we just have to
Darius
run it by
Rucker,
all the
of course.
producers. Exactly. All right, let's take a look at some of these after-hour movers here. We have Roku, Qualcomm, Etsy, Booking, and Robinhood. Kicking off with Roku. Losses there pretty dramatic following that much worse than expected, a wider than expected loss, I should say here, for the coming quarter. The stock off just around 19% as a result. Adjusted loss this quarter may come to $135 million. Putting that in perspective, that's about 3 times what analysts were expecting to hear from Roku. Obviously, the slowdown that we're seeing in terms of the advertising market having a massive impact on Roku. Over the last 3 months, stock off just around 28%. Year to date, you're looking at losses of over 76%. The company also saying that it's going to slow hiring as a result of what we're seeing playing out in the broader economy right now. And CFO Steve Louden is going to be leaving Roku next year. Let's take a look at Qualcomm, another mover here, moving to the downside, off a nearly 6% guidance coming in weak. We just talked to Christopher Rowland of Susquehanna. He said that it's the worst Qualcomm guidance that he has seen in years. Rapid weakening in demand, elevated inventory, a couple headwinds here facing Qualcomm. Fourth quarter revenue, though, did come in line with expectations, $11.39 billion. Taking a look at the year-to-date performance, you can see the stock off just around 38%. Let's take a look at Etsy. Different story here. You're seeing gains of nearly 10% after our strong revenue report there is what's driving the action here. Up 12% on a year-over-year basis, $594.5 million, beating the street's estimate of $563 million. Gross merchandise sales better than what we were expecting, coming in at $3 billion. Fourth quarter revenue guidance also in line with expectations. Year to date, Etsy off 60%. Taking a look at Booking Holdings, you can see gains of just around 6% here after hours. That strong demand for summer travel clearly benefiting this company here over the last quarter. Revenue topping expectations, improvement in room night trends as it moved through the quarter. Also, the company more than doubled its profit. Year to date, though, shares still in the red, off just about 25%. And rounding it out with Robinhood, moving to the upside, up just around 4% here after hours, a smaller than expected loss of 20 cents. Sales, $361 million. That was better than what the street was looking for. Average revenue per user, $63. Estimate was for $62.58, so a slight beat there. Monthly active users, though, bit of a miss, 12.2 million. Estimate 13.7 million. 3 months, the stock is actually up 23%. Year to date, though, you're still looking at losses with shares off 35%. Rochelle?
All right, thanks, Shauna. Well, looking ahead, my stock to watch for tomorrow is Peloton. Now, investors are waiting for an update on the company's turnaround plan and whether it's seeing progress. It's reporting fiscal first quarter earnings ahead of the open. Analysts keeping an eye out for subscriber growth and, of course, that full year guidance. And the report comes just weeks after the company announced another round of layoffs affecting 500 people. At the time, CEO Barry McCarthy said the move was necessary to save the company. The stock is down 75% so far this year. All right, stick with us. Coming up, a big change could be coming for the NFL's Washington Commanders and owner Daniel Snyder. We'll have the details next.
Is the record for the highest selling professional sports team about to fall? That's the question with news at the Washington Commanders announcement today. Owner Dan Snyder has hired Bank of America Securities to consider, quote, potential transactions involving the franchise. Now, Congress and the NFL continue to investigate Snyder over a toxic work culture as well as an allegation of sexual misconduct. Snyder has already been fined $10 million by the league. And Snyder reportedly paid $750 million for this team in 1999 that today Forbes values at $5.6 billion. And Shauna, once you get a name like, let's say Jeff Bezos involved, which I believe is actually a possibility here, unlike the previous rumors, you're talking north of $6 billion easy for this team.
Yeah, it's going to be interested to see, one, who is interested in buying this team. Of course, more details just in terms of the sale we don't have those yet, so I think that's going to be critical just in terms of identifying a potential buyer. But that value is really incredible. You mentioned the fact that now it's worth, Forbes estimates it's now worth $5.6 billion. Snyder has owned the team since '99. He paid $800 million for it. That really speaks, Rochelle, to the astronomical rise that we have seen in the value of teams in the NFL, and certainly this getting a lot of attention. And it will be interesting to see who exactly gets involved. It would be fun if it was Bezos.
It'd be great. Great for the game.
I mean, I'll say, obviously, the Commanders are my local team. I've been watching them since I was in college back in the 1900s. But a lot of people, like when you look at some of the mixed reactions to this news, some people doing happy dances, a lot of people wondering, why is he even selling? A lot of people thought that Dan Snyder would never sell. Now, it's important to note that they did list in that statement they were exploring potential transactions. ESPN tweeting, It's unclear if this means they're exploring a sale of the franchise as a whole or seeking a minority owner. I thought it was interesting that former Washington quarterback RG3 said, he tweeted, who wants to be a minority owner of the Washington Commanders? I'm down to pay for a stake in the team and bring 10 fans along for the ride. So who knows? Who knows where this is going to go? Still early days, but clearly a lot of interest in this, Shauna.
Certainly early days, and Congress is still investigating Dan Snyder, the NFL investigating Snyder for a second time. So it'll be interesting to see how this all plays out. All right, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. We'll see you then. Have a good night.